guilt or any responsibility for anything that may happen after the deal is signed. However, it will be much, much harder to negotiate with a more hardline conservative government, which does have a more anti-West sentiment.
So let's talk about the new man, Raisi. It's said that he will be inward-looking. I just wondered what that really means. He has a currency which has imploded after they exited the 2015 deal the last time around. He's got a negative growth story on his hands. How does he focus inwardly?
By focusing inwardly, it will be more on domestic policy, and most importantly, what he's talked about during his campaign is rebuilding the economy. Now, that rests on the sanctions being lifted, which they are really counting on. The Trump's maximum pressure policies has really squashed the middle class in Iran, and there is huge poverty. Also, we are in the midst of a pandemic. The COVID issue is very important. So by inward looking, I mean that Raisi is going to focus more on domestic policy at the moment, and does not have any enthusiasm or intention on coming out of isolation and engaging diplomatically with the West, especially.
Well, we've seen not just a pivot. We know that there are strong links to China and to Russia. You say that they will grow stronger. How will that manifest most quickly?
Well, yes, Iran has already turned to the east during these sanctions and will continue doing so. With Russia, they have shared interest in the Middle East region and with China with regards to the sale of oil and business interests. This will manifest quite quickly. As I said, the dynamics of the US and the Iran relationship will change a little bit and will become a little bit more hostile. So within the region, especially in the Middle East, Iran will not change their policies very much so. However, a return to the nuclear deal will help curb some of these activities in the region.
How do you see the relationship between Raisi and the Supreme Leader, Ayatollah al-Khamenei?
Well, Raisi was a candidate backed by the Supreme Leader, and now the executive branch in Iran is wholly conservative and hardline. Now, we must remember there is factionalism within the conservative within Iran. However, this will allow for a possibly more streamlined policy making, as Raisi and the Supreme Leader of Iran will be in more agreement about such policies. But we must remember that the key decision maker, the final decision maker, especially with regards to foreign policy, is the Supreme Leader, Ali Khamenei, and what he says will go. But as we saw with Rouhani, because they weren't on the same page, there was some restrictions and limitations in how much they could engage abroad.
Baha, thank you so much for being with me this morning. Baha Karimi,
thank you very much,
visiting research fellow. You're welcome. We'll see you again soon, visiting research fellow at the Center on US Politics at UCL. Plenty more ahead on this Daybreak Middle East. It's Bloomberg.
It's lockdown. Everybody locked down. Also locked down. Everybody locked down. Hands up, 사각지대는 없어. All phones off, pixel camera. 좀 먹고 가 새끼지 멘탈. Hashtag 정쟁, no manner. 마치 ground zero 같이. 얽힌 이 모두가 victim. 겨눠지는 가상의 bullet one shot, two shot now 신고 따윈 없지. $1,000,000 후디엔 패는 게 내 Vanity Fair에서 망가 시기에 틈새로 출퇴기래. 결핍의 냄새를 breathing 잔인한 어린이 얼큰 패딩 질투 납도 친구들은 널리 번져 like a cop. 매일 내 못난 SNS 피드를 보유 퍼져가 보기였을까지 줄만 나에게 모든 게 cruel Get up, back up, mask up, lock down 난 인스타그램 속 라이브 내가 가진 아픔 깊은 우울감 병이 드는 너의 마인 두고 볼 순 없어 여길 벗어나 Party on lockdown 모두가 pay 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 Only for fame 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 다들 obey 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 Party on lockdown 떨어져 low 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 Losing control 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 구원해줘 줘 줘 Party on lockdown ay ay bear Triple S and your Gucci Moncler But brand 따라 친구 replaced 우정을 갈아치워 who's next 전염되는 거짓의 진실에 잘해 stolen 다시 기억하고 다투고 비웃어 feel like this is 병적으로 겉만 꾸며도 너도 나도 다 masquerade 짜여진 plan 모두 다 Big Brother 사정한 흐려지는 의식 brainwash 고개 끄덕여 다 Get up, back up, mask up, lock down 외면하고 있잖아 무력해진 맘과 깊은 소백함 몸이 트는 너의 맘 두고 볼 순 없어 여길 벗어나 Party on lockdown 모두가 pay 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 Only for fame 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 다들 obey 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 Party on lockdown 떨어져 low 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 Losing control 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 구원해줘 줘 줘 Party on lockdown 시야를 막아 선점은 감압해 뚜뚜뚜 Other way other way other way oh. Can't stop cause you won't stop 답을 몰라 방해돼가 끝도 없이 We are burning every day every night 구해줘 lockdown It's a lockdown Everybody lockdown It's a lockdown Everybody lockdown Everything is done 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 내가 control 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 앞으로 go 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 시작해 lockdown
Prawn potato chips. মুখে দিলেই টেস্ট আর ফানি কম্বিনেশনে হয়ে ওঠে চারিদিক সিম্পলি ফ্যান্টাস্টিক প্রাণ পটাটোস সিম্পলি ফ্যান্টাস্টিক
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Let me give you a quick snapshot of what's going on in the Asian market. They're playing catch-up to the equity market, which dropped last week. People are speculating what it means for the potential tapering in the United States. This is the U.S. equity board, but let's show you what's going on there. We're down by 0.5% on the S&P 500. UBS have done the numbers. If you pull away taper back from $1.4 trillion worth of QE, you could see an equity drop of around 3%. They say the earnings will power ahead. But this is a reflection in Asia of the anxiousness in regards to what would it mean for 50 basis points of a hike in 2023, but what would it mean for the removal of taper? When would it start? What would the nuance be this time around in terms of withdrawing that level of liquidity? So the equity markets in Asia come under pressure. The Nikkei down nearly 4% at one juncture, 27,920. Powell speaks tomorrow. You have a number of Fed speakers today. Kaplan on the hawk side, but Williams may set the table for a slightly more dovish pullback from the hawkish pivot on the dots, which we were told to take with a grain of salt, but now the market is almost careering ahead on the bond markets as if they're pricing in some kind of recession. The biggest tail risk that maybe is underpriced is, of course, topping out on the vaccination rate in the United States of America. The U.S. Treasury market continues to flatten. Danny Berger joins me in just a couple of minutes. We'll talk through the latest nuances on the Treasury positioning there. But this week, it is about the Qatar Economic Forum. It's powered by Bloomberg. It kicks off today. And the underwriters of the Qatar Economic Forum and the Qatar Ministry of Commerce and Industry, Investment Promotion, the Agency of Qatar, and the Media City of Qatar. Now, we've got the names lined up for you, and what a great time to talk to Ray Dalio. We know that he thinks cash is trash, but maybe you want some cash in your back pocket if the tail risk is an unwinding of the U.S. recovery. Larry Summers, we know, is a vehement disapproval of the policy regime in the United States of America at the moment. It's inflationist. Maybe he thinks, and he has said in the Wall Street Week just last Friday, that he's glad to see this reawakening of the narrative really from the Fed. The QIA, they've got swag. Mansour Al-Mahmoud and Blackstone's Stephen Schwartzman will discuss with Francine about volatility in markets. Can the equity rally endure? And maybe a little bit of Bitcoin. See whether there's anybody buying that in Qatar. This is Bloomberg.
Announcing a project and doing a project is something different. And that's why we are so proud. We have started now the first one here. It's running, and I believe that we will see scalability. We have now a base to show use cases, so we can develop new cases on how to build a hydrogen economy.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning from Bloomberg's Middle East headquarters in Dubai. I'm Manus Cranney with Danny Berger alongside me at London HQ. It's Daybreak Europe. These are the stories that set your agenda. Investors sour on the reflation trade. 30-year Treasury yields fall below 2%. Asian equities slip with U.S. futures. Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee the U.S. won't quit the accord again. Oil climbs. And in France, President Macron and far-right leader Marine Le Pen disappoint in regional votes. A setback ahead of next year's presidential election. 6 a.m. in London. It's 9 a.m. in the DIFC. I have a new cohort for the week. It's Danny Berger. Welcome to the show, Danny. Buckle up.
Thanks,
it's a bumpy ride in the bond markets. The steamroller is out. I mean, when they grasp a hold of a flattener, they just keep on going. 30-year paper below 2%. Have a look at this. This is the Nordea quote. We were chatting about it yesterday. I love it from the Nordea team. A few months of vastly overshooting actual inflation. Powell and the FOMC aborts the AIT regime, and it's the speed, Danny. It's faster than they dared anticipate. Good morning.
Yep. Good morning, Manus. I mean, what a day for me to first be starting with you. You're really just tossing me into the deep end here with all of this market action. It is absolutely crazy. And I think that Nordea quote just really encapsulates this debate going on. Is this a change in the reaction function? If every time some inflation starts to get a whiff, if the Fed starts to get a whiff of inflation, it swats it down. If I'm an investor, why do I care about long-term inflation? Why not go in and buy the long end of the curve here?
Absolutely, but it depends how much further this flattener has got to run. Nomura have a nice note out this morning, Danny. They talk about buy twos, buy fives, because they say the hikes are already in the price, and maybe we're just getting a little bit carried away with ourselves. Don't forget, equities dipped on the taper in 2013 and then went on for a fairly resplendent rush higher. What else have you got? Positions?
Yeah, positioning I think is so important here, Manus, because a day before the FOMC meeting, JP Morgan comes out with their client survey that shorts in treasuries are their highest since 2005. So you have to imagine a complete rethink of what you're holding in your portfolio if the Fed is all of a sudden turning to be more hawkish.
Absolutely. But the bond markets, they're almost pricing a little bit of a recession. What have we got on the day this week?
Yep, we definitely have, as you say, that recessionary pricing. If you look what's going on in the 30-year yield, you mentioned this dipping below 2%. But look, that move very apparent in the 10-year as well, a 7 basis point fall. And in all that context, it makes sense that you're going to go ahead and sell out of Japan, a very value-heavy index. And at the same time, we're looking at a NASDAQ 100 futures that is outperforming relatively. Yes, it's still down, but not as bad as the S&P 500, Manus.
Okay, let's see what the experts make of it, because King Dollar was reanointed, wasn't it, Danny? Joining us now is Esther Reichelt, Commerzbank FX strategist. Esther, let's deal with the framing of why the dollar spiked higher. Give us your version. A lot of people have tried to quell the angst about, 2 rate hikes in 2023. But it's the speed of the potential taper that seems to have irked the market. What do you make of the prospect of a taper of 1.4 trillion in QE by the end of 2022? What's my risk?
Actually, I think it's most of an issue for the bond market. What matters more for the FX market, at least, is what happens after tapering. How fast will the Fed lift off interest rates, and then how fast will they actually hike interest rates? And I think if you look at the dynamic at the bond market, there is some indication that there's now more confidence in the market that the Fed will react appropriately to inflation risks, and that they don't run into the danger of having to later hike rates much more aggressively. So I think this confidence has actually resulted in the dollar appreciation we are seeing right now.
So is this the Fed then, Esther, saying it's okay to go long the dollar? Is that the move that we're going to see from here on out?
Yes, at least in the short term, I think. In the medium to long term, it actually matters what will inflation do. Because if inflation disappoints, what we see quite a large chance that this might actually happen due to all these very intransparent reasons that drop into the inflation outlook. If inflation disappoints, the market will quite quickly price out any further tightening of the Fed, and then we'll also see a weaker dollar. So the overall medium-term picture is still quite unclear, in my opinion.
Yeah, I got one WhatsApp from Martin Malone at Alpha Book as I was driving in this morning saying, yes, lumber, it's just literally fallen off a cliff. Likewise with copper. So maybe there is justification that we've got ourselves all in a lava over inflation. Tell me what you make of this. Everybody got rather riled up by Bullard's comments about rate hikes at the end of 2022. We get Patrick Harker later on and we get Williams later on ahead of Powell. If you go back and look at what Bullard actually said, it sounds like he's more bullish on the economy than he was hawkish on Fed rates. In an extension of growth in the US, Esther, what does that do to the dollar?
Yes, exactly. Bullard is actually a great example because he does not fit into this typical Dove-Hawk scheme. He was like for a very long time in favor of low rates, but he was always concerned that the Fed might actually miss the point where it's appropriate to tighten monetary policy. And clearly, for him now to advocate for interest rate hikes, maybe already in 2022, clearly signals that at least he is much more optimistic on the economy and on the inflation dynamics, that we've actually be able to escape this low interest rate, low inflation environment. But for this to actually be true, he will also be still waiting and seeing what kind of data will come out.
Bullard, of course, a non-voting member, but this week, Esther, we have 14 different instances where we get Fed policy speakers. It feels like there's a lot of chance for volatility in this market. Is the regime of low volatility in the FX space, is that now over?
I would at least assume that this volatility is going to pick up. Actually, I was a little bit surprised that it remained so low, even for for the longer term, like 1 year volatility, 2 year volatility, because over the next 1 to 2 years, we'll definitely discuss a lot more about lift of various central banks and how, for example, emerging markets will react to a potential tightening of the United States or of Fed. So in my opinion, this low volatility environment we've seen over the past few months will no longer be justified.
Well, let's just dig into the EM call. I know that everybody's saying to me, this time it's different. I don't know, pick a market, and everybody says it's different. But if I look at the EM space, you've got Brazil, Russia, Czech Republic, South Africa, and Hungary. Some of them hiked, some of them are expected to hike. Where's the biggest play in EMFX? People say to me, be much more judicious and idiosyncratic. So how do you play a tighter view on EM?
Well, we've seen like most of these central banks you have just mentioned, they have been quite cautious to react appropriately and quite early in the cycle to avoid falling behind the curve. So if they have to fear that the pressure on their currency increases as the Fed seems to hike, they hiked interest rates. But I would still keep an eye on the whole pandemic situation and the economic situation, because also these central banks will be reluctant to hike appropriately if the economy seems to suffer much longer, potentially due to further waves of infection. So for me, who seems most attractive are those central banks who have traditionally been quite hawkish, like, for example, the Czech Central Bank.
Esther, quickly here, does that mean that the carry trade can indeed come back? We know it was hit pretty hard over the past week with the hawkishness from the Fed.
Well, at least in the medium term, I would be very cautious, as we have already said, because I would expect volatility to pick up, and typically that's not a good environment for carry trades.
Right. Well, Esther, you're going to stick with us. We'll get more from you. Esther Raichek from Commerce Bank. Now let's get to First Word News in Dubai with Desley Humphrey. Good morning, Desley.
Thanks, Danny. A day after hardline cleric Ebrahim Raisi won Iran's presidential election, global diplomats adjourned their 6th round of meetings over reviving a nuclear deal. It's the 3rd time since talks began in April that deadlines have been missed to find agreement. Iran maintains it needs a guarantee the US won't walk out again. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional elections. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness almost £15 billion of annual R&D spend to find solutions for the public good. The new Office for Science and Technology Strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. UK supermarket Morrison has rejected an unsolicited proposal from US buyout firm CD&R, valuing it at some £5.5 billion. The retailer says the offer, at about 29% above Friday's closing price, undervalues the group. Under UK takeover rules, CD&R has 28 days to make a firm offer or walk away. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Desi Humphrey. This is Bloomberg Manus.
Desi Humphrey, thank you very much here in Dubai. Don't miss the coverage. It kicks off the Qatar Economic Forum powered by Bloomberg. Kicks into gear today. The underwriters of the Qatar Economic Forum are the Qatar Ministry of Commerce and Industry, Investment Promotion Agency Qatar, and Media City Qatar. The names: Ray Dalio, Larry Summers, QIA's Mansour Al Mahmoud, Blackstone, Stephen Schwartzman, and many more. Coming up on the show, good progress. The ECB's verdict on the policy overhaul. We discuss the outlook for Europe. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This is Daybreak Europe. I'm Danny Berger in London with Manus Cranny in Dubai. Now, European Central Bank President Christine Lagarde says its governing council is making good progress on the biggest overhaul of the institution's monetary policy in almost 2 decades. Now, her comments come as the entire governing council met in person this weekend, and that's the first time, of course, they're meeting in person since the outbreak of the pandemic. Now, their aim is nothing less than to retool the ECB for the 21st century with a new inflation goal, perhaps that sounds familiar, better ways of measuring the economy, and agreement on how to treat issues such as climate change and inequality. Esther Reichelt of Commerzbank FX Strategist is still with us. Esther, we also have a BOE rate decision later this week as well, along with the ECB meeting over the weekend. Has the Fed's hawkishness caused a soul search of types among these central banks who now possibly also have to weigh tighter policy?
Well, at least for the ECB, this will clearly not be the case. I think the ECB will be happy the more their monetary policy diverges from the Fed's, as this promises, in their view at least, also a weaker euro, which is something they still keep an eye on, as they have at least stressed in January. This will not have changed. For the Bank of England, this might look a little bit different because they are in a different situation. Their inflation outlook is much stronger than for the euro area. And they've also started or did a slight indication that they are also at least keeping an eye on the pace of their bond purchases. So still, I think with infections increasing again in the UK, they will not point to any, reason for any changes in their monetary policy too soon.
So, Esther, it's interesting, isn't it, where we are at the moment, the rise of the Delta variant in the United Kingdom. And if you look at The Guardian's article, I put it out on LinkedIn and Twitter because I think it's perhaps the most underpriced risk. 2 Americas will emerge from the Delta variant spreads and vaccinations drop. Take your mind back, Delta variant and a topping out of vaccination rate in the United States of America. These are very underpriced risks, aren't they?
Yes, in my opinion, this is indeed the case. However, it's unlikely to be an isolated risk for some countries or currency areas. I think that's will be a problem, a global problem. So it's more like not an idiosyncratic currency issue, but more of a risk sentiment consideration.
What's going to be then driving the euro dollar from here on out? Is it going to be central bank policy? Is it not the variant then, for example?
I think what will matter more is actually the central bank monetary policy. And in this case, the Fed side will be dominating, because for the ECB, it's quite clear that even if they reduce their PEP purchases, which were strongly related to the pandemic, we do not even have started thinking about a general reduction of their other asset purchase programs, and it will be still several years before even the most hawkish hawks in the ECB think that a rate hike will be warranted. So the more music is playing on the Fed side.
So let's talk about the Bank of England. Andy Haldane, it's one of his last meetings this forthcoming week. We expect him to sound the inflation alarm bell, is the Bloomberg story. How soon do you see inflation being a problem for us, or not, in the UK? Because I've seen a number of houses. Credit Suisse say a hike in Q3 2022, and BOA say May 2022. So the hiking path is being pulled forward here. So do you see an inflation problem, as Haldane does, and a timeline that aggressive on rate hikes in the UK?
I think the Bank of England will also focus maybe less on inflation. They'll also point towards several transitory factors that are having an effect on the inflation rate. And I think central banks will still be able to justify less focus on the inflation for at least about around 1 year. And the Bank of England has several other problems they have to take into consideration. On the one hand, that is the Delta variant. We've seen over the past few months that the pandemic is having a much stronger effect on the pound than on other currencies. but also, of course, the continuing Brexit risks. It's still unclear how the Brexit is affecting the economy, and that's still something the Bank of England will take into consideration and will maybe result in them being a little bit more cautious than the whole the focus only on inflation will justify.
Esther, then give us where some concrete numbers are going to go for these currencies. For example, we've seen some pretty bullish positioning in different leverage funds when it comes to the pound. Are we at sort of max positioning here? Can it run any further, or is the next move lower when it comes to sterling?
Well, I think in a cable, at least against the US dollar, there is a strong indication that at least in the short term, the next move is going to be lower, as the US dollar will also be dominating here, because the focus is right now that the Fed will be more aggressive or more confident to react than maybe the Bank of England will be. And I think it's also in the interest of the Bank of England not to run too far ahead of the Fed, or to run ahead of the Fed at all, because of all these Brexit risks. They should also be interested in a slightly weaker pound sterling and don't want to push any further appreciation risks there.
So give us a drawdown on sterling, Esther, before I ask you where you hide on a Delta variant spike. So where can cable and euro sterling come back to?
Actually, we think it's like the appreciation potential in euro sterling is quite exhausted, and maybe like 1 cent lower or something like that. But after that, all these concerns about pandemic and the Brexit and a reluctant Bank of England will actually that was most likely to disappoint the moment the currently quite aggressive market expectations will most likely result in euro sterling returning to the levels we have seen a few months ago, around 87.
Let me pick off on that perhaps second part of Manas's question there. Where do you sort of move to? Where is the protection? Should we see more concern of the Delta variant? What do you want to be buying in that type of environment?
Well, as I said, it's a risk consideration, at least on a global perspective. So, of course, some protection via the traditional safe havens, that's still the Japanese yen or the Swiss franc, might make sense there if you want to really protect against further flare or a renewed flare-up of the pandemic concerns.
Okay, Esther, the good old yen, it might be the haven of choice after all. Never mind your Bitcoin, bit too volatile for some. Esther Reichelt, Commerzbank FX strategist, joining us with her calls. There you go, Danny, we got the calls in at the end. We're going to talk about France. The exit polls, they show that the French President Emmanuel Macron and the far-right leader Marine Le Pen both fared worse than expected in the first round of regional elections. The details, this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax
in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's Daybreak Europe with me, Menace Cranny in Dubai. Danny Berger alongside me at London HQ. We've got the early results, Danny, indicating that President Emmanuel Macron and his opponent Marine Le Pen have fared worse than expected in the first round of France's regional election. Now, this election is watched closely because the next presidential vote, it's less than a year away. Let's get to Paris. Caroline Conan is tracking the exit polls. You're busy. Geneva last week, back at home in Paris today. What did the polls tell you, Caroline?
So it was actually very disappointing results for both President Emmanuel Macron and for the far right-wing leader Marine Le Pen, because if you look at Macron's party, LREM, it did not come first in any of the 13 regions of mainland France. And even if you look at Marine Le Pen's party, Rassemblement National, it only came first in Provence, in the southeast region, even though it was expected to be first in several other regions. And even in Provence, the second candidate from the traditional right wing is actually neck and neck with the candidate from the far right wing, so might not even win in the second round next Sunday. So clearly, this is a comeback of the old traditional parties, the left, the socialists, and the Greens, and the traditional right wing. Remember this right wing that existed before Macron, the right wing of President Sarkozy, of President Chirac. This traditional right wing is making a comeback in the Île-de-France Paris region, where you have Valérie Pécresse, the outgoing president, and also in the northern region of Hauts-de-France, where you have a candidate called Xavier Bertrand, who is also the outgoing president of the region, and who is actually already declared himself a candidate to face Macron and Le Pen in the next presidential elections next year. So clearly, this is a show. This shows that Macron and Le Pen, this is not necessarily the battle that the French want to see next year.
How do you take those results then and translate them into national politics?
So this is not necessarily a bellwether for the elections, the presidential elections that are 10 months away. But Macron had one target here, create some local roots with some local elected officials who could then relay his ideas and his program at the local level. Clearly, he failed. And Marine Le Pen's target here in those regional elections was to secure some big regions and have a lot of delegates in those regions, also in order to relay her ideas and her program for next year. They both failed. The French do not necessarily want to see a rerun of the 2017 presidential elections. And another lesson was abstention. 2/3 of the French did not go vote in those regional elections because they didn't want to see this match between Le Pen and Macron. So this is also something that the politicians will have to listen, and the comeback of the traditional right wing.
Caroline, thank you so much. Caroline Conan in Paris. Up next, the Iranian nuclear deal. Round 6 has been abandoned for now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Good morning, everyone, from Bloomberg's European headquarters in the city of London. I'm Danny Berger with Manus Craney live from Dubai. This is Daybreak Europe, and here's what you need to know today. Investors sour on the reflation trade, that 30-year yield on the Treasury falling below 2%. Asian equities slip with U.S. futures. Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee that the U.S. won't quit the accord again. Oil climbing today. And in France, President Macron and far-right leader Marine Le Pen disappoint in regional votes ahead of a setback in next year's presidential election. Manus, certainly a wild day in markets and really a continuation of what we saw last week. In that extreme flattening of the yield curve, Connor Sen at Bloomberg Opinion says, hey, is this the markets maybe sniffing out some hawkish policy error from the Fed?
Yeah, I like Martin Malone sent in a note, and it ties up with the Queen of Charts, the biggest flattening that you've seen in a decade, which is 30s to 5s. But to give you some context around this, and we did it yesterday, that is a 40% unwinding of the steepener that you had last year. And the only other time you've had moves of this magnitude, Danny, is in 2008. It's in Operation Twist. And indeed last year when they launched this next round of QE. So the magnitude of this flattening doesn't appear at this juncture to be done just yet.
That's right. But you also, I'm wondering if you kind of think that maybe the Fed did their job here. I mean, this isn't a 2013 taper tantrum. People are still moving into U.S. assets. The dollar is still doing well, as we were talking about with Esther. So perhaps they've kind of avoided the worst type of reaction you could have seen in this hawkish shift.
Yeah, FCON is still loose. We know, as Esther Reichert just said to us from Commerzbank there, which is, look, Bullard, who we were quoting in terms of 2 rate hikes the end of 2022, doesn't fit into the classic hawkish dove camp, and he's more interested in the bullish economy than the hawkish tilt. Quick sweep through the markets, 30-year paper below 2,000, below the 2%. That is a big move on 30-year paper for you, 195. So we're below 2% for the first time since February. Nomura say you want to buy the 2s and 5s. They say a hike is now priced in. Equities are down by almost 0.5%. UBS say if you take away the taper, it's probably only the equivalent of around 3% on equities because earnings are so resplendent. Earnings growth will be around 10%. They say it'll be a rerun of 2013. Bang, down it went 6%, and Bosch, up it went by 30%. So let's talk about inflation. We've got the dollar, copper, and lumber. Lumber, I think, is closed, but copper is open on the LME. And here we are. Look at this copper, down 0.7%. Lumber down likewise on the futures. The dollar continues its trajectory higher. The question is it a little bit overbought? We got the mini shocks rerun of 2013 and 2015. So could it be that the dollar is just at the start of its next cycle? So there we go. Dollar trades 11.40. Oh, I'll round it up. 11.46 is where we trade, Danny. Let's talk about the revival of the Iran nuclear deal. Those talks, they've ended without an agreement. The diplomats, you know what, let's talk about Bitcoin. My apologies. I ran ahead of myself. This is disgraceful, Danny Berger. I've never been like that before. I made so much of it.
How could you
what
forget
do you reckon on this Bitcoin
How could you
move?
forget? I mean, look, we have China cracking down, continuing to really try to pull back on some of the mining that's going on. Of course, there's the environmental concern. I know you care about that hash rate, Manus, but it's the entirety of the crypto space really falling, not just Bitcoin, but Ether too.
Incoming mail. Yes, absolutely. And the hash rate is the mining rate in China. That's all that everybody focuses on. I just tie it back. The reason why I'm a bit obsessed, Danny, about the Bitcoin move this morning is, of course, Michael Burry. All the speculation, it's drawn the retail investors in. And when crypto falls from trillions or meme stocks fall to tens of billions, Well, that could mean the mother of all crashes to come. It plays to my inner Grinch. It plays to my inner Burr. Okay, Danny, let's talk about Iran. Now we can reset the pace, because that nuclear deal, it ended without agreement between the diplomats in Vienna, a journey in a 6th round of talks, and there are major gaps remaining in that accord. And just a day earlier, well, the hardline cleric Ibrahim Raisi was declared the winner of Iran's presidential election, and the result could further complicate diplomatic efforts. U.S. National Security Advisor Jake Sullivan spoke to Fox News on Sunday. Let's take a listen.
Well, I think what we need to do in the United States is keep our eye on the ball. And that is our paramount priority right now, is to prevent Iran from getting a nuclear weapon. We believe that diplomacy is the best way to achieve that rather than military conflict. And so we're going to negotiate in a clear-eyed, firm way with the Iranians to see if we can arrive at an outcome that puts their nuclear program in a box.
Well, Simone Foxman is tracking the story from Doha for us. So Raisi's election, I suppose the question is, the oil market thinks that the talks are going to be delayed as a result of breaking up on round 6. But what do you think Raisi's election might impact the talks, Simone?
Yeah, well, Manus, there's a difference between sort of the long-term impact, Raisi taking a more confrontational tone towards the West generally, and sort of the near to medium-term impact, which is on the deal. Raisi himself has expressed some support for the deal, but most importantly here is the support that the Supreme Leader, Ayatollah Ali Khamenei, has expressed for the deal, because he is seen as the real ultimate decision-maker, and even the hardline members of parliament, Raisi and his supporters, will essentially go along with what the Supreme Leader says. You know, the oil market probably reacting to the idea that this said by Sarah Vakshori, she's at SVB Energy, essentially that we won't see all that oil come back immediately if we have a hardliner in Iran in the administration. We do have time, however, before Raisi takes office. He's not expected to do that until early August.
Simone, we've also got a key deadline this week. What is it? What is the impact of it going to be?
Yeah, Danny, good morning. June 24th, this Thursday, that's the expiration of a temporary agreement to extend some of the nuclear monitoring that the UN's agency, the IAEA, is doing in Iran. Now, this nuclear monitoring is key to the underlying nuclear deal. That's what Europe, that's what the United States wants Iran to keep allowing. And right now, essentially, Iran stands to potentially kick out nuclear monitors from that IAEA agency. The only thing keeping them there, the only thing keeping that data going, is this temporary sort of stopgap measure that expires later this week. We do expect to see this agreement extended, but there's always a chance, always the risk of some sort of policy failure here.
All right, well, we're going to have to keep an eye out for that Thursday deadline and probably have you back to tell us exactly what happened in the run-up to it. Simone Foxman in Qatar, thank you so much. Now let's get to the first word news in Dubai with Desley Humphrey. Good morning, Desley.
Thanks so much, Danny. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness almost £15 billion of annual R&D spend to find solutions for the public good. The new Office for Science and Technology Strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. A blank cheque firm backed by billionaire Bill Ackman is buying 10% of Universal Music from Vivendi for about $4 billion. Ackman's SPAC, Pershing Square Tontine Holdings, says the transaction values the home of Taylor Swift and Billie Eilish at $42 billion, including debt. Property-wise website Rightmove says UK house prices grew more slowly in June as a lack of availability drained momentum from the market. Asking prices rose 0.8% this month after a 1.8% gain in May. But the increase is still the largest for this time of the year since 2015, boosted by people seeking to leave London and wanting more space. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny and Manus.
Desi, thank you very much. I'll pick it up from here. Well, the Biden administration has rejected a call from the Venezuelan President Nicolas Maduro for relief from U.S. sanctions. Maduro made the comments in an exclusive conversation with Eric Schatzker.
I believe that the sanctions are immoral. That's the first thing. They are cruel, very cruel for a country. And I think that at a round table of conversation, even if it's private, the United States of America, the Biden administration, should accept it as such, should see it as such. And the sanctions are transformed. As the Human Rights Organization says, the special reporter that came to Venezuela for the matter of the sanctions are transformed into a great violation of the human rights of the Venezuelan men and women. Furthermore, not only is it a cruel mechanism that causes suffering to the people, but it's also a failed mechanism. Failed. Because all the sanctions, in an extremist and irrational manner, were applied by the Trump government against Venezuela for a change of regime. And they didn't achieve it. Nor are they going to achieve it. So the sanctions should be recognized as illegal, irrational, extremist, cruel, and they should be lifted.
En su opinión, señor presidente, pero todavía es la política.
In your opinion, Mr. President, but it's still U.S. policy. And it seems to me the U.S. won't change its policy without a change in positions.
Entonces es un juego cerrado, Eric.
Then it's a closed game, Eric, because we have our principles, our Constitution. We have the right to life, to economic freedom, to commercial freedom. Venezuela and the whole world has the right to commercial freedom. There can't be one country that, because of the control of the currency and of the banking system, imposes to the rest of the countries of the world what should happen in their country at a political level, who should govern or who shouldn't govern. If that was established, Eric, it would simply be the end of the United Nations system, the end of the international law. No, the United States must recognize that an international law exists, that a multipolar world exists, that another world exists, and furthermore, it must recognize, sooner than later, that what they are doing with Venezuela is a brutality only comparable to the Vietnam War and the massacre that they committed against the people of Vietnam. They are committing an economic massacre. Venezuela has the right to freedom to produce oil, to sell it, to obtain profits, to fulfill its international obligations, to maintain the life of the people. Venezuela has the right to produce gold and sell it. Why aren't we going to have the right to do that? Why is the right to economic freedom going to be taken away from us? Why? Someday that will. I have faith. I am a man who believes in God very much. I am a man of prayer and of action. And I have the faith that someday that message is going to arrive. And it's going to produce the changes that we need for a better world, a more human world, a world of respect.
Es un problema porque ustedes obviamente no quieren.
That's a problem. Because you obviously don't want to live under the sanctions anymore. You're not willing to change anything?
Es que los cambios en Venezuela se producen todos los días.
The changes in Venezuela are produced every day, but there can't be a relationship in the world where I put a gun to your head and I tell you, act the way I want you to, or I'll shoot you. You can't put a gun to the head of the people of Venezuela, so that from the United States, they'd tell us what we need to do. We would turn into a colony. We would turn into a protectorate. We would kneel down. We would betray the magnificent historical legacy of these giants, like Simón Bolívar. No country in the world, no country, and even less so Venezuela, is willing to kneel down and betray its legacy.
Venezuelan President Nicolas Maduro there speaking with Bloomberg's Eric Schatzker, calling U.S. sanctions economic brutality. Now, Manus, as we head into the break here, I just want to flag Bitcoin continuing to drop down nearly 5%. That pain really is going on as we have China continuing to crack down on some of the Bitcoin mining. And so coming up, we're going to discuss that Bitcoin declining there.
Yeah, we got the hash rate. I think we've got the chart, but this is it. So if you close down, I think it's Yan province in the southwest of China. If you go to close down mining in one area, that's nearly 80–90% of China's Bitcoin output. The question is, Danny, where does that mining transfer to? You can close down in one geography, but where does it go to?
Right, but a lot of the Bitcoin bulls might argue in this scenario, hey, this might be an opportunity to mine in a more environmentally friendly way, right? There's always a positive if you're a Bitcoin bull.
Yeah, we've got a lot of solar power here, but who are we going to ask about the hash rate then?
Oh, of course, it's Joanna Ossinger. She is our queen of Bitcoin, our Bitcoin expert. We're going to ask her about that. We're going to ask her why the hash rate matters and what's next for the cryptocurrency. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's Daybreak Europe. I'm Manus Krenny in Dubai with Danny Berger alongside me in London. Bitcoin tumbled, as we've been saying to you over the weekend. China continues to crack down on crypto mining, promising tighter scrutiny. But cryptocurrencies have endured a lull before. Bitcoin is now trading at about half its record high of $65,000. That was mid-April. Oh, a long time ago. Joanna Ossinger is the lead cross-asset coverage. So here we are, more restrictions on Bitcoin mining. Is that really what's dragging us a little bit lower today, Joanna?
It looks like it's at least one factor, particularly because of the uncertainty about what's next. And you could have miners going from China to other places, but one thing that is a factor, you bring up the environmental issue, for instance, Yan, which is a hydro-rich Chinese city, is one of the places that appears to be cracking down. And so if you get the cleaner energy places in China also cutting back on the Bitcoin mining, it could revive the environmental concerns as well.
Joanna, in your story, you talk about how the hash rate is declining and this being really important for the price. For those who aren't obsessed with Bitcoin like you and I and Manus, can you explain what the hash rate is and why it's so important right now?
It's basically just the computing power that's going into Bitcoin and the mining and the processing. So when the hash rate is declining, that shows that the miners are shutting down, that they're not putting as much computing power into the network. And so that's leading to a lot of this uncertainty of what's going to happen. Will it be replaced, or will people be pulling back from it?
Joanna, always great to get you on, especially when it's not always about Elon Musk's tweets. Bloomberg's cross-asset team editor, Joanna Ossinger, thank you so much. Coming up, we look at the impact of a hawkish Fed on stocks. Japanese equities on track for their worst decline in almost 4 months, continuing to see declines in that 30-year and 10-year yield. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Well, it looks like all the signposts are positive. We see a recovery globally. We see many countries are bringing this pandemic under control. I'll give one example, US, for example, and many other countries. This country, UAE, has done a great job in vaccinating its population. So all the signs are very positive going forward. Commodities are almost at 10 years high. The stock markets, as mentioned earlier, Abu Dhabi market as well. So we see a very strong appreciation. That's a signal and very strong gesture that, the situation is under control and more positive. And I would say an acceptable recovery is on the way. So overall, it's very positive, all sides. And we think hopefully the worst is behind us. And we're seeing more recovery and more positive signs going forward.
Mustafa, you've lived through many different cycles. We're in the midst of the Federal Reserve talking about tapering and huge debate about what that means. Are you concerned about a taper tantrum, or how do you look at the debate around the Federal Reserve potentially tapering?
I think there are different ways to look at these issues. However, we will maintain a positive, as I mentioned, view on the development at the macro level, at the micro level. So we remain positive, Manos. I hope things will improve going forward. We've seen very, very strong positives so far and strong recovery. I hope that momentum will maintain for the foreseeable future.
Mustafa Al-Kaabi, the CEO for UAE Investments over at Mubadala. Danny, it's interesting with Mustafa. He's just come back from the States, and we were chatting obviously before and after the interview, and he sort of said, he's really impressed with what's going on there, and that drives their proclivity for risk. They're coming with an IPO to the market. Let's continue the conversation with Paul Dobson. It's a satellite IPO. Don't know whether we can get in on it or not. Or whether we're allowed to. Our Asia Markets editor, Paul Dobson, not that we ever get involved in IPOs. There's the disclaimer, health disclaimer, risk disclaimer. Paul, Mustafa Al-Kaabi says he's impressed and the worst is behind us. But these markets are a little bit shaken. The flattener, the steamroller continues. Good morning.
Yeah, good morning. Yeah, exactly. Some pretty exciting moves in the early hours trading from the Asian markets here, pushing that 30-year yield in the US below 2%, with some pretty rapid follow-through as well. We saw, a move of almost 10 basis points again before things started to level out and cool a little bit. So still pretty nervous through our session, and maybe a bit more of a clear risk-off feel as well, with the yen the strongest of the currencies.
So then what do you make of what's happening in equity markets? Is it a logical move then that we'd see, for example, Japan, those equities fall so abruptly?
Yeah. Well, Japan has plenty of technology that's hurting at the moment, and quite recently the central bank there stopped supporting the stock market quite so heavily as well. So one of the stabilizers, if you will, has been removed. But I think, Japanese investors are obviously quite sensitive to what's going on in the treasuries market as well, probably joining in that rally, if anything, to not miss out if you think the yields are going to go lower for longer. At the same time, there'll be repatriation flows lending support to the yen, and a stronger yen is another thing that's bad for the equity market. So it sort of creates this double feedback loop in a way that hurts Japan disproportionately.
Well, definitely exciting moves that we're going to have to continue to keep an eye on throughout the morning. Paul Dobson, Bloomberg's executive editor for Asia Markets, thank you so much. And Manus, we're really just continuing to see this big bid in, stay in for when it comes for bonds and that sell-off in equities. And that's going to be it for us. What an exciting day to be in the seat for the first time with you, Manus. This is Bloomberg Daybreak Europe. The European Open is up next. They're going to continue it from here. This is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London. Mark Cudmore, our Markets Live managing editor, joins me in Singapore to take us through all of the market action this hour. The cash trade is just less than an hour away. Here are your top headlines. The reflation rethink continues in the wake of a hawkish pivot by the Fed. European and US futures slip with Asian equities. Treasury flattening, 30-year yields fall below 2% for the first time since February. Front-end yields pick up on comments from the Fed's Bullard. And nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee the US won't quit the accord again. Oil climbs. Very good morning, everybody. Welcome to the European Markets Open this Monday morning. There is a lot to talk about. 7 a.m. here in London. Already there's been a lot of action, of course, through the Asia session, picking up from where Wall Street left off there. Mark, what are the markets saying to you?
Good morning, Anna. Well, as you said, there's a lot to talk about. It's a kind of exciting day in markets. I think there's a lack of clarity about what the Fed meeting last week really means for the next few weeks. We still haven't reached a kind of decision or a conclusion out there 4 days after the meeting. And I think that's going to carry on this week with a little bit of volatility across assets. Today, so far, it's been a classic risk aversion day with equities lower, commodities lower, bond yields lower. And generally, I think we're going to expect to kind of see this volatility continue because we've got a lot of Fed speakers on the agenda and every data point is now live. So it's a very, very busy day in markets and I expect it to be a very busy week.
Right, absolutely. Plenty to talk about then when it comes to what's happening in the Treasury markets, what's happening to equities, the risk-off trades that you described there, Mark. We'll be back to that in just a moment. Let me just get to some breaking news, though, coming through on technology. European tech stock that is Prosus reporting numbers. Prosus full-year adjusted EPS, $2.99. That is versus 2.07 year-on-year. So this is the numbers moving all in the right direction in terms of comparisons with the previous year, at least. They're proposing a dividend. The core headline earnings, the revenue coming in at $5.1 billion. That's up 53% year on year. They do have a full year operating loss of $1 billion, an increase there of 69% year on year. So we'll dig into some of the details here. And part of the reason for doing that is we are going to be talking to the management of Prosus. We'll talk to the CEO, Bob van Dijk. Of course, there's been a lot of focus on the share swap that's being proposed between Prosus and parent company Naspers over in South Africa. A lot of focus on that. Some criticism from some shareholders. So we'll dig into what is the reasoning for that plan. We'll also talk about some of the non-Tencent related matters surrounding this business, their investments in food delivery and payments, in classified advertising, in education technology, all of that very crucial to the future of the business and the investment strategy there. Now, just under an hour away from the start of cash equities trading here in Europe. So let's look at the futures and what a day it was on Friday. And we feel the aftermath of Friday still through this global, through these global equity markets. This is the picture we have for European futures right now, expecting to see another down day then for European stocks. We already saw some heavy selling in Europe on Friday's session. We were down by 1.8% on the Stoxx 50. US equities were also very much under pressure, and we'll show you US futures, which suggests we'll also see some weakness at the start of trade there, although maybe not to such a degree as we are expecting to factor in here in Europe. The Dow especially was under pressure in Friday's session, and more broadly, it is this assessment of the reflation trade that is continuing. So financials, energy stocks, wherever you see heavy weightings towards those, you're going to see a heavy move out of those stocks. And that is something that's very much affecting the Asian session. Worth thinking as we look at what's happening then on the GMM, Mark.
Yeah, on the GMM, as I mentioned earlier, it's a classic risk aversion day. So we're seeing Asian equity markets across the board are weaker. It's just a sheer column of red in the equities column there. We're also seeing all commodities prices weaker, or pretty much all commodities prices. Oil has a little bit of a bid because there's no sign of an Iran deal in the market there. But most commodity prices are much lower. There's two other things to draw attention to on the GMM screen. First of all, you can see that bonds column is very, very mixed. And again, this is about this curve flattening. So those red boxes are those kind of front-end bonds where we're actually seeing yields trade quite a bit higher. And at the back end, we're seeing yields come much lower. So the bond play is really about flattening all around the world. It's being led in the US, but this is a global phenomenon since the Fed last week. The other thing to draw attention to is in the FX column, for the first time in ages, we're seeing the yen there as one of the risers. Now, what's happening is we're seeing both the dollar and the yen strengthen as we're seeing the rest of the world weaken. Again, this is classic risk aversion, and it's a risk aversion signal that we've not seen in FX for some time. This idea of the yen, the classic risk aversion play, this kind of stopping out of carry trades, going back into these low yielders. So that is very much the theme for the morning, that these markets are on the defensive right now.
And is this a taper tantrum, Mark, or is this too complex because it is about the flattening of the curve? Is it more of a sort of flattening tantrum? How would you best characterise what we're seeing?
It's a great question. I'm not sure what the answer is. I think we'll decide it's not a taper tantrum, but we're going to probably come up with some new name in the coming weeks that'll settle on. It is obviously related to this idea of potential tapering, so it's certainly not unreasonable to throw it out as a taper tantrum, but as you say, it's more of a flattening tantrum. It's different kind of price action than we got before. What we do know is that it's a Fed-caused shock in the markets, and there's still this big debate out there about whether we've kind of overpriced the move or not. If you remember, on Friday morning, this time Friday morning, our guests were kind of going, look, we've already repriced it enough. And since then, we've seen the 10-year curve, 10-year yields come down another 14 basis points. So really, it's hard to know, have we already priced it enough, or is this the start of a much bigger move? I'm kind of in the latter camp, that maybe not a bigger move in yields, but I think across markets, this Fed meeting is still being underestimated.
A flattening freak out then, perhaps. Taper tantrum was alliterative. That's why we went for it, I suppose. So we need something something that works with flattening. Let me ask you about the impact on stocks then, because clearly we are seeing stock markets under pressure. That happened in the US on Wall Street, happened in Europe on Friday. It's happening in Asia now. Looks as if it will continue through the European sector. And no surprise, I suppose, for Europe to be in the crosshairs here, because Europe had done pretty well as investors were pulling away from some of the growth stocks that had benefited from the pandemic, and we're going back into those reflation trades around energy, around banking.
Yes, so there's two themes here that are targeting Europe. One is that if the Fed has kind of declared the end of pandemic trading, I'm not saying the end of the pandemic, but pandemic markets, by their action last week, saying they're moving to a more normal reaction function, then the trades that did really well during the pandemic are going to unwind. And so European stocks have been the big outperformer of the past 6 months or so, and there's some money to come out of that trade. The other thing is that we're also seeing an unwind of value trades globally. We're seeing that in the Japanese market. We're seeing that in the sector trades in the US on Friday, and that will also be why Europe is suffering, that kind of unwind of cyclical trades. So I think that Europe is going to have a tough few days ahead. It already had a very tough Friday. I expect that to continue over the next few days. Again, I have no particular view on this kind of very, very short-term next few hours, because one thing I want to clarify is that volatility will remain, and that'll be, so it won't just be a straight line sell-off. Even if there's generally risk aversion this week, we will see some painful spikes for those who are trying to pay this on the bearish side.
Yeah, one asset that does seem to think it's got the measure of the Fed or worked out what this all means is the dollar, though, maybe, Mark. I mean, give us your thoughts on where we head there, because we saw the dollar gain, of course, in the immediate aftermath of what we heard from the Fed. That gain sort of continued for a couple of days, and we've held on to those gains. What do you expect to see then in the dollar?
Yes. FX has been surprisingly calm today, given what we've seen in bond markets, given what we've seen in equity markets, commodity markets, everywhere else. And as you point out, though, it's been calm with the continuation of the theme of last week, and that is dollar strength. Dollar bearishness was one of the consensus trades of this year. It's been a tough one to trade, but up in the last few weeks, we've been hovering around that 6-year low. We never managed to break down below it. I think that Fed signal last week has more of a short squeeze in the dollar out there. I think that the dollar will bounce farther than people reckon. It is true that the long-term bearish factors of the dollar, those twin deficits, those deeply negative real yields, and the fact that we still have a lot of liquidity in the system, even if there's a marginal hawkish turn, at the, just from last week, we still have a lot of liquidity out there that's going to chase non-dollar assets. So I think that the long-term bearish arguments for the dollar are valid. But they are long-term. They may not be relevant again for another couple of months. So I think the dollar short squeeze has more to go in the coming weeks.
OK, Mark, remember, of course, everybody, you can stay up to date with Mark and his team, the Markets Live team. Of course, MLIV Go is the function to use on your terminal. Mark is with us, of course, this hour. Coming up on the programme, talk to revive the Iranian nuclear deal drag as Iran elects a hardline cleric, Ebrahim Raisi, as president. We bring you all of the details there. Plus, we speak, as I mentioned at the top of the programme, to the Prosus CEO, Bob Van Dijk. Don't miss that conversation coming up at 7:30 UK time. Really sizable European tech player, Europe's third largest tech company, in fact. So we will certainly spend some time digesting the latest moves in the business there. Up next, we continue discussing all of the market action with Kokou Agboogblower from Societe Generale. If you have any questions of your own that you would like us to put to these guests, then please do get in touch. IB plus TV Go is the function to use on your Bloomberg. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the European Market Open. 12 minutes past 7 here in London, so 45 or so minutes to go until the start of equity trading, and European equity market futures point to the downside, as if to pick up from where we left off on Friday. So investors sour on the reflation trade after the Fed's hawkish pivot. Stocks slide with Japan's Nikkei leading declines in Asia. The 30-year Treasury yield drops below 2% for the first time since February. We're joined now by Kokou Agboogblower, Global Head of Economics, Cross-Asset and Quant Research at Societe Generale. Kokou, very nice to speak to you once again, as always. Let me ask you how you would characterise what we're seeing in markets today, because we have heavy selling of equities. We have considerable drop, particularly at the longer end, not so the short end, where we see so generally we're seeing curve flattening, of course. So how would you characterise this? It's not quite the classic taper tantrum, perhaps, that we were looking out for. What would you say is happening?
Hello, Anna. Yeah, so I think we've seen clearly a 4 standard deviation flattening of the 530s curve, and we think that a lot of that repositioning has taken place. And when it comes to the equity market, you can clearly see a rotation back to some of the growth and the Nasdaq type stocks at the detriment of some of the cyclicals and mining-driven stocks. I think what's happening is just a repricing of the pace of the tightening of the Fed. But if you look at the current environment, they haven't really done anything yet. You still have $120 billion of buying per month of QE by the Fed, and rates, real rates are still pretty negative. So the environment is still very positive for risk assets. And I think the market was always expecting a tightening of all these fiscal and monetary policies. It was just a question of when. So I don't think the story has necessarily changed. It's just an adjustment in timing and clearing up of these excessive positioning on the reflation trade.
Good morning, Coco. If you think that the 530s curve has now repriced for the kind of Fed surprise, do you think we're going to get some steepening from here, or do we have new stability at this level if you think the repricing's happened? And what will that mean for the dollar and volatility if this has been the repricing already?
Yes, so I think the long-term nominal bond yield at equilibrium should be equal to roughly real GDP growth rate and inflation. So if you say inflation is around 2%, and then we're going to see a normalized real GDP growth rate of 2 to 3%, you could clearly see, and you should see the 30-year above, the 2% should be around, the 3 handle over time. So what's really happening is more of a bear flattening. To some extent, you also have a bit of a bull flattening, because the pace of the tightening starting somewhere in 2023 is clearly forcing the 5-year point or the 3-year point to be higher than what it was. So you expect nominal growth rate to continue to increase going forward, given all the infrastructure and fiscal stimulus that will take time to be implemented. And as a result, you should see the nominal bond yield reprice higher as tapering occurs and fiscal stimulus is gradually taken off and the economy is able to grow on its own.
Okay, so that's the suggestion as to where you think the rates markets go from here then. What impact on the dollar, though, Coco? Where does that leave us? The dollar has adjusted to sort of higher valuation post-Fed and kind of stayed there. And we've seen, as Mark said last part of the programme, relative stability in FX markets. Would you expect the dollar to just hold out here then?
Yes, when it comes to the dollar, I think the drivers on the negative side is the deficit spending and all the leverage that's taking place, but it's also a relative argument. So it's the dollar against which currency, against emerging markets or against the euro. So ultimately, our view is that the repricing of the dollar has occurred, driven by positioning, but over time, you should see the dollar gradually strengthen compared to the European countries or the emerging market countries, which in terms of fiscal stimulus and the size of the money that has been injected in this country is nowhere near that of the US. And therefore, the US should see a higher relative GDP growth rate in nominal terms than that of the other currencies and other countries.
If you think that, the repricing is largely done across assets, it's an adjustment by the Fed, it's not a big kind of change of path, does that mean that the trades that have worked for the past 6 months, they will soon keep on working? And again, this is just a temporary, a few-day adjustment, so that all the trades, for example, European equity outperformance, or is a theme that has legs again?
Yes, so absolutely. So I think there will be some portfolio adjustment that is required. But when you look at the reflation themes in the equity market, for example, you take copper, for example, the cost of production of copper is $4,000, $4,500 a ton. The level of the copper prices is around $10,000 a ton. So if you're a mining company or a cyclical, you are generating a huge amount of free cash flow and your earnings momentum is still very strong. And if you take some of these stocks, for example, they still trade at 7 times PE, which is nowhere near as high as that of the, some of the growth or tech stocks, for example. And if you look at the commodity market, however, we think that the supply response that has been created by these elevated prices will keep those prices to underperform in the short term. So here it's more a question of how do you position to play the reflation theme that is still valid because we're seeing pretty significant demand-led GDP activity. How do you play them in a more precise and subtle way? So thematic basket, for example, around the Biden infrastructure plan or the European Green Deal, where you have targeted sectors that will benefit from these infrastructure investments that have yet to be deployed is the way we think of the context today.
Okay, so the reflation trade is still valid then through all of this. Kokou, really good to speak to you. Thanks for joining us. Kokou Agboogblower, Global Head of Economics, Cross-Asset and Quant Research at Societe Generale. Let's get a Bloomberg First Word News update, and for that, here's Laura Wright.
Thanks, Anna. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's National Rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. Some of Japan's biggest private employers will offer on-site vaccinations for staff from today in an effort to boost the country's slow vaccine rollout. Elsewhere, Russia, Germany and Portugal reported more cases of the Delta variant. Canada, meanwhile, says its border with the US probably won't reopen until 75% of its population is vaccinated. Property website Rightmove says UK house prices grew more slowly in June as a lack of availability drained momentum from the market. Asking prices rose 0.8% this month after a 1.8% gain in May. But the increase is still the largest for this time of year since 2015, boosted by people seeking to leave London and wanting more space. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Mark, Anna.
Laura, thank you very much. Laura Wright here in London. Coming up on this programme, round 6, but still no agreement in sight for the Iranian nuclear deal as Iran elects hardline cleric Ibrahim Raisi as president. More on that next. This is Bloomberg.
The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
No.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
We have proven now over the course of the past few years that we can reimpose sanctions in a devastating way, and the Iranians understand that, so we retain substantial leverage. Second, there are many more things that Iran wants in the way of sanctions relief that go above and beyond what's in the original Iran nuclear deal. So we will come to the table not just with sanctions leverage, but with a united front of the world powers that will pose to Iran a choice.
That was US National Security Advisor Jake Sullivan there talking about the Iran nuclear deal. Diplomats adjourned the 6th round of talks on that deal with major gaps remaining just a day after the hardline cleric Ibrahim Raisi won Iran's presidential election. Let's cross over to Simone Foxman, who's tracking the story for us. Simone, good morning. What impact then is the new hardline president already having or expected to have on the prospects for a return to the 2015 nuclear deal?
Yeah, good morning, Anna, Mark. Well, Raisi does support this deal. He has made some statements supportive of this deal, but even more important than him is the view of the Supreme Leader, Ayatollah Ali Khamenei, who has expressed support for returning to the 2015 nuclear deal, more or less as it was written. And so that is the overall expectation. There's a return to that deal more likely than not. However, some analysts in the energy market, including the likes of SVB Energy, saying this could push off a timeline for a return of more oil to the market. However, when you do think long term, this is an ultra-conservative cleric, very different tack than we saw under the moderate Rouhani. And so there is likely to be a longer, more confrontational approach from this new government than what we saw previously. And that could impact the idea that we would see that longer and stronger deal that Jake Sullivan and the Biden administration is pushing for.
And Simone, if the Iranian leadership are kind of expressing this willingness to return to the nuclear deal, what do we know about the sticking points that remain in those talks?
Yeah, Mark, these sticking points are actually pretty serious. There does seem to have been some progress on exactly which sanctions the United States would pull back on. As you might remember, the Trump administration imposed something like 2,500 various sanctions after it left that nuclear deal. But what still remains, Iran wants a guarantee that the United States just isn't going to up and leave this deal again and sort of leave the Iranian economy in tatters. The United States wants more confidence that Iran is going to follow through with the commitments it makes. It also wants, again, that longer and stronger deal. It wants this JCPOA agreement to be the entree towards longer talks about Iran's support for local militias, its human rights violations, and that is something that Iran simply may not bring to the table.
Simone, thank you very much. Simone Foxman there with the latest on the Iran story. Yeah, difficult to bind the hands of future administrations, it would seem, but we'll watch this story and see how it progresses. Coming up then on this programme, we speak to the CEO of Prosus on the company's full-year earnings, a potential share swap with Naspers and the company's stake in, of course, the Chinese tech giant Tencent. Bob van Dijk joins us shortly. He's already been saying this morning in the release, our strategy to reposition the group for an increasingly online world meant we were well prepared for the acceleration of online adoption through the pandemic. And we certainly saw that through the pandemic, and this business certainly has plenty of exposure to online growth. So we'll talk about that, and we'll talk about that how that could do on the other side of a global pandemic as well. Lots to discuss then with Bob van Dijk. That conversation coming up shortly. This is the European Market Open. This is Bloomberg.
Valuations, particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 7:30 here in London, so half an hour to go until the start of the European equity trading session. Mark, I know you've been thinking about bonds versus equities in the context of the flattening of the Treasury curve that we've been watching recently. What are your thoughts?
Well, the whole theme of the last 6 months, this year so far, has been this idea that a super dovish Fed pumping money into the system, offering no yield on the bonds, means, is this the death of 60-40 as a portfolio allocation, and therefore you've got to just put all your money in equities? There's just no point holding bonds that just offer so little return over such a long period of time, and especially such a deeply negative real return, given that we were seeing these monster inflation prints. Well, just in the last few days, that kind of cynicism or that narrative that 60-40 is dead has been completely blown up. As in fact, for this quarter, as we reach the last kind of week of this quarter, for the second quarter, the long bond total return is outperforming equities total return, which is really, really quite phenomenal, showing just what kind of damage to this idea has been done by the Fed in just the last few days. We have seen the long end yields just completely collapse over the past week. And this is really going to leave those holders of 60-40 yet again just laughing at all those cynics out there.
Okay, we'll certainly keep an eye on that, and the 60-40 lives to fight another day. Now, global internet giant Prosus, Mark, let's move on to that conversation, has posted full-year revenue of $5.1 billion. Prosus has also reported an independent valuation of its e-commerce portfolio for the first time, which has doubled from a year ago. The tech giant says the increased value is driven by growth in businesses, including food delivery and online retail. I'm very pleased to say that we're joined by the CEO of Prosus, Bob van Dijk. Bob, nice to speak to you as ever. We'll get to some of your internet investments, your online investments, the resilience of the business through the pandemic. We'll certainly come to that. Let me start with the earnings story, and certainly a lot of year-on-year numbers moving in the right direction. How would you explain what's been going on at Prosus in that context over the last year?
No, absolutely, and thanks for having me. It's been obviously as a whole a year of extreme challenge, right? And yet we've delivered our strongest results in the history of the company, and we accelerated growth right across the portfolio. And I think that really has everything to do with our strategy. So we've been setting up the company in the last years to really be purely focused at an increasingly online world. And when the pandemic hit us, however terrible it was, people did use online products more and more. And I think the reality was that that increased online focus of everybody who was sitting at home has made already very strong business models stronger, right? If you look at the overall results we're presenting, we're serving now more than 2 billion customers. And if you look at the e-commerce portfolio, as you said, right, it hits about 40 billion valuation, almost double from last year. So in the end, great consumer products then translate into good traction.
Good morning, Bob. What would you say to viewers and analysts out there who think that the announced share swap between Naspers and Prosus just seems too complicated and doesn't seem to align the incentives of directors and shareholders?
Yeah, no, first of all, I think we have more than 80,000 shareholders, and shareholders obviously have opinions, and we listen to those opinions. We really engaged quite extensively with several hundreds of them, and we basically covered shareholders that hold more than 65% of our shares. So we care about their opinions. And I think the complexity point is well understood. And the transaction is not simple. But if you look at the outcome of the transaction when we're done, actually, that is a very simple story, right? You have one great set of consumer internet assets, and that is actually held by two pockets of shareholders, 60-40, so 60% at the Prosus free float level and 40% at the Naspers level. So the outcome is actually quite overseeable. And in terms of incentives, I think there's been some questions around it, but in the end, like the majority of our senior management is exactly incentivized to make sure that value gets created over time, and we're very much in the same boat there.
Okay, so you're listening to the shareholders, Bob, but sticking with this theme, is this just a short-term solution to something that needs a longer-term solution? Will we have to see another rethink on this front? If this is all about trying to make sure that the value of Prosus and Naspers, keeps up with the value of one of your key shareholdings, which is Tencent, and you close that valuation gap, are we going to see something more creative needed in the future?
Yeah, I would say the most important point here is that the structure we have chosen here is actually one that addresses the problem in the most fundamental way and to the largest extent possible, right? So we are a South African company, as Naspers and Prosus is South African controlled, and that has to remain that way. It's clear that the way the regulation is formulated, but within that framework, this actually delivers a great deal of reduction of Naspers' size on Johannesburg Stock Exchange, and for it to go back to its current size, actually Prosus would have to increase in value by about $250 billion. So this is actually a very meaningful solution, and it does really address the problem in a fundamental way. But the good news is also, like, for the long term, it doesn't preclude us from making other steps to unlock value. So it's a big step. It's one that really moves the needle, but it doesn't preclude us from making further steps in the future.
Despite the intense diversity and kind of spread of your portfolio, some analysts have said in the past that it's really just a complicated indirect play on Tencent. Do you think the latest earnings results help kind of drive that kind of bigger wedge, showing the greater diversity that it's not just a Tencent play?
No, I think that's an excellent question, and if you look at the results, and I know you've had time to read some of the releases, it's actually really clear that we have a great investment in Tencent, which we are very proud of, and we are long-term holders of, and China consumer internet, I think, is the most exciting sector in the world. But the rest of the portfolio, so our e-commerce portfolio, grew revenue at 54%, right, year on year. And that is actually accelerating from where it was in the first half, and very significantly accelerated from where it was a year ago. And also, you've seen the trading profit go up by about 44% of that business. And we have now, if you look at that portfolio, 60% of that portfolio is profitable. And we've asked an independent valuer to look at that, and they say it's worth about $40 billion. So it's hard to ignore that. The growth pattern is just really impressive, and they're really great businesses.
That being said, looking at the Tencent story, Bob, you've sold down just a little bit of the holding in Tencent you've sold off a little bit of that over the last reporting period. You're now at 28.9% stake, I think. I'm not expecting you to tell me exactly if you're going to sell any more of it, but give us your thinking about the right size of that stake.
Yeah, we have no intention to sell any more of our Tencent shares. And the reality is it's never been sort of a push, but rather a pull from other opportunities. So we love what Tencent is doing. We love their position, and the leadership team is just the best in the world. So we want to support Tencent for the long term. But the reality is we had great opportunities that we also wanted to fund. And we've been investing in our core segments. We have classifieds, we have payments, we have food, obviously, and now EdTech as a fourth segment. And those businesses are, as I said earlier, are growing extremely fast and showing a lot of opportunity. And we needed some additional capital to fully deliver on that growth opportunity, and that's what we've done. In fact, we did it a number of years ago as well. We sold some Tencent, and then actually, if you look at the money we received from that, even though Tencent is a fantastic investment, we invested that back at a more than 30% IRR. So we had those opportunities, we found those opportunities, and that's why we did it.
You've doubled the valuation of your e-commerce business from a year ago. How much does that kind of correlate with the heavy investment in food delivery over the past 6 months, which seems to come at a slightly strange timing in terms that the pandemic is ending and people are wondering whether the great environment for food delivery is going to continue quite as strongly over the next year?
Yeah, so if you look at our food business, it grew revenue 127% year on year. And actually, if you look in the largest business that we operate, which is iFood in Brazil, revenue grew more than 200%. And that's obviously an exceptional performance, right? And at the same time, we've seen the investments, so the operating losses come down dramatically in the space. So I would say this has been an absolutely outstanding year for food delivery across the globe. But what has happened is that there's two things that have happened. There were a lot of people who've never used these services who started using them. And we see in places already where the pandemic is receding, those people are not going away. They actually build a new habit that they actually that they like. And on the other side, there were people who had used the products but have been starting to use them more. And again, we see a lot of that behavior to be very sticky. You know? So whether you're going to have the same very strong numbers that we had in the past year, that's hard to predict. But I think the customer behavior is definitely there to stay.
Okay, so some of that is sticky. Bob, thanks very much for joining us. Really good to speak to you. Bob van Dijk, the CEO of Prosus. Thanks for joining us from Amsterdam. Let's get a Bloomberg Business Flash. And for that, here's Laura Wright. Laura.
Thanks, Anna. A blank check fund backed by billionaire Bill Ackman is buying 10% of Universal Music from Vivendi for about $4 billion. Ackman's SPAC Pershing Square Tontine Holdings says the transaction values the home of Taylor Swift and Billie Eilish at $42 billion, including debt. UK supermarket Morrison has rejected an unsolicited proposal from US buyout firm Clayton, Dubilier and Rice, valuing it at about £5.5 billion. The retailer says the offer, at about 29% above Friday's closing price, undervalues the group. Under UK takeover rules, CD&R has 28 days to make a firm offer or walk away. Porsche is set to make battery cells for electric sports cars with German lithium-ion specialist Custom Cells. Porsche is taking a minority stake in the venture, while Custom Cells will invest a high double-digit million-euro sum. Local media reports the new batteries will allow charging in less than 15 minutes. Small-scale production is due to begin in 2024. That's the Bloomberg Business Flash. Mark, Anna.
Laura, thank you very much. Laura Wright here in London with your Business Flash. Coming up on this programme, unwinding the reflation trade. We'll be back to the conversation around markets. We take a look at some of these market moves that we've seen since the Fed's hawkish pivot. What's driving what? That's part of the conversation next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it,
people who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. 16 minutes to go until the start of cash equities trading. There's a lot of movement in markets, a lot of moving parts. Equity market futures called lower for the European equity session. Let's get into that conversation now. Investors sour on the reflation trade after the Fed's hawkish pivot. Longer-term Treasury yields decline as the sell-off in equities fuels demand for haven assets. The US 30-year yield drops below 2% for the first time since February. Let's talk about the flattening of this curve then and the impact that is having. Paul Dobson, Bloomberg's executive editor for Asia Markets, joins us now. Let's start with the Treasury market move, the flattening of the curve then, Paul. Is it done? Does it have further to run? What's the story? What are we hearing?
Well, it was a pretty extreme move in the middle of the Asia morning, one of those air pockets that we get every now and then where it seems like all of a sudden, the offers evaporate and there's still some buying interest there. So down went those yields. We have moderated since then. We're back close to that 2% perch for the 30-year. A lot is going to depend on what we hear from all of the Fed policymakers coming up this week, and increasingly probably what the data shows us as well about whether there can be much more follow-through from here. If you're 2% yields on the 30-year Treasury, around about where the Fed's inflation target is. Anything below that is pretty bleak outlook for the economy and tells you, people are either worried about the future growth impact from these Fed moves or, really doubting the long-term chances of inflation remaining high. Now the Fed has sort of damped those worries that it could get out of hand.
Good afternoon, Paul. We're going to get a bunch of Fed speakers this evening and later on this week that might help provide some more direction. But for the European session, what should investors be most focused on? Which asset? In the context that at the end of the last week, we thought it was the dollar. Now it's the yield curve that's grabbing attention, but we're seeing, as you said, some of the pairing of that yield move. And just in the last kind of 20 minutes, we're starting to see crypto collapse. So which is the asset to pay most attention to until we get the next direction from the Fed?
I think you're still going to want to pay a lot of attention to what's going on with those longer maturity bonds, whether it's the 30-year bond, whether it's the 30-year Treasury, just because, those sorts of assets are not supposed to be very volatile and they're flying around all over the place at the moment. So that gives you a pretty good reading into the sentiment. I do think that the dollar as well is a pretty good benchmark for everything else right now because it's a reasonably clean play. We were talking last week, Mark, you and I, about dollar Swiss franc being a particularly good barometer of the dollar rather than about the sort of other currencies, which can muddy its outlook. So maybe that's somewhere else where you want to pay some attention, see whether that dollar strength can continue to feed through into other markets.
And also, picking up on what you said there about keeping the long end of the bond market curve in focus, Paul, into the European session, the banking sector clearly is going to be in focus there. And we have seen a lot of people buying up European bank stocks because they thought the reflation trade was the way to go. And now that seems to be being questioned. Some of our colleagues over the weekend making the point that banks are still cheap, but maybe that's not enough.
No, it's the last thing that investors in those bank stocks are going to want to see, a big flattening of the yield curve, making it harder for banks to make money on that sort of transformation. And we've already been having warnings anyway that the investment banking profits aren't going to be as great this quarter as what we've seen at the start of the year too. So reasons to be edgy there. I think we had a pretty big drop in HSBC in Asia hours, which is a bit of a good giveaway for what might happen to the rest of the European banks as trading gets going over there.
Yeah, absolutely. We'll keep an eye on that. HSBC in session down by more than 3% over in Hong Kong. You're right to point to that one. Paul, thanks very much. Paul Dobson, Bloomberg's executive editor for Asia markets. Let's get a Bloomberg First Word News update. Laura Wright is here. Laura.
Thanks, Anna. A day after hardline cleric Ibrahim Raisi won Iran's presidential election, global diplomats adjourned their 6th round of meetings to revive a nuclear deal. It's the 3rd time since talks began in April that deadlines have been missed to find an agreement. Iran maintains it needs a guarantee the US won't walk out again. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's National Rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Mark, Anna.
Laura, thank you. Laura Wright here in London this Monday morning for us. Coming up on this programme then, we'll look at the individual stocks we're watching. Plenty at the overall market level to think about when it comes to big moves through the Asia session and where we'll pick up on those in Europe. But at the individual car stock level, we'll be talking about this car, Porsche, and the luxury car maker is entering the electric battery production market. More on that next. Plenty of...
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the European Market Open. Some 8 minutes to go until the start of Monday's cash equity session, so the start of another week. Futures point to the downside. There's some big reasons for that. We talked about that, the reflation trade being questioned once again. Some individual stock moves, though, to focus on, and some of them might buck that negative trade, and in some style. Let's talk about that with Joe Easton, who joins us now. Joe, very good to speak to you. Let's start with one stock that might really fly this morning on some bid activity.
Yes, morning, Anna. So this is Morrisons. We've had news at the weekend that the company has rejected a takeover bid of around £5.5 billion. This is from Clayton and Dubilier and Rice over in the US. It's about 230 pence a share, which is around 29% premium from Friday's closing price. So it's a massive premium here. The private equity firm has until the 17th of July to come back with a formal bid after this was rejected. What's interesting to me is I've been looking over the past few weeks. We've actually had private equity interest from the US invests in around 4 companies in the UK now. We had Sane, which is a financial services firm, John Lang, the engineer, and IMI, another engineer as well, now Morrison. So it looks like a big trend. Private equity interest looking at UK companies at the moment.
Good morning, Joe. And GlaxoSmithKline is in the headlines as well for its expectations around new vaccines. Tell us what's going on there.
Hey, Mark. Morning. Yes, so Glaxo, quite a lot of headlines around Glaxo over the weekend, actually. So firstly, in the Times, they're talking about Glaxo trying to boost their HIV drug pipeline because they've missed out on, obviously, the big vaccine push by the companies like Astra, the big rival. And also, they've got a lot of competition coming from generic drug makers at the moment, so they're doing a big push there. However, there is another report in the Mail of Sunday saying that the company could potentially cut its dividend, which would obviously be a big negative. They're due to report results at the end of July, and yeah, the Mail of Sunday saying this could come in order to give them more money to boost their drug making productivity in other areas, make up for that vaccine miss.
And when it comes to car makers then, Joe, there's a lot of focus on where they're going to get their batteries from, and some of them deciding to make, not buy. What's the story with Porsche? That's right.
So Porsche potentially going into a joint venture with Custom Cells, a German company, another German company. So Porsche have confirmed that they will be doing this. They'll be taking around an 85% stake in the company. They do say that the report says that it would be high millions of dollars in terms of spending. So we don't actually know confirmed how much they will be spending, but it is, of course, in the face of Tesla's real domination in the battery area. Lots of other companies trying to get in and get a piece of that. So it could be positive for news for Porsche, which is, of course, owned by Volkswagen.
Joe, thank you so much. European equities reporter Joe Easton, thanks very much for that. And Mark, we were talking to Paul Dobson earlier. He said to focus on the yield curve. We will focus on banks and the mining sector in particular here in Europe.
Yeah, there's so much to focus on. I think Paul's absolutely right that the yield curve is the most important thing overall to watch this week. But on a very short-term basis, it was only a couple of hours ago that it really was all about yields, those long-end yields collapsing, equities weak. But suddenly in the past little while, crypto has taken the limelight, and I do think it might be that week where we might have to jump between assets regularly and stay very flexible.
OK, Ethereum down 10% this morning, Bitcoin down by 8%. We'll keep across those. Thanks, Mark, for spending the past hour with us. A lot to talk about then as we get ready for the market open. The market open for European cash equities, that's coming up next, 4.5 minutes away. I'll be back with that shortly. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. A minute to go until the start of cash equities trading. Here are your headlines. The reflation rethink continues in the wake of a hawkish pivot by the Fed. European and US futures slip with Asian equities. Treasuries flattening. 30-year yields fall below 2% for the first time since February. Front-end yields pick up on comments from the Fed's Bullard. And nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee the US won't quit the accord again. Oil climbs. Good morning, everybody. Let's take a look at these futures then for European equity markets. We've been tracking the flattening of the curve, so we'll keep an eye on the bank stocks with that in mind. Certainly a great deal of action along the 5s, 30s curve. The same story as last week to some extent, but certainly supercharged through the Asian session overnight. Asian equities were weaker, down by 1.5% at this stage. So we'll continue to focus on that flattening of the curve, what that means for other assets. And we certainly see money coming out of equities through the Asian session. And to some extent, we're expecting to see that a little bit through the European session as well. Futures, as we saw there, were pointing to the downside. And a negative start to trade is what we're seeing. The Stoxx 600 just reflecting the FTSE really this morning so far. So the FTSE 100 down by 0.4%. The IBEX now opening down by 0.7%. The Stoxx 600 down 0.25%. I've mentioned banks. That sector's going to be in focus. The mining stocks will also be very much in focus. We saw iron ore lose more than 4% at one stage during the trading session through the Asian session. So that's certainly in focus for us. The CAC 40 opening to the downside as well, down by 0.7%. And in terms of the equity markets, we're really questioning the reflation trades once again. So something that we saw at the back end of last week, certainly continuing through the Asian session, through the Japanese equity markets, and carrying on once again into the European equity market session. As I mentioned, the CAC 40 opening 0.7% to the downside. So we're down by a similar amount on the Stoxx 600, waiting for the DAX to open this morning. So European equity markets opening decidedly lower. Investors sour on those reflation trades. After that hawkish pivot from the Fed, stocks slide with Japan's Nikkei leading declines through the Asian session. The 30-year Treasury yield drops below 2% for the first time since February, so that's very indicative of that flattening curve that we've been talking about. Viraj Patel, global macro strategist at Vanda Research, joins us. Viraj, what is the significance, do you think, of the flattening of that yield curve and the impact it's having on other assets at the moment? Does it fit with your view of where we head from here?
Yeah, broadly, I think so. I think, we've been calling for the reflation trade to unwind for a month now. And I think we're starting to see the early signs of that. First, from a positioning perspective, most reflation assets, anything that's an inflation hedge, has been fairly crowded. And that's usually a good starting point. But the second thing that we've noticed, and there's two legs to this unwind. First is the peak in the inflation narrative as we work our way through those base effects and one-time reopening effects in terms of price implications that will naturally keep a lid on inflation expectations. And the second thing is that central banks, especially those in the US and China, are telling us that actually these sort of unconventional, easy monetary policy conditions that we've been used to for the past 12 months aren't likely to exist forever. But it's worth remembering that the central banks aren't slamming the brakes here. All they're doing is taking easy monetary policy from fifth gear down to fourth gear. And really, for us, that doesn't mean anything other than just an unwind in the reflation trades, but a pretty constructive view for growth and having a growth bias across the portfolio and asset allocation perspective. That's one of the reasons why we like US tech stocks here, US growth stocks here into July. We think the conditions are pretty good for that.
Okay, and we're seeing the flattening of the curve kind of spreading. So something that was very Treasury-centric to start with, and now we see the start of the UK gilt session, of course, and the UK 30-year yield falling below 1.2% for the first time since February the 18th. So it's the first time since February that we're seeing these substantial moves at the 30-year end of the curve, Viraj. Just thinking about what that flattening then means for European stocks. You've been questioning the consensus overweight in European equities. Was that because you kind of saw this coming? You thought that maybe we shouldn't be buying up value stocks, we shouldn't be buying up the reflation stocks to the extent that others in the market thought we should be?
Yeah, very much so. I think it's twofold. I think first, from a positioning perspective, again, things like European banks, materials, resources, energy, they're fairly crowded, and they have been for good reason. Obviously, we've had a rising yields environment. Those sectors do really well during that time, but a pullback was inevitable given the sort of turn in the inflation sentiment and the likely pullback in yields driven by just systematic short covering as well as a turn in fundamentals. So I think this was all expected to some extent. I think the second reason just challenging that overweight is really question marks over, as I mentioned, the cyclicality as well. And I think we're starting to see some of the higher frequency data points that we watch in Europe starting to fizzle out in terms of momentum. And I think that's ominous in terms of just how the next phase of the reopening story is likely to play out. We're probably, the easy part is behind us. And actually, we're probably now, as we're seeing in the UK, but also in other on continental Europe, the slow grind towards normal is likely to continue. And that may be more than just a month story. That's going to be 3 to 6 months, if not longer, before we get back to some levels of normal activity. So I think that's just a reality check on the whole story. A pullback was necessary. Valuations aren't as cheap as they were 3 months ago, and I think that augurs towards a growth versus value tilt for us.
OK, so still a growth versus value tilt for you, Viraj, then over at Vanda Research. Thanks very much. Stay with us. Viraj Patel from Vanda Research with us a little bit longer here on the European Market Open. Coming up then on this programme, we take a look at the events you need to watch out for this week, including a final swan song for the BOE's biggest hawk. We'll talk about the UK market. I just mentioned what's happening with UK 30-year yields. So as gilt yields falling below 1.2% for the first time since February 2018. Things very much on the move as we wait, as we pick up the lead from the Treasury markets on that front. We'll get to that conversation shortly. Also, we'll keep an eye on the supermarkets here in the UK, continuing the UK theme. Morrison's up by 30% this morning on bid activity. That is supporting the rest of the supermarket sector here in the UK as well. Sainsbury's and Tesco's also on the rise to a lesser extent. We'll get the details on that shortly too. This is Bloomberg. Welcome back to the European Market Open. Just coming up to 9 minutes into our European trading session, and this is the picture for stocks this morning. We are weaker. We're down by 0.7% on the Stocks Europe 600. The FTSE under pressure, as you can see, down 0.8% this morning. Let's take a look at some of the sectors or some of the stocks that are on the move in one particular sector, and that is grocery retail. Morrisons, share price of Morrisons up by more than 30%. They've rejected that bid that they received from CD&R, but that got lots of people talking about whether others might come in to bid for this kind of asset. There are real estate assets attached to Morrisons as well, which adds another dimension that not all of the supermarkets have. This is to some extent rubbing off then and lifting others in the sector. Sainsbury's and Tesco are both trading higher, and this is a sort of extra special achievement, I suppose, on a day where we see European stocks very much in the red. More broadly, the FTSE 100 down by 0.8%. Let's take a look at some of the things that we're watching out for then this week. It's going to be a busy week. Bloomberg is live in Qatar, presenting the Qatar Economic Forum, speaking to the WTO Director General, the Barclays CEO, and the Bridgewater founder Ray Dalio. So plenty of big names on the agenda there. On Tuesday, Fed Chair Jay Powell testifies at a House hearing on the Fed's pandemic emergency lending and asset purchase program. How happy is he about the way that the markets have responded to the Fed's statements of last week? If he wants to issue any sort of corrective commentary at all, then we'd look for that this week. On Wednesday, we have PMIs from the US and also from the euro area. And on Thursday, the Bank of England MPC will announce its latest rate decision. Of course, we're saying goodbye to one of its biggest hawks soon. And in the United States, the Fed releases the results of its stress tests on the large US banks. And in Brussels, EU leaders gather for a summit to discuss the pandemic, recovery, migration, relations with Russia and Turkey. So it is a jam-packed week, a packed agenda in terms of things to look ahead to. Viraj Patel from Vanda Research is still with us. Picking up on one of those then, Viraj, we've got an MPC meeting, we've got a meeting of the Monetary Policy Committee at the Bank of England. What are you expecting in relation to the hawkish narrative we've seen of late coming through from the Bank of England? It's been quite driven by the chief economist, who of course is going to be leaving soon. Do you expect others to join his camp?
Probably not. I think some of the hawkish sentiment that we've seen being priced into the UK rates market could potentially get tested, not just from the Bank of England, but also some of the narratives emerging in the UK. Beyond rising COVID cases, I think when we look at some of the high frequency momentum data around reopening, that started to peter out a bit as well, which is slightly worrying. And I think we probably expect the Bank of England to play it slightly more cautious this week relative to what the Fed showed us. And I think when we think about some of the cyclicality that's priced into the pound as well, we think that's probably overshot. So realistically, when we look at 50 basis points of tightening now priced in by the middle of 2023 into the UK rates curve, that to us potentially could get tested this week. And the risks are that you could see a further pullback in the pound, especially against the dollar, especially given that we think long dollar has the potential to be one of this summer's pain trades.
How happy is the Bank of England going to be with what's happening in the gilts curve then, Viraj, when arguably a lot of it is being driven by Treasury markets? We've got the UK 5s to 30s spread narrowing to the least since December. This is clearly picking up on the question of the reflation trades and the flattening of the curve that we're seeing in the United States. Is that something that the Bank of England is going to be okay with or wanting to push back against?
I think they'll want to limit any further curve flattening, and especially from the front end, which is the part of the curve they can control the most. I think the best way to do that is just to avoid markets from prematurely pricing in excessive tightening. And I think we've probably got to that stage where a lot of good news is priced in now, which is a big change from January this year, where we're talking about negative rates, but it's almost as if we flipped to the other side now. So I think playing it cautious, telling markets that a similar message that inflation is transitory. We're not in any rush to tighten rates, and we'll see how the next 3 to 6 months looks. Probably is the best message, especially given that they already made their hawkish pivot back last month in May.
Yes, and considering the fight against the Delta variant, which we're going to get more details on shortly, we're still watching that and how that races against the vaccination rollout. So there's a lot of unknowns in the furlough scheme. How will that come to an end later on this year? So if the Bank of England wants to avoid the appearance or wants to avoid in markets any premature tightening at the short end, that makes me think about what's happening in M&A. And of course, we've seen some big news around M&A, around Morrisons in the supermarket space over the weekend. I don't know if you have thoughts on that sector in particular, Viraj, or more broadly around the M&A story. If we are going to see a higher rate environment to come, is that going to mean a flurry of M&A, rushes to get done before rates pick up, or is it already too late for that?
I think it's natural to start hearing more stories around mergers, especially given the stage of the cycle that we're in. So I think we could expect more stories like this, not just in the UK, but across Europe and also in the US, providing a bit of support for stock markets over summer, especially amid thin narratives. And I think that's probably something to watch out for investors. But as I mentioned, it's natural to see this at this stage of the cycle. A lot of companies will be looking for bargains and opportunities to take this low rates environment as it is, especially before we enter the sort of mid-cycle phase and a period where growth is likely to come harder, and also rates are likely to increase.
Viraj, thank you very much for your thoughts. Viraj Patel, Global Macro Strategist at Vanda Research. Thanks very much for joining us. Coming up on the programme then, warnings of a third wave of coronavirus in the UK and what that could mean for international travel. We'll talk about that next. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the European Market Open. European equity markets under pressure. The Stoxx 600 down by 0.6%, off lows actually perhaps for some of these markets. But the leadership in terms of the downside being handed over from London to elsewhere. Now we see other markets losing more ground than the FTSE 100. Now the rapid development and efficacy of COVID-19 shots from Pfizer and Moderna have created sky-high expectations for the novel messenger RNA technology that they both use. The Pfizer chairman and CEO, Albert Bourla, says the success is due to big R&D and tech pushes that started with his predecessor, and that his company is well positioned to tackle other unmet medical needs once the pandemic is over. He spoke exclusively to Bloomberg's David Weston.
I wouldn't say I knew I can do it, but what I knew is that I have to do it.
because I would realize that the consequences, if we fail, will be dramatic. And although I have high respect for everyone who tried, I knew that very few will have the dedication that we are having. So in a sense, I was feeling that if it is not us, then I'm afraid no one else will find a solution. And that was not an option. So I treat it like if that's it. We do it and we have to do it.
So as I understand it, you had repositioned the company some when you took over as CEO more toward basic science and some of the high-end drugs, high-risk, high-reward drugs. So you may have been better positioned for that. But as you looked at the problem, what alternatives do you have? What tools did you have in your toolkit saying, I have to have a vaccine, how do we go about doing it? Because you ended up with mRNA, but that was not the only alternative.
Yes. First of all, let me say that I did reposition the company when I took over in 2019, but only because of the work of my predecessor. It's not because we have a new sheriff in town. He worked very hard to turn around the R&D. So when I took over, I found an R&D machine that I could believe. And this is why I took all the risk to say that let's find better homes for other businesses and let's focus on the science. Another thing that we did when we said let's focus on science, I knew that in biological science, equal importance with biology has now digital. And that was the time that we brought for the first time a chief digital officer at Pfizer. And we dramatically increased the investments in R&D and in digital. The digital infrastructure that we built in 19 and in the first half of 20 was what helped us dramatically to make this vaccine work. A lot of these things would not be possible unless we have this seamless machine that had digitized our clinical trials.
So, Dr. Bourla, let's talk about the future here. What comes next for the world, for your industry, but for Pfizer in particular? Let's start with Pfizer. Obviously, you've accomplished something that nobody thought you would accomplish. It has really helped save the world. I don't think that's an exaggeration, actually. Where do you go from here? I mean, you're at a pretty high point. What's next for Pfizer?
I think the fundamental question that comes to me after this great success, it is if we were able to do it for COVID, why not for cancer? Why not for Alzheimer's? Why not for many other diseases that they require treatments? That's in general for the industry. And ourselves, we are focused on 6 therapeutic areas that they are covering a broad spectrum of medical needs, most of them unmet right now. So I think there is some lessons learned, and thinking out of the box and re-engineering your processes and investing in R&D, creating a culture that can do the impossible possible, and investing in digital is key for the success in bringing new breakthrough innovations to the world. So this is what I think you will see from Pfizer in the next few years, more breakthroughs that change patients' lives.
Where are we going because of the pandemic? In this sense, will we be able to travel the way we used to? Will the cities come back with the vaccinations? Will it actually get us back to something like what was normal? Or will we really perpetually be living in a somewhat different world going forward?
I believe in terms of controlling COVID, I think we will be able to control it to a level that we could have, if we wanted, our whole life back. But I think there were some lessons learned. Lessons that, for example, we can work remotely as good as by coming to the office every day. I don't think this will go away. Lessons that maybe you can do Zoom instead of travel for a business trip that will take you 2 days just to go and come. That I don't think we'll see coming away, not because of COVID, but because we learned that we can do it differently.
Really interesting conversation there. The thoughts of the chairman and CEO of Pfizer, Albert Bourla, speaking exclusively to Bloomberg. Let's stay with the fight against COVID, because despite the best efforts of Pfizer and others, there's still a battle to fight. The UK government is signalling it will keep restrictions on overseas travel as concerns grow over a third wave of coronavirus. That's despite 60% of adults in the UK now being fully vaccinated. Joining me now is Sam Fazeli from Bloomberg Intelligence. Sam, another week and the battle against the Delta variant of COVID-19 goes on. We've had some warnings over the weekend from Public Health England about new measures that might or might not be needed over the winter. What more are we learning about Delta and the fight against it?
Yeah, good morning, Anna. So nothing really new on Delta specifically. I mean, you know, the variant is showing that it is indeed more transmissible The cases are occurring clearly a lot more in the unvaccinated people. If you look through the Public Health England data and the ZOE database that tracks people, are happening in unvaccinated people versus vaccinated. A big difference there, which is exactly what you want. The problem is that you do also see a breakthrough in vaccinated people because the virus is a little bit better at infecting people despite the vaccine than the alpha variant. So these are things that constantly change and new information comes to hand.
And so I suppose we're still waiting to find out how much an uptick in cases matters, because we're waiting to see how much we have or have not broken the link between infection and hospitalisation and death. And it might be very different at different age groups, given the levels of vaccination are very different at different age groups, Sam.
Absolutely right. That if our entire aim is to reduce death and hospitalizations and reduce the pressure on the NHS, then that link, I'm pretty sure, will have been broken, but clearly for the vaccinated as opposed to the unvaccinated, which if the virus is a little bit more able to increase hospitalization versus the alpha variant, you do have a problem that you're going to start seeing more and more younger people.
And where else should we be keeping an eye on this Delta variant then, Sam? We've talked before about how it's very much less prevalent in some other places, but it is rising quite quickly in some places where we see it. So in the US, in Germany, in Portugal, maybe a focus on further afield as well. Where else are you particularly nervous about? Because this is a real warning, isn't it, the UK story here? Because we have high levels of a speedy vaccination, and yet it is difficult to take on this new variant.
Yeah, so Anna, I think the way to think about that is Israel, at around the 50% full vaccinations, managed to break the back of the alpha variant. Now we have a more transmissible variant that automatically suggests that you should need, or you would need, a higher rate of full vaccinations. 60, 70%, I don't know. Now, no country, apart from some of the smaller countries around the world, are at those sorts of levels. And then, of course, that means that if you're in the United States, Europe, European Union, you need to worry about it, and therefore vaccinate as fast as you can and minimize cases as much as you can so that you could get to that equilibrium.
OK, Sam, thanks very much. Sam Fazeli from Bloomberg Intelligence. I was interested in some research by Bloomberg Economics over the weekend, seeing the risks to the outlook from the Delta variant and running some numbers, essentially, on what that would mean if it picked up elsewhere. Coming up, we'll be back to the oil story and some geopolitics as well. Round 6, but still no agreement in sight for the Iranian nuclear deal. This as Iran elects its hardline cleric Ibrahim Raisi as president. More on that next. This is Bloomberg.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalisation strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into the first trading session of the week here for European equities, and we are down by 0.6% as we continue to question reflation trades, it seems. And if we look at what's going on from a sector perspective, it gives us some really interesting insight. There is one sector that stands out to the upside: personal consumer, discretionary and grocery stores. And it is the GS, it's the grocery stores that are really lifting things, although this does go wider, and we have, to some extent, gains for many names in that sector. But it's the grocery stores doing well, with Morrisons trading higher by more than 30%, up by 32% right now. That's part of the reason we're seeing such a strong performance for that sector. Down at the bottom, basic resources, no surprise there that we see that sector under pressure, with iron ore down by more than 4% in the Asia session. The banking stocks, as we flagged before the start of trade, not liking, of course, the flattening of that yield curve. Travel and leisure, interesting to see that sector is moving to the downside. We have the likes of EasyJet and Ryanair and IAG. So all of those down by more than 2.5% in session. A real focus on the woes, the travails of the travel sector once again. Let's get a Bloomberg First Word News update. Laura Wright is here with that. Good morning, Laura.
Good morning, Anna. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's National Rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. Some of Japan's biggest private employers will offer on-site vaccinations for staff from today in an effort to boost the country's slow vaccine rollout. Elsewhere, Russia, Germany and Portugal reported more cases of the Delta variant. Canada, meanwhile, said its border with the US probably won't reopen until 75% of its population is vaccinated. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness almost £15 billion of annual R&D spend to find solutions for the public good. The new Office for Science and Technology Strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thanks very much. Laura Wright here in London. Now, the sixth round of talks in Vienna between Iran and world powers did not produce an agreement yesterday, and the election of the ultra-conservative cleric Ibrahim Raisi as the country's next president could pose a new test. Let's talk now to Simone Foxman, who's been following this story for us. And Simone, what impact then are we already seeing, or do we expect to see, from the hardline of the new hardline president elected in Iran? This is all to do with trying to return us to the 2015 nuclear deal with Iran, but it's proving difficult. And is it complicated, I suppose, by the election of a new president in Iran?
Yeah, well, certainly this does add a new flavor of concerns, particularly to things that the United States wants. The what's called longer and stronger deal that the likes of Antony Blinken have talked about, essentially going beyond that original nuclear deal struck in 2015 with something more between the United States and Iran. That's something the new president who will take office in August is likely not to be as receptive to as the more moderate Rouhani, who wasn't, frankly, very receptive to that necessarily at all. But, you know, when we look at the markets, when we look at oil prices today, we initially saw these climb as sort of analysts added to doubt about the timing with which Iranian crude could return to the market. But we've seen oil prices sort of retrace themselves, and maybe that's a reflection of the overall idea that not only was Raisi expected to win this race, but also that the return to that JCPOA agreement is still what experts on this expect, more likely than not.
So what is it that's standing in the way of that return to the JCPOA then, Simone? What are the sticking points that are currently keeping these, well, the US and Iran on different pages?
Yeah, you know, Anna, it's funny, but this, I mean, maybe not funny, maybe sad perhaps, but the sticking points are sort of the fundamental problems. Iran specifically wants the United States to commit that it's not going to, in the next election, a new Republican perhaps coming into office, suddenly turn around and go back on this deal. That's something that is challenging for the United States to do. The United States wants a broader agreement, ultimately wants this 2015 nuclear deal, a return to that, to be the entree for some broader discussion of Iran's support for regional militias, of its human rights violations, and that's not something that Iran's necessarily so willing to give up. What we do understand, though, is that there has been some progress in terms of which sanctions might get repealed if we saw that return to a deal. If you recall, the Trump administration imposed something like 2,500 different new sanctions, not all tied to the nuclear program, some tied to human rights, and it's just been challenging for the U.S. and Iran to sort of pick apart which ones go back and which ones remain.
Simone, thank you very much. Bloomberg's Simone Foxman with the latest on Iran and trying to restore the Iran nuclear deal. Coming up then on this programme, bubble trouble. Some of the world's frothiest housing markets are flashing a warning that looks a little bit alarmingly like 2008. We'll have all the details next. This is Bloomberg. Welcome back to the European Market Open, 8:38 in London, so 40 minutes or so into our trading session. And European equity markets paring losses, and in fact, US futures have really pared back on their losses and are now very much in the green for Nasdaq futures, at least, up by around 0.1%. Dow futures and E-mini futures flat to positive. Now, global real estate prices are flashing the kind of bubble warnings we haven't seen since the run-up to the 2008 financial crisis. That is according to some analysis by our economics team. And joining us with the details, our Chief Asia Economics Correspondent, Enda Curran. Enda, what is raising the alarm then? Where are we seeing these alarm bells sounding?
Well, indeed, Anna, it's like you mentioned, our colleagues at Bloomberg Economics have run the numbers, and they're seeing really this cocktail of factors: low interest rates, you've got trillions of dollars worth of government spending out there, trillions of dollars worth of household savings, a shortage of supply, and then, of course, you have this new work from home phenomenon, all adding up to this big house price spike right around the world's biggest, at least in the rich world. If this analysis is of the OECD countries. And what our colleagues have done is, when you look at some ratios, including real house price growth or house price to income ratios, house price to rent ratios, for example, they're showing a big surge now. As you mentioned, these house prices are back to that kind of warning level where we were back around that 2008 time when we had the global financial crisis, where a big crash in house prices was such a central part of it. So there's certainly warning signs flashing again.
Yeah, it's interesting to think about housing as a global asset because, of course, there are so many local conditions, local supply and demand dynamics, local regulations and tax effects that you need to take into account. I was talking to Simon French at Panmure, who mentioned how, because of the amount of time we're spending at home, and this has been a global phenomenon and not in office spaces, the sort of utility value that everyone attaches to housing has increased. And so he puts some of this down to that. So which are the geographies that we see as most affected?
You're absolutely right, Anna. Every national economy has their own story to tell. When you look at this particular league table that our economists have pulled together, those topping the list include the likes of New Zealand and Canada and Sweden. The US and UK aren't far behind. Of course, a lot of these economies were seeing pretty hefty house price momentum heading into the crisis anyway. And all this crisis has done is accelerate that. But like you mentioned, we now have these kind of idiosyncratic factors around its work from home phenomenon. How long does that last? Does it stick? And I think several developed economies have also seen this shift from cities to regional economies. We ourselves have reported on how regional house price growth has also spiked as people move away from the cities. So there's certainly something to be said for what's going on in terms of the pandemic-specific effect. And of course, all of that stimulus flowing through is still having an impact. We are seeing some policy shift, though. New Zealand, for example, is already trying to get a move on in terms of trying to cool down house prices there. And some other central banks, including Canada, which is on top of this list, near the top of this list, is also talking about a gradual exit from its own emergency crisis settings as well.
So when you start to see these warnings flashing 2008 style, Enda, you ask yourself whether we're going to see any crash. And I suppose that depends on whether any of the conditions supporting the housing market are about to change.
Yeah, exactly. And again, right here, right now, you have to say, look, interest rates are low everywhere. Economies are improving, employment levels are improving, you've got macroprudential measures in place, banks are in better order, or at least lending oversight with all of the regulations since the last crisis is now in place. So, you know, there are conditions there to say this is very different from what went on back in the 2000s. But I suppose the big question becomes what happens when interest rates start to increase. And again, I mentioned earlier, we're seeing this shift now. Canada has signaled a way out of this. South Korea is being forecast by some economists to raise interest rates over the coming year or so. New Zealand could be in that basket. You've had, of course, this shift from the Fed last week. And to be very clear, we're still a long way from what you might call outright, tightening of monetary conditions globally. But it's happening, and we are moving away from these crisis settings. And a big test will become what happens when interest rates start going up everywhere. What kind of pressure will it put on borrowers? And like you mentioned, always local factors. Some markets are very much fixed mortgages, for example. Others are variable. So there's a lot at play. But nonetheless, it's going to be a test. And I don't think anybody can say for sure how this kind of burst of lending and burst of mortgage growth will play out as we do exit these crisis settings over the months and years ahead.
Thanks very much, Enda. Good to speak to you. Bloomberg's chief Asia economics correspondent, Enda Curran, with the global housing narrative right now. Sticking with things connected with Hong Kong, just seeing a red headline across the Bloomberg that says that Jimmy Lai's Apple Daily will halt operations after the Hong Kong arrests. Clearly, Jimmy Lai, an entrepreneur, an activist, a key player in the democracy movement in Hong Kong, founder of Next Digital and the Apple Daily newspaper, after he, all of his activity with regards to democracy got him into trouble with Chinese authorities. It seems as if we're seeing reports coming out of Hong Kong with regards to Apple Daily and the fact that it will, according to these reports, be halting its operations in Hong Kong. So interesting to watch as that develops. Let's get a Bloomberg Business Flash. Laura Wright has that.
Thanks, Anna. A blank check fund backed by billionaire Bill Ackman is buying 10% of Universal Music from Vivendi for about $4 billion. Ackman's SPAC Pershing Square Tontine Holdings says the transaction values the home of Taylor Swift and Billie Eilish at $42 billion, including debt. Morrison shares have surged above the value of CD&R's £5.5 billion bid, indicating the private equity firm may have to pay significantly more or fend off rival offers. Under UK takeover rules, CD&R has 28 days to make a firm offer or walk away from its attempt to buy Britain's fourth largest grocer. That's the Bloomberg Business Flash. Anna.
Well, thank you. Laura Wright here in London with your Business Flash. Now, the Biden administration has rejected Venezuelan President Nicolas Maduro's call for relief from US sanctions. Responding to Maduro's comments to Bloomberg TV, a US State Department spokesman said the Venezuelan leader needs to do more towards restoring democracy in the country. Maduro said he wants to work with the Biden administration on lifting sanctions and normalizing ties. He spoke exclusively to Bloomberg's Eric Shaska.
Siempre hay que recordar, Eric.
We always have to remember, Eric, that we faced 4 years of the Trump administration, which were 4 years of direct aggression, of cruel sanctions, very cruel, and of damage to the Venezuelan economy and society. The politics that Donald Trump installed and left as legacy against Venezuela are extremist politics, irrational, right? That caused a complete rupture between the United States and Venezuela.
Presidente Joe Biden ha llegado.
President Joe Biden has arrived, making a proposal to the world. His first speech on January 20th, he said that we don't have to demonize anybody in politics. I would say to President Joe Biden to stop from the White House, from the Department of State, the demonization of Venezuela, the demonization of the Bolivarian Revolution, the demonization of President Nicolas Maduro, and that hopefully we can find paths of reconciliation, of respect, paths of mutual benefit, and paths that allow us to normalize relations between the United States and Venezuela.
¿Ha visto señales ya?
Have you seen any signals
Una postura
that suggest Joe Biden has a different posture, especially as it concerns the Venezuela question?
¿Quieres que te sea sincero, muy sincero?
Do you want me to be sincere?
Ninguna.
Very sincere? There hasn't been a single positive sign. None. It's 5 months where, okay, they're settling into power. The only different thing that might be heard from some spokespeople of the White House and of the Department of State is that they agree with a political dialogue between Venezuelans, without intervention, to look for democratic political changes in the country. That's the only thing. They must abandon the demonization that they make of Venezuela, of our revolution, democratic, constitutional, pacific, and of President Nicolas Maduro, to create real foundations, objective, credible, verifiable, of a process of negotiation to regularize the relations between the two countries, in terms of win-win, which is what we aspire to since a long time ago.
A win-win is possible, in your opinion?
Totalmente.
Absolutely. We've already shown that. Of course it's possible to win-win. They know it in the financial sector, the bondholders, with whom we had an impeccable relationship, and they know it's possible to invest in Venezuela and win-win, as long as this whole persecution and the sanctions aren't there. The oil sector knows it, who has invested in Venezuela, and who still maintains investments in Venezuela, that we can advance much more. The cultural sector knows it. The social sector. The political sectors know it.
That was Venezuela's President Nicolas Maduro speaking exclusively to my colleague Eric Schatzker here at Bloomberg TV. Some lifelines just coming through to us from Hong Kong. The CEO of Hong Kong, Carrie Lam, still giving a news briefing over the last 40 minutes or so. And in it, she's been mentioning various continuation or removal of restrictions. And we've now got some headlines around travel. Hong Kong halves the quarantine for most residents returning from abroad. And Hong Kong also cutting the travel quarantine for vaccinated non-residents. So a few more details coming through on the amount of quarantine required in Hong Kong and how they will make those changes. Also talking about maintaining public gathering limits to 4. Coming up on this programme then, unwinding the reflation trade. We're back to the markets conversation. We discuss the market moves we've seen since the Fed's hawkish pivot. That's next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open at 52 minutes into our European trading day. And what a turnaround after a very negative start. Continued questioning of those reflation trades around banks, around mining stocks. We seem to be taking our lead from US futures a little bit. And US futures paired earlier losses, now turning positive, certainly to a larger degree on NASDAQ futures, which are now up by 0.5%. And so that is helping the European equity markets get off those earlier lows. But what started this, of course, was all in the bond markets and the continued flattening of the US Treasury curve. Let's talk to Ven Ram, Bloomberg's MLive macro strategist, about some of that. Ven, very good morning to you. So the flattening of the curve that we've seen in the US Treasury market, it seems to be spreading into other assets, or at least impacting other assets, and spreading into other gilt curves in the UK or other fixed income curves elsewhere. How far through this are we, do you think, Ven? Is this the start of something, or are we done?
Well, it seems to be changing a bit of change in complexion, if you ask me, Anna. what we saw the flattening, of course, in the curve last week. Now that's morphed into something like a bit more of a wider risk aversion. And that's because stocks have started feeling the jitters. Obviously, U.S. stocks plummeted on Friday. And even so, the U.S. stocks, to me, are looking frothy because they're overvalued by so many measures: market cap to GDP, PE ratios, price to book, price to free cash flow, despite the sell-off. So that may be that signals that there may be more pain for stocks to come, given that the hawkish Fed dot plot implies that stocks will now have to be discounted at a higher rate of interest. That in turn implies a bit for duration in the short run.
Right. And that was all supposed to be negative for tech stocks, wasn't it? So in particular, ones that don't make all that much profit. That was what we saw earlier on this year when we were fearful of higher interest rates in the United States. Investors were getting out of tech stocks because, relatively speaking, they became less attractive. And yet now we see things turning around in the US and the NASDAQ catching a bid. And the NASDAQ and tech stocks seem to have been quite resilient to all of this jitters in fixed income markets. How do we think about that?
Well, I think that they will kind of resist some sell-off because there are some very attractive stocks in there, no question about it. And much of their heightened valuations are linked to their growth prospects. And the U.S. economy is expected to grow a whole lot, more than 6.5% this year. So they may resist the selling impulse, but not for too long, because you can't sustain horrendously high PE ratios for too long. So it's a game of who blinks first, and I think that will happen sooner rather than later.
And in terms of other assets that you keep in focus, obviously the dollar very much at the heart of this, but it was interesting to see the dollar react quite decisively to what the Fed did. It took a few days, but it gained, and it's hung on to those gains.
Well, I mean, absolutely. The dollar hasn't had it this good since the markets tumultuous last year. While the current risk aversion is supporting the dollar today, its longer-term trajectory will depend on the path of real rates, and which is why the dollar rebounded big time last week, because 5-year real rates shot up like a bullet. And if 5-year real rates continue to rise as they did sharply last week, then the dollar will no doubt strengthen. Indeed, it feels like we're in a heads I win, tails you lose kind of scenario for the dollar. If real rates decline and there is risk aversion, the dollar will be big because there is risk aversion. If the risk aversion ebbs out, on the other hand, and real rates climb, the dollar will still be very well placed. So it's definitely a win-win situation for the dollar at the moment.
That's interesting. Even those who, and other voices talk about the sort of more fundamental factors that weigh on the dollar, but maybe they don't get to cut through. Ben, thanks very much. Ben Rahm, Bloomberg's Markets Live macro strategist. Thank you very much for giving us your time today. So European equity markets spent the last hour then clawing their way back to the flat line. We are pretty flat for European stocks right now. US futures point higher. Surveillance early edition is up next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
We have proven now over the course of the past few years that we can reimpose sanctions in a devastating way, and the Iranians understand that.
Even while we're making incredible progress, it remains a serious and deadly threat. And the data is clear.
If we were able to do it for COVID, why not for cancer? Why not for Alzheimer's? Why not for many other diseases?
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Monday, the 21st of June. Happy summer solstice as well. I'm Francine Lacqua in London, and here's what's coming up on today's program. Investors sour on the reflation trade as a 30-year Treasury yield falls below 2%. How much flatter will the curve get? Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee that the U.S. won't quit the accord again. And Germany and the U.S. warn against rising cases of the Delta variant of COVID-19. Joe Biden urges unvaccinated Americans to get a shot. So let's get straight to our top market story. And 30-year Treasury yields have fallen below 2% for the first time since February. Now, that's as traders unwind reflation trades in the wake of the Federal Reserve's hawkish pivot last week. In fact, the St. Louis Fed President James Bullard also added fuel to the debate on Friday, saying that inflation risks may necessitate a hike as soon as next year. I believe he speaks again today with Mr. Kaplan. So let's get the very latest on the markets with our Danny Berger. Danny, so nice to have you back in the office. What are you looking at in the market?
Yeah, I can't tell you how nice it is to be back and not be stuck quarantining in my tiny little flat. Well, what an exciting day to come back, Francine. Basically, as you were saying that we hit below 2%, guess what the 30-year yield does? It goes back up above 2%. So look, in the Asian session, we had some pretty strong buying of the long end of the curve and really throughout the curve, but that curve flattening, taking a bit of a breather. You can see that there are people still going in, buying 5-year yields, buying 10-year, but you have to go, like 6 decimal points back to actually see the move. But that doesn't mean that this trade is necessarily off. There definitely is this debate emerging of whether the Fed has now changed its reaction function. And if it has, if it's going to swat down inflation anytime it gets a whiff of it, why be scared of duration bets? And speaking of duration bets, I just want to show you quickly what's happening in the equity markets, because it went from this yield curve flattening to spilling out into other aspects of the market. So this is the close of the Japanese market. It ended down more than 3%, a very value-heavy index. So it makes sense that the underperformers in this context of long duration being back in vogue, to see Europe down, to see Japan down, both value-heavy indexes, and to see NASDAQ outperforming. Again, this is where you want to be if inflation is going to be controlled in the long term, but S&P 500 futures doing well, okay. So it started as a very risk-off day. Now it's getting a little bit more nuanced, Francine.
Danny, thanks so much. Our Danny Berger there with the great inflation unwind. Well, joining us this morning is Philip Hildebrand. He's vice chair at BlackRock. For many years, of course, he was also central bank governor. So, Philip, you're one of the best when it comes to figuring out what central banks can and can't do in terms of communication, how the market interpret it. So thank you so much on a day like today, especially for being with us. Philip, when you look at some of the things that, we should be looking at, which is the unwinding of the reflation trade, is this just buying time for investors to understand fundamentally what kind of economy we're left with?
Good morning, first of all, Francine. It's great to see you back in the office. I hope I can join you sometime soon. Well, I think you get to the point here. Markets are still trying to get used to, in a sense, and find their way around the new framework that the Federal Reserve has adopted now for some time. And I think that's what's going on here. If you look at the new inflation projections in the framework, basically, they will tell you that they're just about aligned with this idea of overshooting inflation for a couple of years in order to make up of past undershoots. So I think it's taken, unfortunately, some time for the market to really come around and, in a sense, embrace the new framework. And I think we're still testing the waters on that. My guess is this will settle down as we move forward and as the market understands that the Fed has a new framework and that, in fact, the new inflation projections are very much aligned with this notion of overshooting to make up for past undershooting of inflation.
So if you look at this new framework that you eloquently actually lay out, what does it mean for the rest of the world? Does it change the way that we should frame and talk about the ECB and the Bank of England and the Bank of Japan?
Well, as you know, one of the great features of this crisis has been, in a sense, something we've called a policy revolution, which in many ways is a blurring of the boundaries between fiscal and monetary policy. So far, the Fed is the only central bank that has embraced a new framework. We're about to see in a couple of months the new one by the ECB. That'll be very important to see whether another major central bank joins this overshooting idea. My guess is that's what we're going to see. We're going to see a trend towards saying, we have undershot inflation for many years. Now we're accepting some overshooting in order to make up for that over time. And then the question will become how much overshooting and for how long. And this is exactly where markets are, remain quite volatile around this question, as you can see in the last few days. So I think it's a kind of getting into testing the waters into a new framework, which one way or another will be embraced by other central banks as well in the world. But the Fed was definitely first in officially, formally changing its framework last fall.
What does, Philip Hildebrand, a policy mistake from the Fed today actually look like?
Well, a policy mistake, I guess, would be if they don't manage to impose credibility of the framework. And you saw a little bit of a flavor of that. I don't want to read too much into the 24-hour kind of price or news cycle, but you saw a flavor of that. In other words, if they can convince the markets that they're serious about overshooting inflation for some time in order to align themselves with the new framework. And of course, in that context, the fact that inflation expectations have come back again so quickly after the meeting is not great news. But again, I wouldn't read too much into this. We're too focused on the day-by-day news cycle and price action. The key here is the current inflation forecast of the Federal Reserve basically implies is the minimum you would need in order to align yourself with this new principle, the core principle of the new framework, namely that this make-up strategy that you're going to have a couple of years of higher inflation in order to make up for past undershooting.
What does it mean so the markets at some point will settle, I guess, when they figure this out. What's the next catalyst for the markets?
I think just a little bit of time. I'm still struck by lots of discussions and, frankly, diverging views around what the Fed is really trying to do. And this, by the way, I think is also an important lesson for the ECB as they go into the final stage of this deliberation of the new framework, which I suppose will be announced sometime in September, to really be very clear as to what the new framework is. The framework the Fed has adopted is presumably by design fairly loose. We have felt it lacks some guardrails around precisely the timing of how long you intend to overshoot. And I think it's these uncertainties that then give rise to different market views, and that gives rise to price volatility. Again, I think, a couple more press conferences. Speeches are not always helpful because, of course, anybody on the FOMC can speak. And as we saw the other day, that can confuse the message. So I would focus on the official communication and see how they intend to implement, in a sense, live this new framework over time.
Philip, is there anything that you worry about how we view the recovery? I mean, one thing that keeps on striking me almost day in, day out is actually the UK, one of the most vaccinated countries in the world. And then we talk about, the resurgent possible fourth wave of COVID-19. Is this something that actually, it's very difficult to forecast, so it's very difficult for economists to actually put into their forecasts. Is that where we could have a mismatch, or is there something else that you worry about?
I think the most important thing is this is not a recovery, it's a restart. And it's very important to keep that in mind. It's a completely different dynamic than what we would have had after the financial crisis or any other crisis where you have a kind of normal business cycle recovery. This is like a beach resort that opens on day one and the beaches are full. We're going to see huge GDP numbers, and the US demand is going to be enormous. Europe will lag not far behind. So I think we need to expect a lot of volatility around the data points because this is a restart, not a recovery. It's completely different. And we have, because it's so different and so sudden, we have a lot of bottlenecks in the supply chain. So take those two things together, we're going to have a lot of volatility. And I think the key is to look through that. What I'm worried about most, I suppose, is still COVID, right? This is all based on getting out of the pandemic. We have a clear path to get out of it, and that's through vaccination. I worry that 85% of all vaccines that have been administered have been done in the rich world. So that's clearly not only a moral, but also a major economic problem that the world faces. And then we just need to make sure that this vaccination strategy persists and can complete, so we can see continuation of this restart, and then ultimately growth will settle into whatever the new potential will be after the crisis. So I think the key risk factor to watch continues to be vaccinations, the vaccination strategy, the global aspect of that, and the pandemic generally. In other words, how we can ensure that we don't have something that kind of puts us back into COVID mode again.
Philip, thanks so much. Philip Hildebrand there from BlackRock stays with us, and we'll talk a lot more about coming back to work. Because coming up, getting back to the office, BlackRock says staff can start going back into work from next month only if they're vaccinated. So more on the return to work next with Philip Hildebrand. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
As more people get vaccinated, we keep bringing more back. We got a lot of work to get those back. But the view is after Labor Day, our view is all the vaccinated teammates will be back and will be able to operate fairly normally, and we'll then start to make provisions for the other teammates as we move through the fall.
Well, Bank of America is not the only big money manager putting conditions on its staff returning to the office. BlackRock announced on Friday that only fully vaccinated workers would be able to return to work starting in July. Now, all employees will be also expected to report their vaccination status by June the 30th. This comes as the U.S. hits a milestone of delivering 300 million vaccines. Now, even so, it's at risk of missing its vaccine target, getting 70% of all adults receive a single shot by July the 4th. The president urged unvaccinated Americans to get inoculated, warning about the highly transmissible Delta variant.
Even while we're making incredible progress, it remains a serious and deadly threat. And the data is clear. If you are unvaccinated, you're at risk of getting seriously ill or dying or spreading it.
Well, still with us is Philip Hildebrand from BlackRock. Philip Hildebrand, thank you so much for staying with us. I mean, there's quite a lot of debates going on in big corporations on how you get staff back to work, whether you fully open, whether you do distancing, whether it's flexible working. Like, you know, what are some of the discussions that you had to come to the conclusion that BlackRock has?
Well, first of all, I'd say safety, right? This is always the paramount concern. You want to make sure that your employees are safe and feel safe. That's a very important piece of it. It's also true, and I believe this very strongly, that a great company is made up of two things, a great business model and a great culture. And it's very hard to persist on the culture front if you work remotely. We believe strongly that informally interacting, being together as a community is a very big part of the culture. And, you know, we haven't seen our colleagues in a long, long time. I'm looking forward to seeing my colleagues in the executive committee for the first time later this summer. So the cultural piece is extremely important. And we want to make sure that everybody comes back together in a safe environment so that they can feel safe. So vaccination, getting vaccinated is really something you do for yourself, of course, for your family, but you also do it as part of a culture, as part of a company to help protect others, to help others feel safe. And that's very much the way we look at things.
And Philip, how do you see, for example, executive travel or just like business travel? Because I hear both sides of the coin, people saying actually we'll go back to normal or close to normal in the next couple of years. And then people saying, you know, 30% of my meetings I could do virtually, and now it's proven that it doesn't actually impact so much. So how do you see it changing, I guess, and developing as a legacy of COVID-19?
Probably a bit of both. I mean, we are human beings. I've been around long enough to know that humans are what they are. They like to move, they like to go places, and they like to socially interact. And that's a very important part of life, and we should embrace that. So I would certainly expect a lot of it to come back, particularly with regard to clients, new clients. There's nothing that makes up for the interpersonal exchange. On the other hand, will I go to Singapore or Hong Kong for one meeting and get on a plane and come back the next day, as I would have often done in the past? Probably not. So I think a hybrid version, particularly with people that you know well, right? I think that's the key difference. Communities, people, clients that you know very well, where you spend a lot of time in person, it makes perfect sense to continue some of the remote working.
When you look, Philip, at some of the markets that worries you, and we were talking about volatility, do you worry about liquidity in the markets? I hear this kind of on the back burner from a lot of executives, and I wonder whether we're spending, enough time talking about liquidity in the markets.
Well, I can tell you, just looking at our cash business, and I'm sure that's true for any of our competitors as well, it's extraordinary how much cash there is in the system from all sides, right? Retail, corporates, investors. So everybody has an enormous amount of cash, and it's not surprising. We have the highest fiscal stimulus ever in the history of economics, the lowest most expansionary monetary policy ever, and the lowest real interest rate. So yes, there's a lot of liquidity out there. I think the real question will be longer term. Can we kind of do this journey, get on this journey without losing the anchor of long-term inflation expectations? That's really the key piece. And of course, that takes us back to the Federal Reserve discussion or any other central bank discussion. We have to get inflation higher. You can make a good case for making up past undershooting, but the principal aim here has to be this entire exercise 5-6 years from now. We must not lose the anchor of inflation expectations, and that will determine everything else. So I think as long as we can get to that place, I'm not particularly worried about liquidity at the moment, but we should certainly watch it. There will be volatility around it as a result.
You always make us smarter on banks and how we should be thinking, especially about the banking sector in Europe. We know, of course, that the ECB will meet to decide whether they actually lift their cap on dividends next week. Is that important just for investor confidence that that cap is actually lifted now?
I'm not sure, to be honest. The good news is, partly because of what we've done after the financial crisis, banks have gone through this huge problem in the history of economics without any major problems. In fact, when I talk to CEOs right now, I notice that all of them are telling me that they're actually revising downward their provisioning month by month. And so things are turning out even better than they would have expected. And so we're coming out of this pandemic, in a sense, with robust balance sheets. And that's very important also with regard to your previous question on liquidity. We have a strong banking system coming out of one of the worst crises we've gone through. So that's very good news. Whether they lift this cap or not, frankly, the key is the responsibility of the banks themselves to do the right thing, particularly as we enter this environment of a huge restart, which we know won't last forever. This is not a recovery, it's a restart. And so I think much more important than what we do on the formal regulatory side is how banks behave themselves in terms of going through these next couple of months.
Philip, thank you so much for joining us. Philip Hildebrand there, the Vice Chair at BlackRock. Now we'll have plenty more, of course, on the markets throughout the day. Also coming up, talks to revive the Iranian nuclear deal drag on as Iran elects hardline cleric Ibrahim Raisi as president. And then a little bit later, we'll also talk about Bitcoin declining amid a significant fall in the hash rate. Now, what's the hash rate, you ask? All of that and much more later with our Eddie van der Walt. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Emmanuel Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. Now, the US has rejected Venezuela's call for relief from sanctions, saying more needs to be done towards restoring democracy. President Nicolas Maduro reached out on the issue in an exclusive interview with Bloomberg.
I would say to President Joe Biden to stop from the White House, from the Department of State, the demonization of Venezuela, the demonization of the Bolivarian Revolution, the demonization of President Nicolas Maduro, and that hopefully we can find paths of reconciliation, of respect, paths of mutual benefit, and paths that allow us to normalize relations between the United States and Venezuela.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
curtain will rise again.
Broadway's returning. June.
Have you bought tickets?
Is busted out.
You've got more time here. If you want.
Commodities are up.
Keep going.
To the moon.
No. Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Investors sour on the reflation trade as a 30-year Treasury yield falls below 2%. How much flatter will the curve get? Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee that the U.S. won't quit the accord again. And Germany and the U.S. warn against rising cases of the Delta variant of COVID-19. Joe Biden urges unvaccinated Americans to get a shot. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Monday, the 21st of June. So talks to revive the Iranian nuclear accord have ended without agreement. Diplomats adjourned a 6th round of meetings with major gaps remaining on the accord. Now, this comes one day after the hardline cleric Ebrahim Raisi was declared the winner of Iran's presidential election. Raisi's win could further complicate diplomatic efforts. Now, the U.S. National Security Advisor Jake Sullivan told Fox News that preventing Iran from obtaining nuclear weapons remains a priority.
Well, I think what we need to do in the United States is keep our eye on the ball. And that is our paramount priority right now, is to prevent Iran from getting a nuclear weapon. We believe that diplomacy is the best way to achieve that rather than military conflict. And so we're going to negotiate in a clear-eyed, firm way with the Iranians to see if we can arrive at an outcome that puts their nuclear program in a box.
Well, joining us now is our Iran reporter, Golnar Montavali, who I'm delighted is here in the studio with me. So, Golnar, thank you so much for joining us. I know you've been covering this right from the start. You've covered Iran also for decades. So what do we know about this new hardline president and actually what it means for the prospects of this nuclear deal?
Well, he's the head of the judiciary. He's an ultra-conservative. He comes from a very religious background. He's a hardliner. He is naturally very suspicious of engagement with the West, particularly the US. He is part of the hardline camp of Iranian politicians who are always very highly critical of America and don't want to see, frankly, softer relations between Iran and the US. So there's a huge question mark right now about what that means for Iran's broader foreign policy. But immediately, when it comes to the nuclear deal and the nuclear talks, there's a sense, I think, that they're going to be ring-fenced because the policy to continue those talks and to get the deal revived, particularly before June 24th. That's an important date, Francine, because that's when Iran's technical agreement with the UN nuclear inspectors expires, and there's talk of that being renewed so that there's more time for diplomats to get this deal back and running. But that policy to revive the nuclear deal, that's with Ayatollah Khamenei, the supreme leader, and the Supreme National Security Council in Tehran. And there are already signs from Raisi that he wants to preserve the accord. He said so during his campaign. He had a meeting with Foreign Minister Zarif today in Tehran. And there are all sorts of signs coming from Tehran that there is no intention there to kind of throw any spanners in the works in terms of Raisi's arrival in government as president.
So, Golnar, I was reading up, and actually in 2019, the Trump administration also put sanctions on him personally.
Yeah.
So do those need to be removed for anything to happen?
Indeed, Francine. There's another question mark over that. So, as you said, in 2019, as part of the maximum pressure strategy, the Trump administration included Raisi, explicitly naming him in new OFAC designations. Those are sanctions effectively on Raisi. And Iran has said that the entire onset of new sanctions under the Trump administration, those need to go for the nuclear accord to be revived. So they want all the sanctions associated with Donald Trump, not just those that came as a result of the US quitting the JCPOA, but all of the sanctions that came afterwards as well need to go. And that includes designations on the new president-elect of Iran, Ebrahim Raisi. And I don't think that, there is a question mark now over whether the US will reconsider removing those sanctions or not, but we have to wait and see.
Does there need to be an intermediary between the U.S. and Iran? Is there anyone that actually President, Raisi is close to that could play that role?
That's another interesting question. We don't know what Raisi's foreign policy team is going to look like. I mean, the likelihood is that obviously they're going to be hardliners. They are probably not going to be people like Zarif, Mohammad Javad Zarif, who very famously has very eloquent English, who likes to use these kind of flawless sort of idioms and flourishes of diplomatic language. That's unusual in Iran. That is unusual for the Islamic Republic. And we may see a team that looks more similar to what we had under Mahmoud Ahmadinejad, who was the previous hardline president before Rouhani. We may see elements of his team return. We know that Saeed Jalili, the former nuclear negotiator under Ahmadinejad, who was also running in the presidential race and withdrew to throw his weight behind Raisi, will probably be rewarded with some kind of senior role, whether that's first vice president, we don't know. But there are big question marks over this. And I think that's why the nuclear deal issue is going to be ring-fenced for that reason, because Rouhani's team, if you remember, came at the same time as Barack Obama's team did in Washington. There was this kind of alignment of different factors in 2013 that allowed the kind of ecosystem to kind of build around the nuclear deal in the first place, which was then agreed in 2015. We don't have that this time. So I think Khamenei knows that he needs to ring-fence the talks and all the action around the nuclear deal in general.
Golnar, thank you so much. I could talk to Golnar for another 2 hours, so we'll get you back on. Golnar Montevalli, there, our Iran reporter. Now, smaller companies in Britain's FTSE All-Share Index are lagging behind their larger peers when it comes to having diverse representation on their boards. That's according to a report by Women on Boards UK. And my next guest says that previous reports looking at FTSE 350 firms only paint an incomplete picture and mask the true picture of little diversity progress. Well, joining us now is Fiona Haythorne, Chief Executive Officer at Women on Boards. Fiona, thank you so much for joining us on this very important topic. So what have you found, and how do you explain this little representation?
Well, firstly, we found that only half are meeting the 33% target of women on boards. And more worrying, 54%, that's more than half, have all male executive teams or all male leaders at the top. And we find that completely unacceptable. And you will remember that the Hampton-Alexander, our government, has had a lens on the FTSE 350 and argues that it's almost job done. We've made a lot of progress, and we have. But at the FTSE 350 level, only 6% are all male leadership teams. So compare that with the FTSE All-Share, those smaller companies outside the FTSE 350, and there's a lot of work still needed to be done. We also looked at the gender pay gap reporting for the first time ever for all of those companies, and that was a bit of a shocker too.
So, Fiona, does the pandemic actually, has it made things worse?
Well, the pandemic has clearly been very difficult for women in general because of the caring responsibilities that society seems to put on their shoulders. But I think longer term, the pandemic has showed us that flexible working does work for all, men as well as women. I think what we've got to be very careful as companies move forward in this new hybrid world in the way we're working is that women in particular do still go back to the office from time to time and do actively manage their careers. I don't mean being present all the time, but being very, very clear what you contribute, because those networks and relationships matter. So I think we've got to be very careful going forward. And what we do know, looking at the FTSE All-Share, is the gender pay gap is around 20% for all of those 600 companies against the average of around 14%. But worse, the bonus gap is 40% against the average of 20%. So what we really need is the government to still put a lens on all of those companies, because what gets measured gets managed, and what gets managed gets done. And I will talk to you shortly about leadership training and treating it like a change program. Yeah. Stop fixing the minority.
But Fiona, does it have to go through compensation, incentives, quotas, or what is the right approach?
Well, I mean, we've had a comply and explain approach, and we've put a target of 33%. But that's fine. But targets only work if you measure, manage, and monitor. And what this research has shown is outside the FTSE 350, nobody's measuring, nobody's monitoring. And I think we need to keep that lens on. Now, as we can see in France and Germany at the moment, they're looking at quotas for the executive teams to come in. I hope we don't need to do that. I'm sure we don't need to do that, but we do need the government to continue putting a lens, not just on the FTSE 350, but all of these companies, because somebody's got to measure and monitor, otherwise nothing happens. 54% of those companies outside the FTSE 350 that haven't been measured, haven't been monitored, still have all male executive teams. So a lot needs to be done in terms of leadership and conscious inclusion. I don't mean unconscious bias training, in how we make sure that our economy remains strong and innovative, and uses all the talent in the UK. And we know from all the research from McKinsey and everyone else that diverse teams perform better, but only if you can manage them effectively.
So, Fiona, where exactly is the sticking point? Is it at recruitment level? Is it that you don't find, the kind of the right people in the C-suite to then be promoted?
I think, it's systemic within our society. Our society has a view of what women can and can't do, and that needs to be tackled. And that's throughout our education system. And we know from between the ages of 4 and 6, young girls in particular have a different perception of what they can and can't do. And that's still the case today. So we can't blame the companies for everything. But what we can ask companies to do is to set targets so they actively manage what's happening in departments and divisions, to make sure that if you recruit the best graduates, then they have an equal chance of being promoted, and you can measure and monitor that. So that's where a lot of the progress has to be done. You need to understand what's our intake, how are we keeping them, and what the issues are, and the issues that individuals face, whether it's somebody who's disabled, whether it's somebody who's black or an ethnic minority. And that's the other thing that we also looked at in the, I must mention this, in the FTSE All-Share outside the top 350, we found that only 3% of board directors were directors of colour. And Fiona, only 16% have met the Parker Review target. Not good enough.
Fiona, thank you so much. Fiona Hathorn, absolutely not good enough, chief executive there of Women on Boards. Now, London turns its Olympic Stadium into a pop-up vaccination centre. Britain's government pushes for its entire adult population to be vaccinated, but cases of the Delta variant are still surging. How concerned should other countries be about the UK's spike in infections? We'll discuss that with Sam Fazeli up next. This is Bloomberg.
valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Biden administration has rejected a call from Nicolas Maduro for relief from U.S. sanctions. Responding to Maduro's comments to Bloomberg TV, a State Department spokesman said the Venezuelan leader needs to do more towards restoring democracy and engage with the opposition. The U.S. doesn't accept Maduro as Venezuela's legitimate president and instead recognizes Juan Guaido, the leader of the National Assembly, as the interim president. While Maduro said the sanctions are cruel and immoral, he spoke exclusively to Bloomberg's Eric Schatzker.
I believe that the sanctions are immoral. That's the first thing. They are cruel, very cruel for a country. And I think that at a round table of conversation, even if it's private, the United States of America, the Biden administration, should accept it as such, should see it as such. And the sanctions are transformed. As the Human Rights Organization says, the special reporter that came to Venezuela for the matter of the sanctions are transformed into a great violation of the human rights of the Venezuelan men and women. Furthermore, not only is it a cruel mechanism that causes suffering to the people, but it's also a failed mechanism. Failed. Because all the sanctions, in an extremist and irrational manner, were applied by the Trump government against Venezuela for a change of regime. And they didn't achieve it. Nor are they going to achieve it. So the sanctions should be recognized as illegal, irrational, extremist, cruel, and they should be lifted.
En su opinión, señor presidente, pero todavía es la política.
In your opinion, Mr. President, but it's still U.S. policy. And it seems to me the U.S. won't change its policy without a change in positions.
Entonces es un juego cerrado, Eric.
Then it's a closed game, Eric, because we have our principles, our Constitution. We have the right to life, to economic freedom, to commercial freedom. Venezuela and the whole world has the right to commercial freedom. There can't be one country that, because of the control of the currency and of the banking system, imposes to the rest of the countries of the world what should happen in their country at a political level, who should govern or who shouldn't govern. If that was established, Eric, it would simply be the end of the United Nations system, the end of the international law.
Venezuelan President Nicolas Maduro there speaking to Bloomberg's Eric Schatzker. Eric also spoke with Maduro's opposition, Juan Guaido, who is recognized as the interim president of Venezuela after an election that the U.S. and many others said was rigged. Guaido said the pressure of sanctions has increased the possibility of a deal with Maduro.
Maduro siempre quiere negociar. As I said in the beginning, Maduro always wants to negotiate for the same reason. To ease the pressure, earn time, and try to confuse the democratic alternative. You talk about different groups. Today, the advantage is that together we have set the possibility of an agreement that will be negotiated, facilitated dialogue, the support of the international community.
So we'll have plenty more, of course, on Venezuela throughout the day. Now, a major push to offer COVID-19 jabs to every adult in England is underway, with queues forming outside pop-up vaccination centres, including at West Ham's London Stadium, where the 2012 Olympic Games took place. But the Delta variant of the virus has made infections spike in the UK once more, and this has prevented the government going ahead with its planned relaxation of overseas travel restrictions. Well, joining us now is Sam Fazeli. He's the Director of Research at Bloomberg Intelligence. Sam, first of all, there's quite a lot going on in the UK. It's one of the most vaccinated countries in the world, and yet there are 10,000 or more cases a day. What exactly, do you see in the UK that could have done better, or does it just show the limits of vaccinations?
Francine, no, I think the UK has done a pretty good job. We still have to wonder whether that one-dose strategy for 10 days was absolutely the right way to go, but it certainly helped bring down the mortality rate. But I can tell you that when you look at my favorite data source, which is the Zoe COVID-19 symptom study, you've got about a six-fold increase in the positivity rate of people who've not been vaccinated in the past 4 weeks, compared to just a twofold increase in those who are fully vaccinated. So, and the difference between them is like tenfold. You have a very small 0.25% positivity rate in fully vaccinated people versus 2% positivity rate. Clearly, the vaccines are working. And therefore, what we saw yesterday with a massive push is absolutely the right thing to do.
Sam, so we see quite a lot of travel companies actually trying to put a lot of pressure on the government here to ease restrictions. Like, what do we know about that? Do you write off summer holidays for the Brits abroad?
Well, not if you're very happy to go to Cornwall and Devon and the Lake District and Scotland and Wales. But in terms of international travel, it's complicated by several issues. The UK can do what it wants. But if you've got people like countries like Italy that then introduce a 5-day quarantine, I'm not sure anybody would want to go there. And I would not be surprised if other countries, given that they're bringing their cases down so well, Germany and France particularly, would welcome people from an area where there is a rampant infection with the Delta variant with open arms. What happens with double vaccinated, fully vaccinated people is an interesting question. I'd love to hear the answer to that from the government.
Sam, thank you so much. Sam Fazeli there, Director of Research at Bloomberg Intelligence. Now, coming up, cryptos sink as China cracks down on Bitcoin miners. Up next, we'll drill down on this morning's market action. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, cryptocurrencies are taking another hit as China cracks down on Bitcoin miners. For the latest on what's moving the markets today, we're joined by Bloomberg MLive's Eddie van der Velde. Eddie and I also, off the record, are talking about him possibly getting a puppy, but away from puppies, actually Bim Boom market. Eddie, what are you looking at? It's the reflation trade not quite working out anymore.
Yeah, it's very difficult for cryptocurrencies at the moment. The China narrative is part of the story. And, you know, the relationship between Bitcoin and the miners are a complex one. If you see fewer miners, that doesn't mean that you see fewer Bitcoin being created. It just means that the difficulty of creating new coins comes down. So it's really complex. It's not like looking at a traditional mining model from that perspective. Mm-hmm. But at the same time, I think what we're seeing here is we're just seeing, you know, the pressure from regulation and from policymakers in general on cryptocurrencies just starting to bear out. Now, in the long term, I think greater regulations are positive for cryptocurrencies because we need to get them into, you know, the broader financial fold to get mass adoption. But for the time being, if you see China putting pressure and you see Basel putting pressure, then you're going to see crypto prices going lower.
Yeah, so what exactly is the hash rate?
So the hash rate is the difficulty or the amount of the amount of computing power that is dedicated to creating new Bitcoin. But if you will remember that Satoshi Nakamoto in the original white paper said there will only ever be 21 million Bitcoin, and the rate of production remains pretty much stable. So as you put more computers on solving these problems, what happens is the problem becomes more difficult or easier. So the rate of production of cryptocurrencies, of Bitcoin in particular, stays relatively stable as the amount of miners change.
Eddie, thank you so much. Bloomberg MLive's Eddie van der Velde there. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin, Kay Lines out of New York. We'll have a full roundup, of course, of the markets. We'll talk Iran. We'll talk cryptocurrency some more. We have you covered. This is Bloomberg.
Announcing a project and doing a project is something different. And that's why we are so proud. We have started now the first one here. It's running, and I believe that we will see scalability. Have now a base to show use cases, so we can develop new cases. on how to build a hydrogen economy.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The bond market has its own brain. It's a very shrewd operator.
Overheating has been a major concern of mine. I'm glad to see that they have that recognition.
Are we at peak growth right now? Yes, probably.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, it's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, June the 21st. Our top stories today. Investors sour on the reflation trade as the 30-year Treasury yield falls below 2%. How much flatter will the curve get? Nuclear talks hit a roadblock as Iran elects a new hardline president. Tehran wants a guarantee that the U.S. won't quit the accord again. And crypto crackdown, Bitcoin sliding amid a risk-off mood in markets and a clampdown in China. So definitely quite a lot going on in the markets. Kaylee, we heard from James Bullard. I think he's speaking today again with Robert Kaplan, and that will give us an indication of what markets do next.
Yeah, market's really paying attention to the Fed, Francine, and any indication that maybe they're not going to let inflation and the economy run quite as hot as we maybe previously thought. Just a recap of what we saw in the Asian session overnight, it was broadly negative. Most of the major benchmarks lower, including the Hang Seng, which was down about 1%. And your real underperformance came from the Nikkei in Japan, which fell 3.3%. Japanese equities, of course, quite cyclical. They may have been weighed down on quite a bit by the fact that we saw that reflation unwind happening here in the U.S. on Friday, and that followed through in the Asian session. Also, I would note in foreign exchange that Japanese yen is stronger against the dollar by about 0.25%. And then Bitcoin makes it on my Asia board today because, of course, the fear around the crackdown on mining in China is really weighing on the cryptocurrency. That hash rate is moving lower, and as a result, Bitcoin also moving lower. Right now, it's just shy of the $33,000 level. As for what the picture looks like here in the U.S., the older the future session grows, the more positive it becomes. Right now, S&P 500 futures up about 15 points. It is NASDAQ 100 futures, though, that are outperforming, so it does look like big tech may still be leading on the day. In the bond market, the 30-year Treasury yield fell below 2% earlier in the session. We are right now essentially unchanged at 2.02% or so. And actually, after 3 days of flattening, the curve is steepening back just a touch. The 530 spread now sitting right around 115 basis points, and keeping an eye on oil as well. That Iran nuclear deal still out of reach after the 6th round of talks in Vienna. Right now, WTI is trading just below $72 a barrel, Matt.
All right, we will be watching, Kaylee, oil very closely. Obviously, the situation in Iran is prompting many to question whether we go from a supply, too much supply, to a supply shortage. And this is going to definitely put an exclamation point after that question mark. Let's take a look at what's going on here in Europe. It is hot. Maybe that's a reason that you see red on the screen in a few places. Spain right now, France and the UK, little changed. It's a good day to work at home if you have AC, or come to the office if your office has AC, which is a huge if. in Europe. I also want to point out that the DAX is a big gainer. We have almost 2 winners for every loser here in Germany, so it's doing much better than the rest of the continent. The euro getting a little bit of a bounce, but it had come down substantially. So the ECB is doing its job well versus the Fed, but right now we see a little bit of a bounce in the currency, a little bit of a bounce in the pound as well as the dollar comes down. And then, you know, last week, Francine, someone on Twitter, a viewer on Twitter, was very angry, had enough of me making fun of the British and their obsession with supermarkets. Now, I pointed out, I do it in jest. I love the British. I lived in Britain and enjoyed my years there, and I love those supermarkets as well. William Morrison is up 32%. It could get taken over, but it's not the only supermarket gainer. You see big gains in Sainsbury's, Tesco's, and Waitrose as well. So watch. Oh, I forgot to mention Marks and Spencer's. Watch those British supermarkets today.
Yeah, I don't see you shopping at M&S. Maybe Morrison's. I think you're more of a Savile Row kind of shopper, Matt. Correct me if I'm wrong. But I know
as I have previously mentioned, M&S is a good place to buy underwear. If you're just looking for your typical tighty-whities, your Y-fronts as you call them, M&S is a good place to get those.
The Myth of Fashion with Matt Miller. This should be like a regular segment at, 5 a.m. Just so that if you're coming to the UK, if the rules change on how you travel, you know where to get your bits and pieces. Now, this is a look at what else is ahead this week. Of course, the Qatar Economic Forum kicks off today. That's at 8 p.m. Eastern Time. The first day speakers include Ray Dalio, Larry Summers, and the South African President, Cyril Ramaphosa. Tomorrow, New York City goes to the polls for the hotly contested mayoral election. We'll have special coverage across Bloomberg throughout the day. Also tomorrow, U.S. Secretary of State Antony Blinken kicks off a trip to Europe. He'll start in Berlin by meeting Chancellor Angela Merkel. And then on Thursday, it's the key central bank event of the week. Of course, the Bank of England announces their latest policy decision. We look at the Bank of England on how they also see a possible fourth wave of COVID-19. In other news, another round of Iran nuclear talks have ended without agreement. This comes one day after hardline cleric Ibrahim Raisi was declared the winner of Iran's presidential election. Well, joining us now is Golnar Montevalli, Bloomberg's Iran reporter. Golnar, so what does this mean for the nuclear accord? And first of all, does the U.S. need to get rid of the sanctions against the president-elect for anything to happen?
Hi, Francine. Yeah, so with Ibrahim Raisi becoming president-elect, obviously there's a big question mark now over whether that's going to have any effect on the talks that are happening in Vienna over reviving the deal. The signs and the signals we have from Tehran so far are that he wants to preserve the accord. He said that during his election campaign, and there is a definite sense that the nuclear deal and foreign policy is being ring-fenced for now because Supreme Leader Ayatollah Ali Khamenei, who ultimately makes those decisions, has so far backed the talks to revive the deal, and there's no sense that there's going to be any major spanner in the works. But there's obviously a big question mark over these sanctions that you just mentioned. Raisi was directly sanctioned by the Trump administration in 2019. He's designated under those OFAC sanctions designations, and whether those are going to be lifted now, that question mark is going to be revived. I think there was a sense before his election that they were definitely going to be lifted by the Americans as part of that agreement to revive the deal. And now we're seeing kind of louder noises around his background, particularly on human rights. And that may raise some kind of flag and some question mark over whether the Americans will be willing to lift those sanctions.
What does this mean for oil exports? I know they've been able to get some out to China and some other countries, but how many barrels a day are they exporting, and how many barrels a day could they be exporting were we to make a deal?
Well, they obviously want to get back to pre-sanctions export levels. So we're looking about 2 million barrels a day. It's going to take time, obviously, for that to happen. They are pumping oil. They're still producing quite a significant amount of oil, again, though not in the levels that they were before sanctions. So that's another obvious big question mark. Because we don't know when this deal is going to be revived yet. Everyone is looking at kind of two different deadlines now. We're looking at June 24th when this technical agreement that Iran has with the IAEA, the UN nuclear inspectors, expires. And then we have mid-August, which is when Hassan Rouhani, the moderate president who championed the nuclear deal, leaves office and Raisi takes over. But if we do get a deal before mid-August, if the deal is revived again, then Iran expects to be able to get back up to pre-sanctions levels of oil output within 3 months. So we're looking at an aim, I think, probably towards the end of the year, at the end of the last quarter, of 2 million barrels a day, if the nuclear deal is indeed revived.
Right, a big if there. Bloomberg's Golnar Matavali, thank you so much. Turning back to the markets now, and investors are shrugging off last week's bearishness after the Fed's surprise hawkish turn, with U.S. futures climbing and longer end treasury yields turning higher. Here's Bloomberg's Danny Berger for more. And Danny, the curve steepening once again.
Yeah, it really is. Finally, a little bit of calm in the market. How long will it last? That's certainly a big question on everyone's mind. But coming into this week, this is the picture we had faced. We had seen the most severe flattening of the curve since 2011 last week. And as the Asia session unfolded, when I came in here at 3:30 a.m. London time, it's definitely within the meat of the day of the Asian trading session. Let me show you how the U.S. 30-year yield looked, because we continued to see investors flocking into it. You have this big dip, but as the European session opened up, as we moved away from that Asia heavy session, you did get some of this yield coming back up, and indeed yields moving higher now. And across the board, that's really what we're seeing. Some of the risk aversion taking its foot off the gas pedal. So if I can show you what a couple of different assets are doing, we are definitely still seeing some buying, for example, in the 10-year yield, but you are seeing stocks that are more cyclical in nature underperform. That doesn't mean that they're necessarily totally negative, but it still is a little bit of that flavor where things like the Stock 600 here in Europe are underperforming something like the NASDAQ 100. So still you get this sense that the reflationary trade is still not in vogue. However, we're not seeing as severe of a sell-off in a lot of these type of assets as we did at the end of last week.
All right, Danny, thanks very much. Danny Berger talking to us about the reflation, deflation. We'll check in just a moment with an investor whether or not that is going to pause now. Over in Hong Kong, though, Bloomberg has learned that Jimmy Lai's Apple Daily will suspend operations if its Hong Kong accounts stay frozen. It doesn't have access to that money, and therefore it can't afford to continue operations. Bloomberg's Ian Marlowe joins us from Hong Kong to talk about this continued crackdown on democracy. And I guess, Ian, this is what this is, right? Because we're talking about a pro-democracy media organization.
Yeah, Apple Daily, the sort of the most popular pro-democracy opposition newspaper in the city, has been under mounting political pressure for months now. I mean, they've been raided by police before. Their owner, Jimmy Lai, is currently in jail on charges for attending an unauthorized protest. And late last week, 500 police officers marched into the headquarters of the Apple Daily newspaper, and 3 of their top editors and their chief executive and publisher were arrested under the national security law, which China obviously imposed on the city last year. So at the moment, there's a lot of questions because this is the first time authorities here have used the national security law to arrest journalists. They previously said this law was only for a small minority of criminals. They'd be going after people who had violated the law. They were saying it was about riots and maintaining peace and stability in Hong Kong. And now we have essentially one of the largest opposition newspapers in the city being shut down because its owners can't access more than 500 million Hong Kong, roughly about nearly 70 million US, in funds that they have in the bank. So at the moment, they don't know how to pay staff. Suppliers and others can't transact with them. They can't put any money in their accounts. So at the moment, they're kind of being forced by the government into effective bankruptcy here.
All right, it's a story we will continue to watch. Thank you so much to Bloomberg's Ian Marlowe in Hong Kong. I do want to take a quick check now on some stocks moving in pre-market trading here in the U.S., beginning with some M&A action on this Monday. Raven Industries, which is an industrial agriculture products maker, is higher by 47% or so in early hours after CNH Industrial agreed to buy the company for $58 a share, around a 50% premium to Friday's closing price. Another stock surging in early hours is Torchlight Energy. This is one of the meme stocks that is front and center now. It once again was touted on Wall Street Bet assets as a potential short squeeze, and as a result, traders bidding up those shares, they're higher by about 42%. As I was mentioning, though, Bitcoin is under some pressure today because of fears around a mining crackdown in China, and as a result, some cryptocurrency-tied stocks are also under pressure in early hours. MicroStrategy, one of them, lower by about 6% before the bell, Francine.
Yes, so much going on that actually warrants a little bit of our attention. Now, coming up next, we'll look, of course, at the reflation trade. We'll get yields with Patrick Armstrong, Plurimi Wealth Chief Investment Officer. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman, London. Matt Miller in New York. Now, joining us to talk about the souring of the reflation trade is Patrick Armstrong. He's Chief Investment Officer at Plurimi. And Patrick, when you look at some of the metrics, it's very clear that the Fed pivot means that the markets are a little bit unsure about how to price things in. When will investors actually get a better handle on the fundamentals and what the economy does?
Yeah, I don't think they're trading off the economy so much. It's trading off that the Fed in 2 years is going to hike rates a couple of times. Half of them expect, and the other half aren't really pricing that in yet. So I think the market's really gone from reflation, the Fed's going to look through everything as transitory, to essentially being asleep at the wheel for the next 3 years, to where they've woken up where a lot of the Fed is going to pay attention and maybe the inflation isn't necessarily transitory. I don't know if the market reaction makes sense to me. I suspect the Fed would not have anticipated this, and therefore a significant chance they sort of changed the narrative this week, where they really, Powell may want to say, he always says don't look at the dots, but I think he may stress don't look at the dots, listen to what we say. Bullard came out a little bit more hawkishly on Friday and even said about a 2022 hike. And I think all of the Fed docs make sense, but totally inconsistent with really what the Fed has been trying to achieve over the last 9 months, which is create reflation.
Yeah, I mean, but also pretty insignificant, right, Patrick? I mean, half a basis point by the end of 2023, that's a long time away in this kind of economy. So can't we really take it with a huge grain of salt?
I think we should be taking it with a huge grain of salt, and every reflation trade basically just got thrown out the window on Thursday and Friday this last week. And I think it's a relatively easy story for the Fed to take back, exactly just putting it as you did, that these dots are 2 years down the line. We have to hold our hands up because we have no idea what we'll be doing in 2023 because there's so many things that will happen between now and then. But the Fed just really wanted to ease the signal that eventually all this free money, zero interest rates, buying billions of bonds will end at some time. And I thought that was probably a pretty mild way to show that things may eventually change. But the market is throwing out all reflation trades on this.
But it probably won't end soon, right? Because now it looks like central banks, the big ones, are starting to try and position themselves. The ECB says their stimulus is going to last at least as long as the Fed, which has helped them get the euro down to 118. I'm wondering if the reflation trade still has room to run. I got this great chart from our MLive blog. Cormac McMullen put it together. And for our listeners on radio, I'll walk you through what it shows us. This reflation trade, which started off in November, and here is shown as the MSC All-World Value Index divided by the All-World Index. It took off and rose to 18%. Now we're back down to about 9%. So it's about halfway what we have, halfway back down what we have climbed since November. Is this a good point for it to, I mean, is the deflation of the reflation trade kind of on pause for now?
It's on pause. And it's going to come down to the Fed. They're going to establish what they want their narrative to be this week. I expect they're going to come out quite dovishly, and you're going to get some of those reflation trades put back on. If the Fed comes out and all parrot what Bullard said on Friday, we probably have further downside because I've been owning banks. I own Goldman Sachs, I own Citigroup, and it's part of the reason I own them is I expected a steeper yield curve and that it would improve their profitability. I expected commodities to continue to get bids because the Fed would let inflation run hot. And I still think that's their game plan. I don't think the whole world gets out of this without basically massive monetization of debt, very strong nominal growth. I don't see how we get away from that with the debts and the deficits we face. So I expect that to be a pivot in the narrative this week. But if that doesn't happen, Thursday, Friday are probably what we've got for the next few weeks.
All right, thank you so much, Patrick Armstrong, CIO at Plurimi. This is Bloomberg.
Bloomberg has enhanced search on the terminal. to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Happy Father's Day, Matt Miller. Belated Father's Day. Now let's get straight to the Bloomberg First Word News. And the two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Now, Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election. President Macron's party taking 11%. The turnout, an estimated 32%, was really at an all-time low. One recent survey showed many citizens didn't even know what the election was for. Now, some of Japan's biggest private employers will offer on-site vaccinations for staff from today in an effort to boost the country's slow vaccine rollout. Elsewhere, Russia, Germany and Portugal reported more cases of the Delta variant. Canada, meanwhile, said its border with the U.S. probably won't reopen until 75% of its population is vaccinated. And a blank check firm backed by billionaire Bill Ackman is buying 10% of Universal Music from Vivendi for about $4 billion. Ackman's SPAC, Pershing Square Tontine Holdings, says the transaction values the home of Taylor Swift and Billie Eilish at $42 billion, including debt. And some breaking news. China's asking banks and Alipay not to get involved in crypto operations. Matt, this is a story that we've been following closely, not because of this, because this just broke, but actually over the weekend, there were a couple of regulations in order to keep control also of mining because it's not considered green enough by China.
Wow. So if China doesn't think it's green enough, then it's not green enough for anybody. I thought it was also interesting that we see at the same time a number of unicorns in China, in Hong Kong, that are getting big, billion-dollar valuations, and they're crypto exchanges or fintech that involves crypto. So it does look like you've got up and down arrows there.
And the down arrow for Bitcoin now.
Yeah, it certainly is.
For sure.
We'll have plenty more on Bitcoin. Coming up next, the Lloyds of London chairman. This is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Well, this is Bloomberg Surveillance Early Edition. I'm Francine Lachman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, there is quite a lot going on, Matt, in the markets, and of course, it's a reflation trade that's not exactly going to plan, but it was interesting to get Patrick's thoughts on the fact that they've moved quite quickly, the markets, and he actually thinks they're probably moving too quickly. So I don't know whether they were mispriced before or whether they're mispricing how aggressively the Fed will move today.
Yeah, I think it's really interesting. We have a couple of Fed speakers also to watch out for, so there still could be some catalysts this week, but the gains that we've seen in this reflation trade have already been cut in half, as I showed you earlier. So maybe it's time for a breather and for the market to refocus. On the other hand, there's so many other things to watch, right? I mean, oil especially is important as we try and make a deal with Iran. The crypto situation is fascinating as China clamps down further, but a lot of the innovation is coming from China as well. So, and then you've still got the COVID issue, right? The Delta variant that has hit the UK so hard is now starting to rear its ugly head in the US as well. There are a lot of moving parts to kick off this week.
Yeah, a lot. So, Kaylee, how's it all playing out in the markets?
A lot to digest for a Monday morning. Matt Miller coming at us hard this morning. Although I would say in the equity market, actually, the older the session grows, the more positive it becomes. So all of those fears or worries the market could have that Matt was mentioning about, they don't actually seem to have them right now. The Stock 600 in Europe was lower by as much as 0.6% and now is in positive territory to the tune of about 0.3%. And here in the U.S., futures are continuing to climb as well. NASDAQ 100 futures right now up by about 0.6% or about 85 points. And in the bond market, the U.S. 30-year yield actually fell below 2% earlier on in the session. Now it is climbing once again, and actually as a result, we are seeing the curve steepen just a touch. Right now, the spread between 5s and 30s sitting right around 115 basis points. And then, of course, as Matt was talking about, that crypto crackdown in China, both when it comes to mining and then, of course, the headline just crossing that China is asking banks and Alipay not to get involved in the crypto space. That is weighing on sentiment, with Bitcoin now just around $33,000. That is the lowest level since January. And of course, with Bitcoin moving lower, it is dragging on some crypto-tied stocks in pre-market trading. You have Marathon Digital, MicroStrategy, Riot Blockchain, all down 6% or more. And then Coinbase, of course, is a crypto exchange, and it is also down by about 2%, Francine.
Kaylee, thanks so much. Now, the insurance market has been at the epicenter, of course, of the coronavirus crisis, paying out billions of dollars to bail out everything from cancelled sports events to giant concert tours. Now, Lloyd's of London, the world's largest insurance market, has secured an additional £650 million of cover for its central fund. That's to protect against its underwriters being overwhelmed by similarly unexpected events. We're delighted to be joined by Bruce Carnegie-Brown, chairman at Lloyd's of London. Mr. Carnegie-Brown, thank you so much for joining us. When you look at how the pandemic has affected Lloyd's of London, but also the insurance market in general, what will its legacy be?
Well, as you rightly say, this has been a very large event for the insurance industry, and at Lloyd's, we've announced that we will pay claims in excess of £6 billion related to the pandemic, and the largest of those have been around event cancellation issues. Increasingly, of course, what we're focused on is how can we support our customers in future pandemics, but also more broadly across other systemic risks like cyber and climate. And so one of the big themes that we have post this pandemic is working more closely with governments to provide solutions to these kinds of challenges. So interestingly, statistically, I think the total resources of the non-life insurance sector globally are about $2 trillion to pay all of their claims. But what the IMF said in 2020, the government's pumped in some $14 trillion to support their economies. And so you can see that the scale of the challenge around the pandemic has been much too large for the insurance industry alone to bear. And so I think creating a collaboration between the industry and government is going to be key to addressing future systemic risks.
So can you give us an indication of what you think the final bill for COVID is? Is it too soon to actually see how much this will cost Lloyd's of London and some of the underwriters?
No, so we think our total bill will be of the order of £6 billion now. The key now is, of course, that many of these covers are not available to our customers going forward, and we need to reintroduce them in order to support our customers in building back resilience into their business models as they try to reopen for business.
Are more people asking for insurance against future pandemics? Is that something that you can ensure?
Yes, well, in fact, the answer is that we did provide insurance cover. So after the SARS epidemic, we produced a report in 2008 that's been on our website since then, which looks enormously prescient for the issues that the economies around the world have subsequently faced through this pandemic. And we put in place products to try to support our customers. But nobody bought them. So one of the challenges around this is not just having the products available, it's behavioral activity on the part of our customers. And what we find is that where events are very remote in terms of their perception, even if the impact is very high, people don't buy the insurance covers. Now, clearly, pandemic is now no longer regarded as a remote event, so people are interested in buying pandemic covers, but it's not just an issue of whether they're available. They also need to be affordable for our customers. And because of the size and scale of this kind of issue, this is why we need a partnership with government. And so we put out a white paper last summer on suggested structures that we could work with, and we've been engaged with more than 25 governments around the world to look at a partnership that would help customers be able to buy this product at an affordable price to protect themselves from future claims.
What kind of pricing do you expect? Because, of course, it's still remote, right, Bruce, that we have another, global pandemic that forces businesses to shut completely down. On the other hand, it's got to be incredibly, impossibly expensive to pay off if everybody takes it.
Yeah, so that's exactly what we need to look at is that balance between availability and affordability, and we're running some test pilots at the moment around certain products with customers to see whether what we're offering is interesting to them. I mean, clearly we all have a limited budget around what we can spend to buy protection from the risks that we take, and so there is a prioritization issue here. And do we need to divert a premium that we pay for risks that we currently insure to buying pandemic cover, for instance, if we think that those kinds of risks are now looming much larger on the radar screen. So there's a huge behavioral issue here. I mean, if you take an example away from the pandemic and you look at windstorms in the United States, hurricanes blow pretty regularly every year in the southeast of the United States. but only 1/3 of the economic value that hurricanes destroy is actually insured even today, despite the regularity of these events. And what we know is that the most expensive real estate in the world is all located on waterfronts, and waterfronts are most exposed to hurricanes. So there's behavioral issues that also need to change here to build resilience into our economic models.
Well, Bruce, that brings me to climate change. To what degree are you seeing demand for insurance against climate events move higher?
So we think the total premium value for climate-related events is increasing year over year. We're doing a lot of that at Lloyd's today. But again, it's important that there's resilience alongside climate change. So our mantra really is trying to support our customers as they transition to more sustainable business models. We're absolutely committed to the UN sustainability goals for a net zero by 2050. And we've announced that from the beginning of next year, we will not insure new thermal coal projects, Arctic drilling, or oil sands projects, because we think those have the highest negative impact on the world's climate. And similarly, we're producing products to support renewable energy, particularly things like wind and solar.
Aside from climate and the threat of another pandemic coming potentially down the line, what other kinds of risks are people primarily looking to insure against?
So cyber is I think the third of the systemic risks that I call out. So pandemic, cyber, and climate, and cyber risks are also growing as a result of the pandemic. Much greater adoption, of course, of cyber ways of working through the pandemic, and therefore a need to adopt and adapt policies. So a good example of that would be typically you're not allowed to use your home under your standard home insurance policy as a place of work, and the insurance industry has moved to adapt its policies to allow for remote working. But there is an increasing evidence of ransomware, for instance, that's coming through in the last 12 months that's causing very substantial claims in the insurance marketplace against the provision that we have. And it's also important, just as you know, if you have a sprinkler system in a factory, it reduces the chance of fire. If you have a burglar alarm, it reduces the chance of theft. We've got to try to build a better engagement with our customers about reducing the incidence of risks that they face. And of course, if the risk goes down, so will the costs of the cover.
Bruce, thanks so much. Bruce Carnegie-Brown there, chairman at Lloyd's of London, joining us today. Now, coming up, Bitcoin under pressure after a crackdown in China. We'll talk cryptos next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kayleigh Lines in New York. Now, China continues to crack down on cryptos, now asking banks and Alipay not to be involved in crypto operations. Bitcoin is, of course, struggling amid a risk-off mood in the market and the ongoing issue with mining in China as well. Joining us is Bloomberg's Eddie Vanderwalt to talk about this, as well as some other things if we have time, but let's focus on cryptos first. Eddie, there's been a drop in the hash rate. So what does that mean for the price of Bitcoin?
I know. Yeah, I know. It sounds like a really scary metric. All it really tells us is that, you know, miners are shutting down their computers and they're mining less Bitcoin. But what this actually means, it doesn't mean that we're going to see Bitcoin into the market, because the fundamentals of Bitcoin doesn't quite work the same as, you know, shutting down a copper mine. Therefore, you get less copper production. The rate at which Bitcoin is produced is fixed by the algorithm. So therefore, you know, just shutting down miners just means it becomes easier to mine Bitcoin. It doesn't mean that we will see less Bitcoin coming to market. Really, what we're seeing, this drop in price, is really got to do a lot more just with the risk-off mood generally in markets. Now, the risk mood has improved a little bit over the last hour or so, but not in cryptocurrencies.
But Eddie, it was my understanding that China, apologies, I always lose my voice when talking about cryptocurrency, that China was never that into cryptocurrency, so they always, you know, tried to stem the flow.
Well,
the fact that it's now moving the price, is it because they're aggressively trying to kind of, you know, stem speculation?
Yeah, look, the Chinese government has never been big on cryptocurrencies. The Chinese government has never been big lovers of cryptocurrency. The Chinese people, however, have adopted it, you know, at a pace probably that outstripped everybody else. We have seen, you know, the Chinese consumer and the Chinese investor going after cryptocurrencies. And a lot of the mining capacity has been, you know, located near these big hydro facilities in China. So what we are seeing, you know, is that as the government cracks down on it, that definitely has a knock-on implication for price.
Eddie, to what extent are you paying attention to the technicals? Does the death cross really mean anything?
The technicals for me is the most important thing in cryptocurrencies, because it's really hard to price cryptocurrencies on the basis of fundamentals, on the basis of inflation expectations, on the basis of almost anything else. But because cryptocurrencies is almost a pure investment play. Therefore, you know, technicals which try and measure investor sentiment, you know, in some sort of pure form removed from the fundamentals, I think it's really interesting to look at. I don't know that the death cross is going to matter that much. What I will say is that this drawdown in crypto has been a lot smaller than we've seen in the past. We're only down about 50% from the all-time highs. Previous drawdowns, we've gone as much as 80%. So, as you know, as crazy as it may seem, even with this drawdown, it seems as though crypto seems to be maturing and seems to become a little bit more just stable and, you know, worthy of mainstream adoption.
Well, and you've got a great chart. I'll recommend to our both our television viewers and our radio listeners to check out the MLive blog, MLIV Go on the Bloomberg, to look at Eddie's chart there. You're also talking, Eddie, a little bit about gold here. And in fact, a number of MLive contributors have weighed in on gold. We saw a great rally in the precious metal and then a drop around the Fed move. What's the short to medium term future look like for gold?
Matt, yes, the air has just kind of gone out of that gold rally a little bit. I think what we're seeing here is that we're seeing, you know, hopes that the Fed is finally starting to talk about tapering. We're just seeing that sort of hawkish noises coming through. But really, what you want to be talking about for gold at the moment is the dollar. If we look back at 2013, 2014, in the previous you know, tapering cycle, what we saw was the dollar turned first, gold turned immediately afterwards, and that became the major trade for gold going forward for a number of years. And I think that could be the case here.
Eddie, I know there are two actually Fed presidents talking today. Are they going to try and temper some of these market moves, or is this what they wanted?
You know, I think we haven't seen extreme moves. I don't think that they will come out all guns blazing saying, listen, you got it wrong. Because I think there was perhaps the understanding that Bullard came out on Friday, you know, and just ramped up the market's expectations for a slightly more hawkish Fed. Now, I think there's going to be a lot of management this week. We're going to get, I think we've got 16 Fed speakers this week. It's a really busy week for Fed speakers. So, you know, there will be some management, but I don't think they're going to completely row back and say, listen, you got it wrong, because the market's move just hasn't been that extreme yet.
Eddie, thanks so much. Eddie van der Walt there, of course, from our MLive team, looking at everything crypto, treasury, and the flattening yield curve. Now, coming up throughout the day, Bloomberg Live Qatar Economic Forum, rethinking the global economic landscape through the lens of the Middle East. Now, we have a really all-star lineup for you. Speakers include the WTO Director General, Barclays Chief Executive Jes Staley, and Bridgewater founder Ray Dalio. So we'll look at that, and coming up, we'll have plenty more on Iran. We understand that there's a press conference by the president-elect, President Raisi, holding a press conference in Tehran as we speak. Plenty more on that shortly. This is Bloomberg.
انجام گرفت. این حضور پیام‌های مختلفی داشت.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman, London. Matt Miller in Berlin. Kaylee Lyons in New York. Our Tom Keene now joins us. He's co-anchor of Bloomberg Surveillance. And I know, Tom, you have some great guests and then some great charts for us as well.
Well, Tony, we're perfect today. We
Happy
booked Tony
Monday.
Cosenzi before Friday blew up. And to have the gentleman from PIMCO with us today is really perfect with what we're seeing in the bond market. Ben Emmons will join as well on how this all links into Fed policy. Really, really interesting. Francine, as many people have said, including George Saravelis, I've never seen markets like this. Where we are right now, Francine, after this natural disaster, the huge fiscal stimulus is absolutely original. and there's no other chart than the amount of cash sitting at the Fed. One of the indicators of this is ON, overnight repos, and the circles are just simply the different days recently where the amount of money sitting at the Fed ballooned up, and there it is out to a new high after the Fed festivities of a week ago.
Yeah, Tom,
Wow.
I mean, we're hearing a little bit later on, I think, from Robert Kaplan and James Bullard. I mean,
Well,
they'll have to, and it's a really great chart. How will they position it?
This is really an important question, and you're dead on about the Fed speak this week. They're going to have to re-rationalize the message of last week, and Francine, critically, they're going to have to reset, as Bullard already has attempted to do. I believe it was on Friday. But what you saw on Friday, and with the markets up today, I'll tell you, the bond market is litmus paper for the global system now. It's tangible, and people are going to hang on every word of those Fed experts.
Yeah, they certainly will. Tom Keene, thank you so much.
Sure.
Co-anchor of Bloomberg Surveillance, starting shortly. I'm really looking forward to watching the program. Now, a look at what else we're watching today. Kaylee, what's on your mind?
Well, it's Amazon Prime Day today, Francine. Actually today and tomorrow, of course, the annual online sales event. Last year, it got bumped back to October because of the pandemic, and it is happening this year as it traditionally does in June. Now, this could be a really big sales day for Amazon. Analysts over at Telsey Advisory said total sales could be as much as $12 billion over just the two-day event. That would be growth of about 16% compared to 2020. And our analysts here at Bloomberg Intelligence, Matt, say there will be a shift in what people are buying this year, a bigger push toward apparel and travel as the world reopens. But of course, people are still going to be looking to buy things for their home, buy electronics. I myself will probably be doing some online shopping after work, Matt.
I was looking yesterday for disposable baby bottle inserts. So my
That's very specific.
shopping habits are changing drastically in terms of
I'd love
what I buy
to
on
see
Amazon.
your algorithms.
I am, exactly. I've gone from, motorcycle clutch
Ducati.
tools to baby bottle inserts. I am watching UK supermarkets. Now, I make fun a lot of how much Britons care about their supermarkets, but I'm only joking. I also care. You know, I have bought BLTs at Marks and Spencer's. I have bought, TV dinners at Tesco's. Every little helps. And I have bought, honestly, the best New York cheesecake in the entire world at Waitrose, but Morrison's is the one in play right now. Clayton Dubilier and Rice making an offer there reportedly for $5.5 billion, and this supermarket could be in play. It was a 32% gain right now, so a massive boost to the FTSE and the stocks and the Stock 600, and it's definitely one to watch because there could be more consolidation in this exciting industry.
Yeah, I mean, it's a great story, Matt, and it's amazing that they just after 3 days said, actually, no, it's not the right price. Matt, I hope your algorithm for Amazon is better than mine, because I still get, baby news, and my youngest is like 7 years old. So good luck with that. I'm looking at cryptocurrency, and this is, without a doubt, for me, one of the top stories because of China's involvement in cryptocurrency. So just a couple of minutes ago, I think about 15 minutes ago, China has asked Alipay and banks not to get involved in crypto operations. And then the last, I would say, 7 days, I learned DeFi, and I've learned exactly what some of the other things. Hash rate is.
DeFi,
so
you mean?
Commentators. DeFi, I say it DeFi, the European style, of course, mispronouncing it. So DeFi, the so-called decentralized finance, is something that we've been talking about over the last week, and China getting a much stronger stance on this. It's basically the apps that let people lend, borrow, trade, and take out insurance directly from each other. And the other one, which I'll also mispronounce, is hash rate, the computational power used to mine Bitcoin and the like, and China's having a crackdown on that as well, Matt.
Yeah, I think we all understand hash a little bit better than DeFi. Sometimes we use Wi-Fi when we're talking about Bitcoin as well, no?
I also say Wi-Fi. We'll have plenty more, of course, on Bitcoin, on the markets, on the yield curves, on Bloomberg. This is Bloomberg.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
We still see there being more to go in this restart narrative.
It's still being affected by concerns about COVID.
The biggest risk for me is that I underestimate how much inflation is going up.
The Fed doesn't know either when this transitory notion is going to go away.
The Fed has to be very careful about its communications, not just verbal communications, but all types of communications.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. Good morning on an unprecedented Monday. There is no other way to put it. The bond market and the linkage, the correlations into equities, commodities, and the rest is absolutely extraordinary. Lisa Abramowitz, Matt Miller in for John Ferro, which is a good and beautiful thing. Matt Miller's surviving Father's Day by all reports that we can.
How about Tom Keene?
No, I didn't survive it.
Okay.
Lisa, the 30-year bond, briefly in the Asian morning, under 2%. Stunning.
Stunning because basically people are pricing in the ramifications of a hawkish Fed before the Fed comes through on even being hawkish. A couple of members coming out and basically indicating that they'd be willing to raise rates, and the market extrapolates down into the future of slower growth and lower bond yields. Exceptional moment, Tom.
Want to go to the research board now? We've got tons of research to verbal to you this morning. That's what we do here. We summarize global Wall Street. Stephen Major, Dyer, and the team at HSBC out with a terse note. Both Abramowitz and I independently notice this note. We maintain our 1.0% forecast for 10-year treasuries. And then on the movement, the elasticities we're seeing, the new policy moves more slowly than a Taylor rule, but it does move.
Yeah.
The underlying inflation trend is likely to be benign based on GDP and PCE projections. Lisa, I go to GDP, and the turmoil we're seeing now is a guesstimate of where GDP is going.
The guesstimate of the ramifications of the frictions in the labor market, the ramifications of higher gas prices, higher prices in staples, leading to lower purchases, the dreaded S word, the pendulum of stagflation, Tom.
Well, it is in a new kind of stagflation. Well said, frankly. Matt Miller, I really want to go to what this means for Europe. I mean, it's sort of we're separating away hawkish central banks from Lagarde alone. Is that it?
I think Lagarde and the ECB have done a great job playing this to their advantage as you see a euro coming back down to 118. My question is, does the Fed strike back with the speakers today? You know, we're going to start seeing a lot of people are talking about the big central banks jockeying for a better position in terms of currency.
It is absolutely, again, I really want to emphasize the market coverage worldwide, absolutely extraordinary right now, and we'll really sit on it this morning. Tony Crescenzi will be joining us from PIMCO, I believe, in this hour. Let's do the data right now. Matt Miller, help me out here. You mentioned euro, a 119 exact, yen weaker as well, 110.11, and the dollar really not breaking out, Matt Miller, is it?
It isn't, but we've seen the euro and the pound come down pretty substantially over the past couple of sessions. So what you see here is just could be a dead cat bounce, as David Buick used to say. The point is the euro's not trading at $1.22 as it was pre-Fed meeting last week.
Equities surge in Asia, were weaker in Asia, and now they surge up 0.5%. SPX up 20 points. Dow, we do the Dow futures for John Farrow.
He's
up
grateful.
200 points, 33,300. 355. NASDAQ, well, was leading the way, not so much right now. Bitcoin, I should point out, 32,000, 33,000 right now. Lisa,
that's fascinating.
We need a brief.
Yeah, we do need a brief, and we will get to Bitcoin, I promise, Matt Miller, later on.
Yes,
I meant Dow futures. I thought Dow futures were fascinating, not Bitcoin.
Let's move on to what we're expecting today. We're expecting a number of Fed officials to come out and speak. Jim Bullard, in particular, of the St. Louis Fed, among them, which should be interesting following his hawkish discussions on Friday. Also, John Williams of the New York Fed, as well as Robert Kaplan of Dallas. These remote or these virtual events by the Federal Reserve, possibly giving some color to the dots raised forward, bringing forward some of those rate hikes. 1:45 p.m., President Biden is going to be meeting with financial regulators. Interesting to see the focus on regulators and global climate change, how much they are going to weigh in on this. That is his connecting force here. What kind of threat to the financial system could global warming be? An interesting conundrum, especially at a time when it's not a clear link and we still have a lot of other issues to work out within the financial system. And today we have the Bloomberg Qatar Economic Forum. Very interesting roster of speakers, including Barclays' Jess Staley, Ray Dalio of Bridgewater. How much do they recognize the new regime, the paradigm shift that we're seeing reflected in markets, the deflating of the reflation narrative? How much do they buy into this, and how much are we going to hear from Ray Dalio? Cash is still trash, and we're going to get inflation pick up dramatically here, whether the Fed takes a more hawkish tilt or not, Tom.
Lisa, thanks so much. And we'll dip into the coverage there from Doha this morning. I know Mr. Bloomberg leading off that Bloomberg Forum on this Monday. Right now, David Page with us with AXA, investment managers, head of macro research. David, there's a huge divide out there. There's people looking out for higher yield, elevated inflation, and others who simply say no. Which is it?
We think yields will move higher, and we think it'll probably happen over the next 3 months or so, certainly from the depressed levels we find ourselves at the moment. I mean, the story on inflation, I think, is a transitory one, certainly in the short term, in the sense that we are seeing this big spike, and we do expect that to roll off. And we think there'll be increasing evidence that that's rolling off as we move into, the September months and after the summer. And that will add to the story. I think the key is, though, the Fed isn't really that worried for now about what's happening at the very short end over the next couple of months in inflation. It's really trying to guess what's going to happen towards the end of 2022, what's going to happen into 2023, what would happen into 2024 if they don't move. When you're thinking about dots moving, into 2023 rather than 2024, they're anticipating inflation much further out, not the next few months. And I think that's the key issue here. And I think once the Fed repurposes some of its messaging, I think that's going to come through both in real yields and to some extent in break-evens.
David, what could, though, trigger the increase in yields? If it's not a more hawkish Fed, the idea that the Fed itself is starting to see inflation pick up, what could possibly convince the rest of the market that they are wrong, especially if the Fed is showing a willingness to try to tame inflation should it rear its head?
Well, I don't think the Fed is suggesting that. I mean, there was a reaction that, the Fed only increased its inflation forecast to 2.2 from 2.1, and that's what led to this whole shift in the dots. And so the overshoot that the Fed was looking at for 2023 wasn't as much. And I think that's wrong. I think what the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation that is going to be persistently higher if they don't put themselves in a position where they can start to restrain that. And that's perfectly sensible from a central bank's perspective. They have extreme accommodation at the moment. Rates are as low as they can be. The QE program is extensive, and they're still not talking about tapering that, and we don't expect them to until December. There's a huge stimulus going through. We can see the problems it's causing at the short end of the market with some of the liquidity positions out there, and I think the Fed needs to work out how it's going to retrace some of that. So I think that's the story that they're going to communicate. That's where we're coming through at the moment.
So is this what we see in treasuries right now, what we see in the 30-year coming back below 2%? Is this investors all getting out there looking for duration? Are they searching for convexity to try and limit their exposure to interest rate changes?
I think to some extent there is a repositioning come through, and I think also there is a global factor here as well. I mean, we're still seeing, as we've talked about in previous sections, an ECB that's taking advantage of the international situation. There's elevated purchases coming through from the ECB. German bond yields are still trading at negative. And so you still get quite a positive carry from a lot of European investors if they allocate overseas. And I think perhaps some of that allocation into the US market is continuing to be there and will continue to be at something of a ceiling for treasuries. So we're not looking at a huge surge coming through, but I think some pickup coming through over the medium term is entirely likely.
David, how do you interpret trillions of dollars with no place to go? And the literature over the weekend is obviously overnight repo and the rest of it, all the fancy math inside of 6-month duration. And it's also the assumption that all that money will go into Bitcoin to keep Matt Miller positive and maybe the equity markets as well. But how do you rationalize, or how do you frame out trillions of dollars on the sidelines?
Well, I think you have to sort of see the distortions that it's going, and it has to feed into how the Fed reacts. So we are seeing, I mean, it's been exacerbated to some extent by the government's unwind of its own cash positioning at the Fed, and we can see that that's having some impact. We know there's a lot of liquidity coming through from households with excess savings, and that's creating a deposit issue. So all of that is affecting the short end, and of course that's rolling along to the longer end as well. But I think the Fed needs to consider what that means for monetary policy. We saw a tweak come through, don't forget last week in the IOER rate. They increased the interest in excess reserves to try and offset some of the short-term pressures. But those short-term pressures will maintain when there's that amount of liquidity through there. The only way you can reduce that liquidity over a period of time is to stop creating excess reserves. Now, what we think the Fed is going to likely consider is a quicker taper than is in the market at the moment. So most are of the opinion that the taper program will follow what we saw last time around, i.e. it will take probably 12 months. We think that they won't start until January. But we also think that they'll probably try and do it a little bit quicker than they did last time. So we think they'll close that taper within 6 months.
Right.
And I think maybe when markets start to consider a quicker taper, and therefore obviously if they finish a little bit more quickly, the possibility of an earlier rate hike, that's something that will help the liquidity situation. Now, I think there are 7 members of the FOMC that also think that the taper will be 6-month one, because I don't think 7 people can vote for a rate hike in 2022 if they still think that the Fed is closing its QE program by the end of that time.
In English, David Page, thank you so much. And folks, that's what we're searching for here all through the week on Bloomberg Surveillance, is some clarity to the complexity of the moment, given the record fiscal stimulus back to 47, 48, and certainly different than it was coming out of World War II. Lisa, the word I'm using here, and I think it was Sarah Vellis that had it in a note at Deutsche Bank, is responsiveness, which is English talk for a arcane word called elasticities. Do we know the elasticity of the spread market? We don't have a clue.
Well, right now it's highly elastic. It's being incredibly resilient. You're seeing spreads stay very much tame. Yes, widen a touch. But right now there's still money pouring into anything with yield. And we have seen that persist regardless of concerns about growth. And so, Tom, that is why the Fed is not that concerned. They're not seeing any material disruptions to financial conditions, even with a hawkish tilt.
Yeah.
This is significant.
I really agree with it that folks, what we see here is a lack of instability, and that's what everyone's watching for. With that lack of instability, though, is a lot of worry, and we'll try to address that. Tony Crescenzi with us here, I believe, in this hour. Some other good guests coming up. We're thrilled to bring you Benjamin Emmons. He is with Medley Global Advisors. It's a perfect day to talk to Ben Emmons about, well, all the speakers. Who's speaking? Let's see. Bullard. This guy, Abramowitz, is speaking. This is Bloomberg.
I just keep speaking.
With the First Word News, I'm Rishka Gupta. The 2 main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. And UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness nearly $21 billion of annual R&D spending to find solutions for the public good. The new Office for Science and Technology strategy will be headed up by the government's chief scientific advisor, Patrick Vallance. Property website Rightmove says UK house prices grew more slowly in June as a lack of availability drained momentum from the market. Asking prices rose 8% this month after a 1.8% gain in May, but the increase is still the largest for this time of the year since 2015, boosted by people seeking to leave London and look for more space. The Tokyo Olympics will limit the number of spectators to 10,000 people per venue to reduce the risk of the world's biggest sporting games turning into a super spreader event. The organizing committee chief says the number will be set at either 10,000 or 50% of venue capacity, whichever is smaller. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
We have proven now over the course of the past few years that we can reimpose sanctions in a devastating way, and the Iranians understand that, so we retain substantial leverage. We will come to the table not just with sanctions leverage, but with a united front of the world powers that will pose to Iran a choice.
Jake Sullivan of the White House on Fox News Sunday there. We thank Fox News for that moment there on Iran. It was good to see Golnar Montevalli of Bloomberg News earlier with Francine Lacroix with her true authority on Tehran and the events that we see. We'll have much more on that through the week as well. Right now, and this is really difficult to admit, because he really wasn't my first choice for 6:18 in the morning, and he wasn't my second choice. But Marty Schenker was our third choice of guest this morning, which begins to filter out ranked choice voting.
That was my wife's third choice, too.
Yeah, that's good.
Goodness.
Here we are with an experiment. Let's get back on track, folks, or Mr. Schenker will show me the door. They've tried it in Maine. They've tried it in Oakland. They tried it here. Republican, Democrat, they've tried it. What makes New York City, for our listeners and audience internationally, what makes New York so compelling as a ranked choice experiment?
Well, this is the first time New York City has tried ranked choice voting in any election. And being the mayor of New York is such a critically important post. Some people consider it the second toughest job in America. Having a ranked choice is causing some confusion, some anxiety, and people really have a hard time understanding what it is.
That's where I want to go. I mean, I'm fascinated, particularly in the complexity of New York City, how it affects turnout because of its complexity. This is a serious issue.
Yeah, there are
Is it complex?
Yeah.
Doesn't seem that complex to me.
Well,
that's okay, Matt.
You must be a math major then.
It's a big deal here, just looking at the ballot, what to do.
Yeah, I think what is giving some people pause is the idea that you really have to examine the entire field. And when you go in the ballot box, you're going to be faced with picking your 5 of 13 Democrats ranked by your preference. And it's that second choice that is critical in this whole process. The person with the most first place votes, if it's not 50%, then the second place choices get allocated. The last first place vote getter is eliminated, and that person's votes are allocated to the second choice. So it could be that the person who's elected mayor would not be the first choice of a majority of the voters.
You got through that at 8:15 in the morning. That was spectacular.
Which is why Andrew Yang has teamed up with Catherine Garcia to try and push Adams out. As I was reading this fantastic Bloomberg coverage over the weekend, my question really goes to the crime in New York. How bad is it? And has crime gotten worse because of the pandemic, Marty, or is it because of the choices of the current administration?
Well, I think that many of the experts do attribute it to the ancillary effects of the virus, the depopulation of the public transportation system, making it less safe. But the point is, I do think public safety, quality of life is the number one issue that's going to decide this race. Eric Adams has clearly staked out that as one of his most important points. But Andrew Yang has done that too. And so it'll be very interesting dynamic to see who wins that race.
What's great about this is Lisa's going to vote. She's going to leave the first 4 votes open and just have a 5th place vote.
You could do that, I guess.
I'm just going to put Tom Keene, and let's say everyone at Bevelman's for some martinis. There is a question. I will just say this also. All of the advertising that I saw on the sidewalk, all the people pestering you to vote, were saying, if not for number 1, put her for number 2. And so people are definitely trying to cater to this ranked system, Marty. Looking to Washington, D.C., aside from New York City politics, there is a question of this bipartisan bill that seems to be gaining steam. I am interested in the headline number of it, just north of $500 billion. Is it really coming down all that much, or is it being viewed as sort of a siphoned off infrastructure plan with additional support for a bigger project down the line?
Well, that seems to be the Biden strategy, and today's a pretty important day. Apparently, Joe Biden is going to get briefed by this bipartisan group in some way today. The biggest question is how to pay for it. The bipartisan proposal of a graduated gasoline tax is a non-starter as far as we can tell from the Biden administration. But if they can find a path for paying for this, it looks like Joe Biden wants to get this bipartisan bill through the Congress and then take on the multi-trillion-dollar social welfare plan that he has proposed for America.
Marty, when I hear this, I just think that he's basically conceding to a much smaller fiscal spending package than he initially set out to do, simply because it seems a lot less likely for him to get consensus among Democrats to push through this larger multi-trillion-dollar plan. Am I wrong?
No, you're not wrong. You're right. The key thing, I think it looks like they can get this smaller infrastructure bill through, and I think both sides can claim victory. The biggest problem Joe Biden has is keeping his moderate Democrats in line for the bigger spending plan. Joe Manchin and Christine Sinema have not said which way they're going to go, and without them, it's just impossible to do.
Marty Schenker, thank you so much. Bloomberg editor at large and managing editor of Ranked Choice Voting here at Bloomberg Surveillance. I always come in at fifth place as well. Lisa, I want to look at the 10-year yield. Just keep it real vanilla here. It moved out over 2 standard deviations, lower yield. We broke through the 144 level. The shock of these lower yields, and of course the tendency, as HSBC says, down to even more shockingly low yields. Is that in the market?
I don't think so. I would think that the economy would have to slow down materially for these yields to really make sense.
Exactly.
And if that were the case, wouldn't we see a more risk-off tone? Aren't we looking at a more stagflationary environment where the Fed forestalls growth, it forestalls inflation by raising rates sooner, leading to these ultra-low yields? Shouldn't that mean lower profit margins for a lot of these riskier companies?
Yeah, but we don't know the sequence of that. But to your point, and I, of course, focused on this last week as well, the real frame out here is the sub 3% growth rate. Will that occur, and when will that occur?
And I also think that there is the global nature, and we've been talking about this, but how much is this foreign investors coming in, which we saw with the strengthening of the dollar last week? How much can yields really rise in the United States if the rest of the world does not recover at pace? And we've seen little pockets of outbreaks. I don't understand exactly how this can continue this way,
Matt
Tom.
Miller, is this followed in Germany? I mean, are people in Germany following on the street? Are they following what the Fed is?
Well, on the street. Not on the street so much, but certainly followed in Germany by those in finance incredibly closely. And it's so important because the ECB and the Bundesbank have to follow it so closely as well. I think everybody on the Bundesbank board is waiting for Lisa's next opinion column. Lisa, when is it coming out?
Should be this week sometime. Break exclusive.
We ranked it.
Oh, yeah? Where is it? Number 8?
In 4th place.
Well,
but
winning.
The 3 on top didn't get a majority of the votes, so you still got a chance for essay of the week.
That's so kind, Tom.
Coming up, the interview of the day on the short-term bond market, Crescenzi of PIMCO. This is Bloomberg. Good morning.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Good morning, everyone. Bloomberg Surveillance. Matt Miller in for John Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance to get you through fascinating markets. Futures up 18. Dow futures up 188. We quote the Dow for John Farrow. The VIX goes out 15 out to 20.19. It's in a little bit better today, but 20.19 right now on the VIX. This is the interview of the day on the shock and awe of the short-term paper market 6 months in. It is arcane, it's complex, and you've got to read the 14,000 pages of Steigums written by Tony Crescenzi to understand a little bit of it. We don't have the time to do that, so we'll talk to him instead. Crescenzi of PIMCO now on where we are. Tony, there are two groups. The Fed is organized, the Fed is providing stability, and the overnight market surge we've seen in repo is no big deal. There's another camp that says baloney, the world's fallen apart. Which is it? Bring the chart up, Brad, for TV and on radio. All you need to know, it's a spike like you've never seen. Think about Jeff Bezos going up in space. That's what the spike looks like. Tony, what's it mean?
Well, it's as if the Fed wrote its recent framework on disappearing ink to some, because the Fed's new framework, released last August 27th, said that it wouldn't raise its policy rate until the inflation rate had gone above its 2% target for some time. It hasn't really done that for some time, and so hence the idea of disappearing ink. This spike we're seeing in rates, of course, relates to the Fed's communication. And I should add that Ben Bernanke, who's an advisor to PIMCO, has famously said that Fed policy is 2% action, 98% communication. It goes to show how strongly markets take the words of the Federal Reserve, and certainly they were taken very strongly. So the rise in rates, just to sum up, I would say that it's as if the Fed is put the inflation cop back on the beat. It wanted to regain control of the inflation narrative because the public's hype over inflation had gotten too high. The Fed got spooked. That's what it says. And it'll probably be good, final words, Tom, on this. It'll probably be good for the equity market, for the credit markets, private investments, including real estate, because it looks like it will rein in inflation fears, right. But the Fed may.
Okay, but Tony, this is really important. If Crescenzi's telling me the Fed got spooked, that's really, really important. What about the responsiveness, the malleability, the dynamics, the elasticity of trillions of dollars? I don't understand the theoretical model of what that money does that came from this pandemic.
Well, we see $750 billion of it in a Fed repo facility. There's still a lot of money sloshing around, and it's the reason why the Federal Reserve raised a few official policy, I should say technical policy rates that it tracks. It has its official policy rate, of course, is around zero, but it does things to tweak behavior in the money markets. And last week it raised two specific rates by 5 basis points because there's so much money floating around that it was putting downward pressure on money market rates, call it commercial paper, et cetera, and 3-month LIBOR, which reached an all-time low of 13 basis points last week. And so that money still is out there, so to speak, and it won't be removed for a long time. Remember, the Fed is still purchasing $120 billion of new securities per month. In other words, it's printing another $120 billion of money each month. It'll do so into next year, and it won't shrink its balance sheet for a while. Why? Because it's going to reinvest the principal and interest payments it gets on the mortgages it has and the treasuries it has.
Lisa, I don't mean to interrupt Tony, but this is so damn important. Lisa, what's so important, and Mr. Crescenzi just said, is that phrase, for a very long time. I mean, that's really what the market's arguing about.
Yeah, the issue here is that people are trying to extrapolate forward what the trillions of dollars in excess cash sloshing around that clearly banks and the Fed are struggling to know how to handle, what the ramifications for this will be. Zoltan Pozsar of Credit Suisse writing in a recent note that by paying trillions in reserves, 5 basis points, the Fed just planted the seeds of the next liquidity crisis. Tony, do you agree?
No. For one, markets understand the Federal Reserve's reaction function, which is that if there were a liquidity problem, that the Federal Reserve would stand up and inject additional liquidity. This is something we learned after the GFC, the global financial crisis. There was some doubts about whether the Fed would stick to it in 2013 when there was a so-called taper tantrum, when there's a fear like now that the Fed might remove its monetary accommodation. That fear subsided over the years, and look today. The Federal Reserve has communicated an idea that the markets didn't believe in previously, yet the reaction was not much of a reaction. It's rather tame. You're not seeing meaningful movement in global markets from this, i.e. Downward movement in equities, credit, and or jump in interest rates. And so it's a rather benign notion related to the reaction function idea. So this notion that if there isn't enough liquidity, there'll be liquidity crunch is not happening in my idea. One quick notion, though, to think about is the idea of chaos in periods when credit cycles end. After 2008, 2020, we all saw that credit instruments did not trade well. This relates to the breakdown of the so-called principal agent model,
right?
Which is that there are so many debt securities in existence that when investors go to sell, that the system can't handle those securities because there is no intermediary to bid for them.
Yeah.
So that's where there's a liquidity crunch in financial markets, in debt securities, because the problems in the broker, the principal agent model.
And Tony, that sort of speaks to the so-called taper tantrum type model, particularly in credit, because it isn't traded in the same kind of way as full faith in credit, government debt of the United States. Here we are, though, with two-year yields moving. And as a number of analysts noted, people expressing the hawkishness heard by a number of the Fed members in markets, but not, as you point out, in credit. We are not seeing the stress in risk assets. How do you make sense of this?
Well, first, I thought the first thing that came to my head when you said that is corporate profit story, cash flow. What investors care about, bond investors, equity investors, is cash flow. A bond investor cares about getting his or her or its money back. And the earnings story is quite good. In fact, we think the equity that investors should be overweight equities today, overweight credit. The story in equities is that the earnings will grow near 30% this year, and we would project as well that earnings will grow 10% next year, 10% the year after that. The Federal Reserve's communication, if anything, will elongate the economic expansion by tapering, I should say, bringing down inflation expectations, inflation fears, the type that might have truncated the economic expansion. And so the story is looking good. And again, I refer back to the notion of the Fed's reaction function. Most believe that the Federal Reserve would step in and take action if, in fact, the markets got into trouble.
Tony, I wonder about the renewed, as Sven Rahm calls it on the MLive blog. Hey, Tony, good to talk to you. He says there's a renewed quest for duration, and I wonder if that just points to market expectations of real volatility coming back in rates.
Well, looking out several years into so-called forward rates, one sees that, and even out 5 years, that the market consensus is that interest rates across the yield curve will be in the low twos. In fact, that's down 20 basis points in the past week or so. We would say that the 60-40 model is alive and well. Returns have been quite good this year, call it 7 to 8% or so. We still believe in the hedge value of high-quality fixed income instruments. And I said earlier that we prefer to be overweight credit, overweight equities, overweight private assets, including real estate. But that's not a very balanced portfolio. We would say then that the way to balance that is, of course, through the use of duration, having fixed income in a portfolio, because in the long run, adverse scenarios will affect treasuries in a way that benefits a portfolio, while the other instruments don't fare so well. So we believe in the hedge value of treasuries, and the 60-40 model is still 60-40 model is still big believers in.
That's a shock. I've been terrified to check my IRA over the last couple of years as we continue to hear that the 60-40 model is dead and gone. Why was that? And how come you think it's healthy and surviving?
Well, thinking first of the returns for the year, which are quite respectable, call it 7-8% or so is a fair return. And it's very difficult to surmise that in a quite adverse scenario that longer-term treasuries, and this has been demonstrated in the past week, would not fare well in an adverse scenario. So last week, a microcosm perhaps, when the Dow Jones Industrial Average was falling 500 points, longer-term treasury yields were falling. And this is the sort of behavior we would expect in other adverse scenarios, and they could be prompted by numerous things that are difficult to predict. But we do believe that investors would move in that way. I should add, finally, that the reach for duration is a global story, and this is obvious in Germany, where yields are still in negative territory, and also in Japan, of course, where they're near zero.
All the way out to 30 years, practically.
Correct.
Wow.
And so the reach for duration, the need for it is still high. And the final note is, in 60-40 models, because of the performance of equities, if anything, there's likely to be some adjustments by large pension funds and other investors following it into fixed income, especially given some of the volatility of late.
Tony, got to leave it there. Tony Costanzi, thank you so much.
Thanks so much, Tom. Thanks, everyone.
This morning. Lisa, I want to go back to what you had out earlier this week. You were leading on this, which is the difference in yield between the 5-year and the 30-year. What does that signify?
What it signifies is slower growth long term, that basically people are pricing out that reflationary push that we saw earlier in the year. My question is, how consistent is this, going back to your question, how consistent is this with risk assets rallying? How much do we start to see a lower growth scenario priced into assets that have been flying high on the expectation of perhaps we're entering a new period of time of fiscal spending and low rates?
And you dovetail those two conflicting ideas with the idea of when the money begins to drift away, this wall, this mountain, this Game of Thrones wall of cash that we have. And if that's a long time away, this sustains this really unique position we're in. We're going to stay on this theme through all of surveillance, not only today, but this week, I believe, with a lot of Fed speakers coming up on the pandemic, on India, on Delta. Joshua Sharfstein, John Hopkins, next. This is Bloomberg. Good morning.
With the First Word News, I'm Ruchika Gupta. Authorities in Hong Kong will shorten quarantine time to 7 days for fully vaccinated residents traveling from most places. They're also set to cut the requirement for non-residents who are vaccinated. These are the most significant moves yet to ease one of the strictest border curbs in the world. Other plans include lifting capacity restrictions at some restaurants and swimming pools. The board of Next Digital has reportedly agreed to suspend operations of the pro-democracy Apple daily newspaper in Hong Kong. The move comes after police there arrested top editors at the flagship newspaper of media tycoon Jimmy Lai, and national security officials froze its bank accounts. The board will apply to Hong Kong's Security Bureau to unfreeze the paper's assets and says it will decide on Friday whether to seize Apple Daily's operations. European natural gas extended its unprecedented rally as supply curbs sent prices to their highest level in nearly 13 years. The gains are fueling concerns about inflation. Gas is so scarce in Europe that some utilities have turned to burning more coal, a setback for the fight against climate change. Israel's new foreign minister is set to travel to the United Arab Emirates next week. It will be the first ever visit to the Gulf country by a top Israeli diplomat. Foreign Minister Yair Lapid's visit comes after the two countries normalized relations last year in an agreement brokered by the Trump administration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
And investing in R&D, creating a culture that can do the impossible possible, and investing in digital is key for the success in bringing new breakthrough innovations to the world.
Dr. Bourla, Pfizer, you really wonder, is he going to line up for a Nobel Prize, what Pfizer and Moderna have done to help all of us in this pandemic? Over the weekend, I kept looking for a definitive article on India Delta variant, and that would be Anna Gross, Lila Abood, and the wonderful John Byrne Murdoch in the Financial Times with a tour de force, I believe it was yesterday, on the dynamics of this variant. Joshua Sharfstein joins us from Bloomberg School at Johns Hopkins. Dr. Sharfstein, I'll cut to the chase. Everyone's looking at the United Kingdom, and Lisbon and Portugal seem to be the worst right now on India Delta. Let's start with a why. Why are pros like you looking to the United Kingdom?
Well, because the United Kingdom is pretty highly vaccinated, but is also now seeing an increase in infections, and overwhelmingly these infections are the Delta variant. So this is sort of the next chapter of the COVID pandemic, and just reminds us that for every move that humans make, the virus has another one, and we just have to continue to press the case against the pandemic.
Dr. Sharfstein, how is the Delta variant different from all other variants? The idea here being if you're vaccinated, you're still highly protected against it, right?
Well, you really need both shots to be protected. One shot really doesn't do that much for the mRNA vaccines. That's one difference. But in general, vaccination is the best protection against the Delta variant. It's just that there are still a lot of people who aren't vaccinated, may have decided to wait it out. And that is not a good decision given the transmissibility and the lethality of this particular type of virus.
There is a concern, especially with the prevalence of only one-shot vaccinated individuals in the United Kingdom, of not necessarily Delta, but Theta, Eta, Epsilon. The idea here of all of the additional pile-on variations that could spring up. Are we seeing evidence of any further mutations?
Well, the virus is constantly mutating, so I'm sure there is evidence of that in countries around the world. And as long as that virus has billions of chances to replicate every second, really, then new variants can come up. There constantly are variations in the virus, and the question is which ones make it more transmissible and more lethal. So we're fighting against an enemy that is constantly changing. The best thing we can do is give it fewer and fewer opportunities to do that.
Fewer people are dying, that's for sure. Do you start to think we need to shift what we're counting in terms of counting infections, counting deaths, counting hospitalizations?
Well, those are the big three. And I think, the number of overall cases is a bit of the leading indicator for hospitalizations and deaths. And fortunately, as there are fewer people, people can get more intensive care. There are different treatments and hopefully more treatments coming. But our goal should be to prevent, as many infections, hospitalizations, and deaths as we can. But we should be looking at all three, I think.
When you look at a map, Doc, of the U.S., are there places you think that are vulnerable to a UK-type resurgence? Because surely we've got the coasts vaccinated, but the middle may be a problem.
Well, I was just in the American South, and there's not a lot of mask wearing, but I also know that those states have relatively low vaccination rates. So that combination of low mask wearing, low vaccination rates, and people thinking the pandemic is over or was overblown or something like that, that's a dangerous combination. And we know that the Delta variant is going to be spreading there pretty soon.
Dr. Sharfstein, late in the Padres game yesterday against the Cincinnati Reds, Myers of San Diego hit a ball down 4 feet inside the foul pole. He went to third base, there was a throwing error, and then he ran home with what's called a Little League home run. The roar of the crowd shocked me. That's how much we've been affected by this pandemic. Would you sit in that crowd?
Outside, I would probably sit in a crowd like that. I think that, I'm vaccinated, and vaccines are very effective, and the virus doesn't transmit that much outside. But, people who aren't vaccinated, aren't wearing masks, or inside at the concession stands, they could pick up COVID, particularly the Delta variant. So I don't think that's such a safe environment necessarily for everyone, the bathrooms, other places, in the ballpark. So, it's just that we're not there at the point where we can stop thinking about the COVID pandemic. We should be, the end game. This is like the end of the game. We need the closer to come out, to take your baseball analogy, and pitch some strong innings at the end in order for us to really move past that. And that means really helping talking to people in your life, helping them get vaccinated. That's really, really important for us to put this in the W column.
Here's Dr. Sharfstein channeling the Baltimore Orioles there and their quality relief staff. Dr. Sharfstein, thank you so much for joining us today from Baltimore's Johns Hopkins University. Matt Miller, it is time for the obligatory Bitcoin talk. Bitcoin rolls over. Bloomberg reporting out of China that it's basically the Chinese government going further. How critical to you within the synthesis of this is a support at 30,000?
Well, the support at 30,000 is critical, and technicals, which I've never really thought too much of. Matt Winkler famously didn't think too much of technicals. They're really important in something like Bitcoin because there are very few fundamentals to trade on. But I'm not sure how much China's crackdown on mining has to do with this. It also has a lot to do with the reflation, deflation. And keep in mind that the Chinese... Yeah, sure. The Chinese people are still huge buyers and huge users of Bitcoin. And if you look at all of the unicorn startups that we've been reporting on recently, they're all out of China. They're all based in Hong Kong.
Yeah. Lisa, I was sitting on Fifth Avenue having the obligatory cigar, and there was the Porsche that pulled out onto Fifth Avenue, and I thought of Matt Miller.
Matt Miller.
Responsiveness.
Obligatory Porsche.
Responsiveness. What, the price goes up and you buy more? Is that the responsiveness
of Matt Miller? No, they're more responsive cars. That's why they're better. They're more responsive. And now they're sourcing their own batteries near Stuttgart, so they'll be even more responsive than any central bank.
See the enthusiasm, Lisa, we get out of Miller when we start with obligatory Bitcoin and obligatory car talk.
Yeah, he just lights up.
It's like a different person.
Well, I mean, I would too if you bought me a Porsche.
Matt, did you survive Father's Day?
I survived Father's Day. Actually, for the first time in my life, my dad called me to wish me a happy Father's Day.
So that's the best news of
very
the day.
Cool.
That is.
Very, very cool.
Yeah.
Very, very cool.
Well, happy Father's Day to both of you. It was a lovely day. Nice and sweltering. Tom Keene, you buying Bitcoin?
God, no, I'm not buying. Well, I don't know. You know, I'm looking for an entry point on Amazon. It's Prime Day. I'm primed.
Yeah. So is Afterthought.
I might buy a fractional share.
Yeah.
Matt Miller, thank you for joining us in this hour. Greatly appreciated. From Berlin, coming up on the Fed speaking this week, we got the perfect guest to start strong in the 7 o'clock. Ben Emmons will join us, some Medley Global Advisors. On radio and TV, please stay with us. The 10-year yield, 1.43%.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents. which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here. Have you
Commodities are up.
Keep going.
To the moon.
No.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We still see there being more to go in this restart narrative.
It's still being affected by concerns about COVID.
The biggest risk for me is that I underestimate how much inflation is going up.
The Fed doesn't know either when this transitory notion is going to go away.
The Fed has to be very careful about its communications, not just verbal communications, but all types of communications.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. We welcome you on a day of turmoil in the markets. There's no other way to put it. Equities, bonds, currencies, commodities all have a dynamic story to tell. And all of this around Fed speak this week. It's a theme this hour. Ben Emmons to join us in moments. Lisa Abramowitz, let's just get down to it. First, do no harm. What does the Fed not want to say this week?
I don't know. I mean, honestly, I don't know what message they want to send. I don't know. Maybe they're doing a victory lap because, frankly, they've injected a little bit of caution into markets without creating turmoil dramatically so anyway. And isn't this what they wanted in order to avoid some sort of bubble or asset price fears, Tom?
Last week, my data checks were lousy as voted on by the senior management of Bloomberg. So Kaylee Lines joins us this morning to straighten me out. Kaylee, thank you so much for being with us. I thought the early morning hours in London were very valuable talking about the markets. And the center tendency for me is Steve Major and the team at HSBC still predict a 1% 10-year yield.
Got a little more ways to go down to 1%, Tom. We're looking at a 143 this morning, but I would say the picture right now at 7:30 Eastern time looks a lot different than it did when I came into the office around 3 a.m.
Really
then futures were lower. We had a flatter curve again. The 30-year yield, I should say, broke below 2%. Now the story looking very different. We are back above that level on the 30-year. We have a steeper curve and futures right around the highs of the session, Tom.
Lisa, I want to get to this before you do the brief, and to me, it's just real simple here. It's the wall of money that's out there. Tony Crescenzi of PIMCO addressed that. It's truly trillions of dollars, and the when of that moving is the arch debate, isn't it?
Well, the idea here of where is it moving to, right? If we've got the ball of money that was rolling around China, it's now rolling around the entire globe. And we have all of this money. At what point do people move into risk assets? At what point do people actually just buy stuff and buy experiences, Tom? And we are starting to see that, but perhaps not as much as people expect.
If you're confused, well, join the crowd. I'm confused too, and Ben Emmons with us in a moment. Let's do the data right now, Kaylee Lines. I'll pick the equity market because it's easier. Futures up 19, Dow futures up 200. The VIX goes out to 20.19. Kaylee, what do you see in the spread market and in bonds?
Well, in bonds, I'm looking at a 10-year yield that is going nowhere from Friday's price, Tom. 1.43% right now on the 10-year yield. After it was pretty substantially lower earlier, we were right around 136 at one point around session lows. And of course, that 30-year yield, the longer end, has been really getting a bid over the past several days, and that is is not continuing today, Tom. We get a steeper curve, not a flatter one.
The 10-year real yield, that's important to a lot of our viewers and listeners, negative 0.81% on that real yield. Again, we'll dive into that in a moment. Right now, I think on a Monday, it's 50-50. Let's get briefed.
All right, is it 50-50? We're going to go 50% yes. Let's get it briefed. You know, Tom, you asked one of the key questions. What message does the Fed want to be sending? Perhaps we get some sense of that. Today, we get a slew of Fed speak, including James Bullard. Jim Bullard had a very hawkish tone on Friday. Will he continue with that message? John Williams of the New York Fed and Robert Kaplan of Dallas. Really, the question to me is how much dispersion is there among the different members on the Federal Reserve? Is there a consensus forming that inflation really is a significant concern and should outweigh letting the market run hot enough to get employment to a full enough picture yet to be determined? 1:45 p.m., President Biden is meeting with financial regulators. They're going to be talking about climate change and how this could affect the financial system. What kind of existential risk is being posed here?
Wait a minute. Is he going to talk to Gensler about meme? About GameStop?
Presumably, he will go beyond the purview of just global warming, but it's being headlined as that being the major focus. But yes, I would guess that he would be talking about a whole host of issues that are a threat to the financial system right now, especially due to all of that cash sloshing around, some people getting concerned. We have an excess, a glut of cash. What happens if that reverses suddenly and we get a shortage of cash? How do these flows really get translated in an unprecedented time? And also today we have, of course, the Bloomberg Qatar Economic Forum, a host of really key speakers, Ray Dalio, Larry Summers, Stephen Schwartzman, you name it, they are speaking. My question is, how do they look at inflation down the road? How do they look at the Fed's reaction function? And is cash still trash, as Ray Dalio famously said a little bit more than a year ago? Is there a sense we are in a new regime after printing all this cash, or are people backing off that, Tom?
As Kayleigh Line said, red on the screen earlier, now green on the screen. S&P futures, other S&P up 20 points. Ben Emmons was booked. We said, yeah, okay, great. 7A slot. It's wonderful to have Ben Emmons with us on this Monday. And then things blew up on Friday. So this is a genius booking of Benjamin Emmons and Menley Global Advisors with an important research note over the weekend. What'd you write?
Yeah, Tom, I was looking at the dynamic of the curve on Friday, and it speaks to that you get guidance actually through the dot plot, which was different in 2013 when the Fed actually didn't do that and yields jumped. And so the opposite effect then happens on the long end of the yield curve that says, okay, maybe these future rate hikes are sufficient to control inflation around that 2%. So the market has given some credibility on that front to the Fed. But there's also a lot of technicals at work, as you probably have talked about with Tony. You know, this positioning that took place prior to all this flattening that we're seeing was really predicated on that markets were expecting a growth rate.
Folks, this is what we do. When we invented surveillance, this was a couple months ago, when we invented surveillance, we said what we want to do is get a short-term guy like Crescenzi on the show and then get a long-term guy like Emmons as well. Parachute into Crescenzi's market. Long-term people like you and, frankly, Jerome Powell, what do they think of trillions of dollars in the Crescenzi space, overnight repo, and the rest of it?
So it's not only substantial, but it will continue to compress short-term interest rates over time. As much as you want to communicate that you're going to raise rates, you cannot really expect this two-year yield to jump all the way out to this projected rate that the Fed has put out. I think it's more like a very slow normalization. And markets know this, actually, because we experienced this in 2014, too, when we went really slowly with the two-year yield over time. I think that's what you can expect. Whereas on the long end of the yield curve, it's this dynamic, I think, of a technical positioning and the fact that, you know, maybe these rate hikes are sufficient to keep inflation in the future under control.
All right, so if it is technical, are we almost through with the technicality, Ben? Are we moving into a period where perhaps long end rates can possibly rise on the prospect of less Fed accommodation?
I think, Lisa, that the rates communicated this time compared to 2013 is that, you know, we were missing guidance on rates in 2013. And if we have this idea now that, okay, it's going to go that trajectory, you take out some of that risk premium out of the long end. At the same time, to your point, probably there's some scope for rise in long-term rates as new data comes in and surprises still to the upside. You know, let's face it, we have an economy that's really strong. It's not normal to have rates at these low levels. It's, as we talked about a few weeks ago, it looks like dislocated. So I would think the next payroll report, even the core PCE data that comes out this week, surprise to the upside, probably a catalyst for rates to somewhat normalize again back to inside the rates where we came from.
Ben, did we already get the taper tantrum? Was that what March was?
Maybe, Kaylee, but there's a definition about this taper tantrum. In 2013, it was really a communication that confused markets and led to this repositioning on, okay, we didn't really expect you to go this fast with ending QE and then moving to rate hikes maybe in the future. So in that respect, the Fed, I think, has done a really good job controlling that aspect. But I think what the markets were not expecting last week was to see this dot plot shift. And I think what really happened on Friday was just completely recalibrating what we saw in March, where the expectations for rate hikes were the same as they are now today, with now the difference that the markets understand what the Fed is potentially planning to do, including working towards this start of the tapering process.
Well, Ben, to Kaylee's point, though, isn't it surprising that you're not seeing a bigger wobble in risk assets, given the fact that people are starting to think about tapering sooner?
I think there's two things going on, Lisa, because yes, tapering means removal of accommodation over time, but we also have to discount the fact that the Fed is still super accommodative. Right? We will continue to buy $120 billion a month, which, by the way, larger than in 2013 when it was like $85 billion or so. So we're going to continue on that pace for at least a number of months, if not longer, until that tapering actually happens, maybe presumably in 2022. So you're looking at a balance sheet that's going to extend beyond $9 trillion.
Very quickly here, we're out of time, Ben, but very quickly here, what do you need to hear from Fed officials in the coming days, including today?
I think you want to hear that what they've put out as projections is what we call a bullish forecast. They're looking at the economy will be protected here against this surge of inflation. And this forecast that they put out on the dot plot has always been considered to be an individual, that's re-emphasized, right? They are still at the starting phase of considering future normalization.
Ben Emmons, thank you so much with Medley Global Advisors this morning. Lisa, I look at the bond dynamics. What's the part of the bond market, Lisa, you look at right now within the 47 spreads you look at and the actual nominal and real yields? What matters to Lisa Abramowitz?
The belly of the curve. That's where people were looking in terms of whether there was potentially value there. And I know you're looking down, Tom, but that's not my implication. I'm just saying that people were looking at the idea that 5-year yields climbed to the degree that they did disproportionately, and whether that was perhaps a place of value. I think that is an interesting conundrum in the bond market.
Kaylee, you'd like to jump in here and insult me as well?
I would never.
Kaylee. Oh, you'd love to.
Don't let his insecurities get into your head. Go ahead, Kaylee.
I would never insult you, Tom, but Lisa's watching the belly of the curve. I'm watching the longer end, and of course the dynamics between the two. Is the flattener over? Was yesterday or last week's really dramatic action all we're going to see with the steepener coming in today? I wonder how much longer that trade is actually going to persist.
Okay. How'd she get on the show? Kaylee,
someone let me in.
Let you.
I don't know. Take it up with management.
Thank you so much. Oh, I will. Thank you so much, Kaylee, for joining us. And we look forward to the coming minutes as we flatten her and steepen her and the rest of it as well. These are serious conversations, folks, and seriously, our economic team is really steeled for the Fed coverage this week. So I believe John Williams is on the docket today, and that's always important. The gentleman who gave us the gift of our star, it keeps on giving. The VIX 20.29, futures up 17, Dow futures up 185, NASDAQ up 0.4%. Stay with us on radio and television. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. National Security Advisor Jake Sullivan says the U.S. is working on additional sanctions against Russia for the poisoning of opposition leader Alexei Navalny. President Biden said he raised Navalny's case with Russian leader Vladimir Putin during their summit last week and made it clear that Russia would face consequences if Navalny died in prison. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness nearly $21 billion of annual R&D spending to find solutions for the public good. The new Office for Science and Technology Strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. The Tokyo Olympics will limit the number of spectators to 10,000 people per venue to reduce the risk of the world's biggest sporting games turning into a super spreader event. The organizing committee chief says the number will be set at either 10,000 or 50% of venue capacity, whichever is smaller. And President Biden's administration has rejected Venezuelan leaders Nicolas Maduro's call for relief from U.S. sanctions, saying he needs to do more towards restoring democracy. Venezuela was a target of crippling American sanctions under former President Trump. Maduro reached out to Biden in a Bloomberg interview last week, calling on him to lift sanctions and normalize relations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
What is is more surprising is the degree to which the Fed is linking themselves to realized inflation data that they themselves are suggesting will be transitory. To me, this isn't really a change in their monetary policy strategy or reaction function. This is actually an execution of that strategy to focus on realized data at the expense of forecasted data.
Matthew Hornbach of Morgan Stanley there, among other voices. I really can tell you, folks, it is a market day out there. There's no question about it. Read on the screen earlier when Kaylee Lines entered the door, and we've really seen a very nice advance. Kaylee, what's the why for the green on the screen that we have?
I don't know. It started at the European Open, Tom. The European Open was down about 0.6% for the stock 600, and then you saw that bid coming in, and with it we saw futures now right around session highs climbing, and that was after a really ugly Asian session. So I guess the question is, was Asia playing catch up to what we saw here in the U.S. on Friday? And now we're seeing some of those reflation bets, maybe a little bit of dip buying happening, Tom.
And Lisa, in the short space, I mean, LIBOR OIS is really not much of this, but that overnight repo surge that we saw over the last week has just been extraordinary. It's really unprecedented.
I mean, this is the conundrum right now. We have so much cash in the system. Banks don't want companies' deposits. They're actually going to charge them for it. What happens with all of this? I mean, how much does this just suppress all bond yields and keep risk assets elevated? Can this continue indefinitely? Or at what point does it have to stop?
Two things off the chart. Oil this morning still rounded up, $74 on Brent crude, 73.56. And I really want to note new weakness in Turkish lira, maybe not out to a true record, but at 8.78, I would suggest with the velocity of the move, we're on the 8 lira to the dollar watch. I've never said that before. Emily Wilkins with us out of Washington. And buried beneath the fold and beneath the second fold and beneath the third fold is the strange thing of infrastructure, which we've been focused on. I mean, Emily, it's not Iran. It's not Biden back from the big trip to Europe. It's not the rest of it. It's not even the Washington Nationals relief pitching. What's happened to infrastructure? On this Monday, what gets done on infrastructure?
So look, there's Monday, and then at the end of the week, there's Friday. And after Friday, the Senate and the House take off for that July 4th recess. And that means that, once again, the pressure is on President Biden to make a decision here about how the Democrats go forward. 21 senators, bipartisan group, have offered a $1 trillion infrastructure plan. Now, the details still aren't clear on how to pay for this. They've talked about a gas tax. The White House has said no way on that. And so there's still a bit of a question about working out the details on that particular thing. But there is an interest from the White House in potentially going forward with this bipartisan deal. The question then becomes, how do Democrats move forward? Do they wind up two-tracking the bipartisan deal and a larger infrastructure package? How do they get senators like Bernie Sanders on board, who's not happy with that bipartisan agreement because it doesn't have enough for climate change and other priorities? So lots of questions here, but they all start with answering that one: does President Biden want to shake hands and make an agreement with these bipartisan senators and get a bipartisan bill done?
Emily, let's talk numbers, especially as we talk about the Fed potentially tapering its stimulus. President Biden is reviewing a $579 billion plan. This is the bipartisan plan. It is a far cry from the $1.2 or the $1.9 trillion plans previously proposed. Is this what we're looking at now? The more likely situation where we see a sub $600 billion plan passed and then a battle into other priorities?
Well, here's the thing, Lisa. Even if they do wind up saying, yes, let's go ahead with that $597 billion bill, Democrats are still going to want to pass another trillion-plus legislation. And that's going to include things such as the child care, child tax credit, expansion of Medicare, potentially things like preschool. And so the fact of the matter is that even if they pass this smaller bill in a bipartisan manner, Democrats are going to want more.
Well, Emily, they're going to want more. Whether they will get more is another story. And I'm talking about the Fed in tandem with the fiscal spending, because people are starting to worry about inflation. And it's not just monetary policy members. It's also the folks down in Washington, D.C. It's also people who are going to the gas station and seeing more in terms of the price at the pump. At what point has President Biden run out of room for his most ambitious spending plans as people look at an economy that's getting back on track?
when you talk to Democrats and you talk to them about inflation, they'll pretty quickly pivot the topic to saying, hey, we got elected. The American people elected Democrats. We control the House. We control the Senate. We control the White House. And they want to get something big done before those 2022 midterms. I mean, I think that, particularly for progressive Democrats, that's where their eye is on, perhaps a little bit more so than inflation. They feel that if they can get something big done, they stand a chance to win in a midterm election that is heavily favored toward the Republicans. And that's something that they're thinking about very much. I'd say even a little more so than inflation at this point, particularly as you hear individuals like Treasury Secretary Janet Yellen still downplay the potential risks from inflation.
Well, Emily, yes, the Democrats do control the House, but not by an overwhelming margin. And you speak of progressives wanting to spend more. Frankly, are Democrats going to be on board with a smaller bipartisan $579 billion proposal?
Lisa, that is the trillion-dollar question here. I mean, a number of progressive Democrats, including Senator Bernie Sanders, have already come out saying that they're not on board with this bipartisan plan. Now, that could potentially change if they come to some agreement saying, look, go ahead and vote for this bipartisan deal, and we promise you, we guarantee you we're going to be passing another larger reconciliation bill. That's what a number of progressives are looking for right now. But you're very right in calling out the fact that the House has a very slim majority. Democrats can only lose 4 individuals there before they're not going to be able to pass anything. So as you're looking at your Joe Manchins and your Kirsten Sinema's, you also have to keep an eye on your AOCs as well as your moderate Democrats, many of them who are going to be facing really, really tough re-elections.
Sounds like a new quote for gridlock. Emily Wilkins, thank you so much. In Washington, an eventful week to be had. We'll have full coverage here through the week as well. Lisa, you know, we talked to Matt Miller, and I guess he went out and sold it all. Bitcoin really has lost the bid under 32,000. I'm going to call that not a quote of the moment. Really, a 29,000 quote would be far more important. But nevertheless, Bitcoin can't find a bid today.
Well, what Matt said was interesting, that it was more a risk-off tone, and perhaps the Fed taking accommodation out of the market, a move away from this regime of ever printing money and expanding the monetary system, that was more the reason why there's been this sell-off in Bitcoin. If that's the case, Tom, why are we not seeing a commensurate decline in other risk assets? Why is it so isolated to Bitcoin?
Linked.
But that's interesting to me. How is that possible if Bitcoin is considered the marginal risk-taking measure, and you've got the likes?
It's considered that by people that support Bitcoin. I don't hear that from people that question Bitcoin's veracity.
Well, but then you've got the likes of Troy Gajewski saying this is the key macro bet and the key potential for the outperformer or the underperformer in your portfolio. And there is, of course, also a degree of regulatory scrutiny, particularly from China. I don't know.
And Kaylee, what'd you learn about Bitcoin? I mean, Matt Miller wanted to do one of those hours all on Bitcoin, didn't he?
Oh, he did. That would be his choice. 5 a.m., talk about Bitcoin for an hour straight. I would say keep an eye on the technicals, Tom. Death Cross. Just watch it.
Oh, listen to us.
Bitcoin
the Death Cross.
And Death
Coming
Cross.
up, Kaylee Lines on the Death Cross.
I think a little piece of me just
Gene
died.
will join us. Well, stay with us. Futures up 13.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Bloomberg Surveillance, good morning, everyone, on economics, finance, investment, and yes, trillions of dollars of cash sitting out there and what it means for the Fed optionality out the next couple of years. Tom Keene and Lisa Abramowitz, Kaylee Lines in for John Ferro today, in for Romaine Bostic, in for Taylor Riggs, and Matt Miller and 47 other people as well. We'll get to Kaylee in a moment. Lisa Abramowitz, I look at where the markets are today. It's not a normal Monday, is it?
No, I think people are trying to understand the Fed's reaction function, to use your phrase. And honestly, this dissonance between lower yields indicating slower growth, yet a bid into risk assets that I just am not understanding the permanence of, Tom, heading into a choppy rest of the year.
I can't convey the surprise that's out there. George Saravelis at Deutsche Bank writing about R-starred. John Williams will be a speaker today, the inventor of all that with his Kasten group at San Francisco Fed years ago, now at the New York Fed. Kaylee Lines is with us on the equity markets and on a company from Sioux Falls, South Dakota, Raven Industries. Kaylee.
Yeah, a little M&A in the ag tech space this morning, Tom. Raven is getting bought by CNH Industrial for $58 a share, and in pre-market trading, it is trading almost at that level right now, $57.69, up about 49%. Of course, that price tag was a 50% premium to Friday's close. Another stock surging in early hours is Torchlight Energy. This is one of the new favorites of meme traders on Reddit. Once again, getting touted on Wall Street Bets as a potential short squeeze. I'm doing my best Romaine Bostic impression. That stock is up around 40%. AMC getting a little bit of a bid as well. And CureVac, some dip buying for a second day. Remember, it fell 38% last Thursday after that poor efficacy data from its COVID-19 vaccine trial. It was however, bought on Friday. It's being bought again this morning. And we were just discussing Bitcoin, blame the Fed, maybe pulling some liquidity out of the market eventually, blame China. Whatever it is, Bitcoin is moving lower. And as a result, it is dragging on stocks tied to Bitcoin in pre-market trading. Marathon Digital, MicroStrategy, Riot Blockchain, all down more than 8% at this point in early hours. Coinbase, of course, the cryptocurrency exchange, also down by about 3%, Tom.
Thank you so much. Right now, a very cogent note. Everybody publishing over the weekend and the follow-on on Fridays, challenges within the market and the oddity in the Asia opening today. And then over we are now to futures up 14. They're up a little more earlier. Gene Tenuso with us from Columbia Threadneedle. And Gene, I love it. And I'm going to pick up here and steal from Lisa. I'm really good at stealing ideas from Lisa Abramowitz, particularly on a Monday. And that is the dispersion of the Fed decisions to come. And you suggest that this is original uncertainty. Discuss the challenges these many Fed officials have.
Well, I think you're right, Tom. And if we look at those dots for 2023, the market was obsessed last week that the average Fed forecaster was predicting higher rates than we would have otherwise expected or previously expected in 2023. But that dispersion is exceptionally wide, including some Fed officials like James Bullard who expect higher rates as early as next year. And I think what the market is trying to grapple with here is trying to figure out, is the Fed actually committed to average inflation targeting? Now, remember last year when this was introduced as a policy reaction function, they basically said, we're not going to focus on short-term realized inflation. We're going to be focused more on long-term inflation expectations. And these bumps in the road, this noise, we're going to consider that transitory. And they kind of blinked and they said, no, actually, we're reacting now, or at least making an adjustment to our forecast based on short-term realized inflation. And I think the market is confused by that.
When you say they, it's really a view of a number of separate officials. This idea of disagreement on the Fed leading to elevated Fed decision uncertainty. How much is this being priced in? What are the market implications of this disagreement that we're seeing brewing on the FOMC?
Well, we're seeing the market bring forward those rate hike expectations. And actually, the market, for the first time in a while, is probably pricing in a more aggressive forecast, a more upward forecast in interest rates than what the Fed itself is predicting. But I think if you're the Fed, as much as they do have disagreement and there is uncertainty, they have to be pretty happy with the financial market outcome, quite honestly. Because when we were talking, for the last several months, one of the biggest fears was a taper tantrum. And a taper tantrum where yields shoot higher and you see, imbalance in risk assets like stocks and credit spreads. And now as we look at where yields are, and as you talked about earlier, the long end has actually come lower, if anything. We've seen some inflation premium drain out of the market, and credit spreads are still exceptionally tight, and stocks are within spitting distance of all-time highs. So as much as they've communicated uncertainty and there's still a lot of unanswered questions, I actually think Fed officials are probably pretty happy with where financial markets are at this stage.
Gene, is a taper tantrum off the table?
No, I don't think so. It's just delayed at this stage because we still don't know, remember, Lisa, what is substantial further progress in the labor market. That's a key variable that they have defined and put in their statement, and that's something they need to define for the market over the next several months.
Gene, you talked about how tight credit spreads still are. I think 286 basis points or so for high yield. At what point do we get the read-through and those start to widen out?
Well, look, we always look at three things when we look at credit spreads. We look at the fundamental environment, the technical backdrop, and valuations. What are you being paid? And valuations are the most challenging. And when high yield spreads are inside 3%, historically, that's not a very good time to get into the market. But the technical picture is still robust, and fundamentals are as supportive as they could be. On the fundamental side, we're trying to look beyond the reopening bump and see what sustainable growth looks like. I think there could be, a little bit left in this carry trade, but I think it's pretty dicey to really load up the boat on high yield at this stage. We much prefer shorter maturities within the high yield space.
So elaborate on that. What do you put in a fixed income portfolio right now?
So we'd rather be diversified amongst shorter maturity, high yield securities, a mix of securitized products like mortgage and asset-backed securities that can benefit from the strong state of the consumer. And what we would not want to be exposed to would be things like longer maturity investment grade bonds where there's really no price upside at this stage in our view. And those sort of volatile components can really detract from return.
Gene, within all this is we got to make a decision. Is this the time to reallocate, or is this the time to sit in your hands?
Well, I think the best thing you can do is stick to your rebalancing discipline. And this was something that we learned in early 2020 before the pandemic as well, which is even when interest rates are low, if your equity portfolio has appreciated to pretty high levels, or your risk asset portfolio, rebalancing to whatever your neutral allocation is a pretty healthy thing to do. And typically when credit spreads are this expensive and equities are this high, an allocation to high quality fixed income is still beneficial, and it's something that will help you in the long run from a diversification standpoint.
Well, that's fine. I mean, we can diversify out as much as we want, but as Lisa's mentioned throughout the show today, you go back to the 60-40 model. In the bond market, I don't have a clue what's happened. I mean, Steve Major at HSBC and his team is telling me to load the boats on bonds.
Well, I don't think you can just look at the bond market and say low interest rates are a bond market problem. I mean, we really think low discount rates are going to be with us for a long time. They affect all financial assets. It affects credit and it affects equities, and it explains part of why we're seeing the elevated valuations we are elsewhere. I don't think it changes anything in terms of that discipline, whether you're neutral, be 60-40 or any other balance.
Gene, what's your biggest concern going forward if it isn't a taper tantrum, if it isn't perhaps inflation getting carried away because the Fed is going to step in? Where is the concern at this point?
Well, all the focus right now is on the tailwinds, Lisa, and those tailwinds come from fiscal. Those tailwinds come from the Fed. Those tailwinds come from reopening the economy with all this excitement. I'm a little bit worried about next year and the headwinds that start to come into place. I don't think fiscal is going to be as helpful next year, particularly if we're talking about higher taxes to pay for the infrastructure plans that were just being discussed. Monetary policy is going to be going the other way, likely with a taper in the beginning part of the year, and we'll really be exposed to whatever the underlying trend in growth is. And we really don't know what that is at this stage. So I think when tailwinds become headwinds and you're already expensive in the market, I just think you got to be a little bit careful out there.
Gene, thanks so much. Gene Sanuzzo with us today with Columbia Threadneedle. Kailey Leinz, Lisa Abramowitz, and Tom Keene, thrilled you're with us this morning. Lisa, I'm going to go to the John Williams R-Start idea. Sarah Vellis writing this up for Deutsche Bank, and the wonderful tension between Sarah Vellis, more short-term at Deutsche Bank, and David Folkerts Landau and his team, more long-term analysis at Deutsche Bank. And it just comes down to this idea of R-Start and its link into what economic growth will be. To me, that's the major focus.
Well, just in plain English, we just don't know where inflation is going, right? I mean, that's ultimately.
We also don't know where the economy's going.
Well, but that's key, right? We just don't know how this is going to extrapolate out into the future, whether the fiscal impulse will continue. I mean, honestly, we've been talking all of this time about potentially withdrawing monetary stimulus. But what are the implications of a much smaller fiscal spending package in Washington, D.C., which looks increasingly likely? Is that priced in? How much have we already moved back to the old regime that we're used to, Tom, which is slow growth, and now we've got more debt that will slow it further.
Kailey, what research did you see over the weekend or into this morning that caught your eye?
I'm looking at oil, Tom. Francisco Blanche out of Bank of America calling for $100 a barrel next year because of the extent.
This?
Well, I'm telling you now, Tom.
Hell.
I had to build up to it.
Kailey's hiding secrets from us. I mean, Francisco Blanche at 100, and I'm hearing about it right now.
Well, that's the call, Tom. Demand is going to outstrip supply is the basic thesis from Bank of America. And of course, this is where the Iran conversation comes into the forefront. We know those talks ended in Vienna without a deal after the 6th round. Are you going to need Iranian supply to come back onto the market to meet all of this demand we're seeing as the world reopens, Tom?
I think she's one-upping us.
With $100 barrel oil? I hope so. We need some one-upping this morning on this Monday morning. I think it's a great thing to bring up, the idea of, are we going to see higher oil prices, or are we going to see them go down as people basically reprice the reflation trade? Are these coherent trades, given what we're seeing in the bond market?
It's that lonely idea, Lisa. Chris Verone of Strategas talking about $80 as a target, and I would suggest nobody's really framed $80 yet. And then there's Kailey Leinz showing us up this morning.
Triple digits.
Out at Francisco Blanche and 100.
He's not alone. There are other analysts as well.
Can this not happen again?
Thumbs off.
I'm asking.
Kailey, it's fabulous to have you. Happy Monday, and
Futures
thank you.
up 14, $100 a barrel. How do you spell her name? Kailey?
Really? Really, Tom? Happy Father's Day.
Yes.
With the First Word News, I'm Rishka Gupta. There's political chaos in Sweden after Prime Minister Stefan Löfven lost a confidence vote in Parliament. That toppled his minority coalition and leaves the leader with 1 week to decide whether to call snap elections. If Swedes are forced to head to the polls early, it would be the first time since 1958. Authorities in Hong Kong will shorten quarantine time to 7 days for fully vaccinated residents traveling from most places. They're also set to cut the requirement for non-residents who are vaccinated. These are the most significant moves yet to ease one of the strictest border curbs in the world. Other plans include lifting capacity restrictions at some restaurants and swimming pools. The board of Next Digital has reportedly agreed to suspend operations of the pro-democracy Apple Daily newspaper in Hong Kong. The move comes after police there arrested top editors at the flagship newspaper of media tycoon Jimmy Lai, and national security officials froze its bank accounts. The board will apply to Hong Kong's Security Bureau to unfreeze the paper's assets and says it will decide on Friday whether to seize Apple's daily operations. European natural gas extended its unprecedented rally as supply curbs sent prices to their highest levels in nearly 13 years. The gains are fueling concerns about inflation. Gas is so scarce in Europe that some utilities have turned to burning more coal, a setback for those fighting against climate change. Israel's new foreign minister is set to travel to the United Arab Emirates next week. It'll be the first time ever to visit the Gulf country by a top Israeli diplomat. Foreign Minister Yair Lapid's visit comes after the two countries normalized relations last year in an agreement brokered by the Trump administration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
If we're going to believe in a positive structural outcome from this awful pandemic, is for that real yield to become far less negative. It can't stay here. This is not sending a very positive discount.
Patrick Garvey on the battle of inflation-adjusted yields there. Right now, the 10-year real yield and negative 0.81%. We welcome all of you on radio, on television. Lisa Abramowitz and Tom Keene. John Farrell's off today. We're thrilled that Kaylee Lyons could join us this morning. What we're trying to do on the markets is give you a cross-section of views across assets. Ira Jersey will be joining us scheduled in a bit. And then Jane Foley at the last moment has come on board from Rabobank. Really pleased that Jane Foley could join us today. Right now, all of this market action dovetails into the banks. There has never been a crisis like this in the career of Gerard Cassidy. He's with RBC Capital Markets and joins us right now. He has seen this before angst and hand-wringing. What does all this uproar, Jerry, mean for the big banks?
Tom, you're right. And we've been through a number of different cycles, and each one has a different side to it. But this one is quite interesting because we've not seen this low rate environment persist for so long, particularly on the long end of the curve, with the likelihood of inflation heating up to levels possibly we haven't seen in over 25 years. So the industry right now is grappling with an excess amount of liquidity caused by the quantitative easing by the Federal Reserve. As you know, Tom, the Fed's balance sheet now is over $8 trillion. And that's up from $4 trillion prior to the pandemic. And that's gone into the banking system, which is weighing on their margins along with this rate environment.
You know, I looked, Gerard, and we were talking about $34 lobster rolls as we were coming on with Gerard Cassidy of Portland, Maine. And I guess the question is, when you see a pullback in JP Morgan of 11% or other selected Cassidy stocks, is it time for Gerard Cassidy to load the lobster boat?
I think it is, Tom. In fact, this pullback is a great opportunity for investors to buy bank stocks, whether it's JP Morgan Chase or Bank America or any of the large regionals like a PNC or Truist. And you're right, Tom. If you believe that the U.S. economy is truly growing at 6 or 7% and throw in 3 or 4% for inflation, loan growth historically, Tom, going back to the 1940s, is correlated to nominal GDP growth. And loan growth hasn't shown up yet because of the liquidity of corporates and consumers. But over the next 12 months, we do expect to see loan growth with the growth in the economy the way it's projected today.
And Lisa, this is so important. You know, a grizzled pro like Cassidy, who remembers that a lobster roll was $3.40. And Lisa, I'm sorry. The fact of the matter is he's looking out 12 months, not 12 hours.
Tom, I love that your priority right now is a lobster roll. I am right there with you, Gerard, talking about the liquidity beyond perhaps the beverage of your choice to accompany a lobster roll, but rather the liquidity in the financial system. You talk about extending loans, the idea that there's $3.9 trillion of cash, of reserves at the Federal Reserve versus pre-financial crisis of $46 billion on average, a complete magnitude change. What is the trajectory of getting that money into lending at the same time that people are drawing down their deposits and actually spending that cash, perhaps taking that cash out of the banks and into the economy?
No, that is the key metric, and you're very observant on the numbers. And I would suggest that that's what the banks want to do. The banks, as I try to remind myself and investors, banks are in the business to lend money. They want to lend money to qualified borrowers. And right now, the demand's not there. But as the liquidity is used up, and remember, the consumer has a number of benefits that are expiring in the fall. For example, if you're a student and you're deferred your loan payments, that expires in the fall. So I think you're going to find people are going to use up their stimulus payments to help with their monthly cash flows and then revolve back onto credit cards, which we're starting to actually see. So maybe they are buying those lobster rolls, Tom, for $34.
Maybe people are buying lobster rolls. I wonder if companies are going to start buying other companies because, yes, the consumer balance sheet's looking pretty healthy, but companies have a lot of cash on hand as well. And Jamie Dimon last week in talking about the fact that, okay, yeah, trading isn't going to be as great, look to M&A as a driver. How much of a growth catalyst do you think M&A will be for these banks?
You know, that's a real good question. And I think it will be a real driver because as corporates become more confident that the U.S. economy is out of the downturn that we experienced last year due to the pandemic, they will have more confidence to either build new plant or equipment or go out and buy a competitor to become more efficient. So we do see that as being one of the accelerants to loan growth, along with regular corporate loan demand. You know, the building of all the new green initiatives, whether it's electric vehicles and other things, those too are really demanding corporate borrowing, and that too will pick up as, again, confidence comes back into this economy.
Gerard, how much does your buy banks call get threatened by a flattening yield curve, as many people now are looking at the consensus call as being that continuing?
No, that is a risk. I don't disagree with you whatsoever. If we're chatting here a year from now and the 10-year government bond yield is 110 basis points or 120 basis points, and there's more talk of the Fed raising short end that would be a very challenging bank stock environment. I don't disagree with you.
Jerry, I don't care. What I care about, Gerard Cassidy, is a Connecticut or a Maine lobster roll. Are you going to go with a butter sauce, or in honor of your colleague in crime, are you going to go with a Mike mayonnaise like a good Maine guy?
You got to go with the butter sauce, Tom, with a nice IPA, with a nice IPA, and we'll call it a day.
A butter sauce. I never thought. Lisa, I'm absolutely shocked.
Really?
Yeah, that's
butter
like
sauce
I
is
just figured
superior.
Cassidy was ice cold Mike mayonnaise and the whole thing.
No, butter sauce is far superior.
Okay, thank you,
Yeah,
Gerard
there you
Cassidy. Thank you. I learned something finally today on the show. Gerard Cassidy of RBC Capital Markets, truly expert. We didn't even have time there to go for his single best buy within the sell side. And what I heard there, Lisa, is buy the banks.
Yeah, buy the dip here as they expect the acceleration in the economy to allow loan growth to pick up. We have not seen it yet, although he's saying on the margins, credit cards. I don't know, $3.9 trillion of cash parked with the Federal Reserve. To
Lisa,
me,
I
that's
don't
shocking.
care.
I know you don't care. You're
Kaylee,
looking at
help
your
us
food
out
choices.
here. Cassidy's from Maine. I'm from up north. Lisa's from New York. You're the Southern girl. Help us out here. Butter sauce hot or cold mayonnaise lobster roll?
I don't even know what you're talking about, Tom. It's just going right over my head.
Literally should be an evergreen comment.
This
on
is like
Bloomberg
having
surveillance.
Pharaoh on air. You know, it's
I don't
worse
even
than
know what
that.
you're talking about, Tom.
All I
Okay,
know is, generally
folks.
speaking, this conversation has made me hungry. I don't know if for a lobster roll with butter sauce or with
There
mayonnaise
we
or maybe
go.
something else
I
entirely.
can see I'm going to be out $34 to miss lines here at some point as well. Folks, this is actually a really big debate, you know, as we launch into the summer season. Do you have a cold, crunchy lobster mayonnaise, or do you go the Abramowitz way with a butter sauce?
Savory with a cold
Savory
IPA.
Connecticut with a cold IPA.
It is still not yet 8 a.m. Eastern time. Just throwing that out there.
It's 5 o'clock somewhere.
It's exactly.
AM or PM?
Doesn't matter.
God, keep her on. Don't. Who's this Farrell guy? Don't bring him in. Keep Kaylee here. Make it work out. Futures up 19. Dow futures up 213. A little bit of lift. Bitdog. Oh, I can't quote Bitdog. It's so painful.
It bit you. Sorry, I can't.
Announcing a project and doing a project is something different. And that's why we are so proud. We have started now the first one here. It's running, and I believe that we will see scalability. We have now a base to show use cases, so we can develop new cases on how to build a hydrogen economy.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Public's hype over inflation had gotten too high. The Fed got spooked.
We still see there being more to go in this restart narrative.
We have an economy that's really strong. It's not normal to have rates at these low levels.
The Fed has to be very careful about its communications, not just verbal communications, but all types of communications.
I think what the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Partitioning a divided Federal Reserve. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, Bloomberg Television. Tom Keene, Lisa Abramowitz, Kayleigh Lyons in for John Ferro. I am struck by the stasis that has overtaken the bond market as people reassess the Fed's message last week and look ahead, Tom, honestly, to what the economic outlook really is, given the fact that we are reopening and yet the Fed is concerned about inflation.
End of June here and into the end of the second quarter, and it is an unusual uncertainty. And Lisa, I would just say you've got to be riveted on every Fed speaker today as they recalibrate and calm a market.
Yeah, Jim Bullard, I don't know how calming he's going to be. He wasn't very calming on Friday when he spoke with CNBC, talking about how he would like to raise rates by the end of next year. Does this mean that the Fed could potentially taper its entire $120 billion monthly purchase to zero in 6 months? Tom, that is not being priced into the market right now.
I don't see it priced in the shift here in the market this morning. Kayleigh Lyons, you've been living this morning. When I was looking at Kayleigh Lyons' time, it was red on the screen, and we've really turned it around, haven't we?
Yeah, it was an uglier picture at 3 a.m. Usually the picture is a bit uglier at 3 a.m. because it is 3 a.m. But yes, Tom, it was a red day for the equity market, and you were seeing that bid into the longer end of the curve. A similar story to what we had at the tail end of last week. And now the story is changing. Futures up 0.4% on S&P E-minis, and we are going nowhere in the Treasury market. The 10-year yield just sitting just shy of 1.44%, Tom.
Lisa, Lyons crushed us last hour with their knowledge on Francisco Blanch at Merrill. I'm sorry. I mean, $100 oil, Lisa, that changes the dialogue.
Well, do you know that a number of oil majors have actually predicted the same thing, that they don't see the increase in supply that could offset the demand.
$100 a barrel?
Yes, there has been an increasing number of calls like that. They are not outliers entirely over at Bank of America. This idea here that you're seeing discipline, including from the swing producers over in the shale patch. They have not increased production despite the increase in prices so far, Tom. And this raises questions about the elasticity of supply.
There we go.
There you go. That's
Today's
just for you.
word. Yeah, the Tang Mimosa this morning has elasticity as well. Futures up 16, Dow futures up 190. The VIX, let's remind ourselves, 15, 16, and with the angst of Friday out well over 20, 20.32 right now on the VIX. And the yield space, 1.4%, 10-year yield. What a round trip that has been. And the 30-year bond, as Kayleigh mentioned, was south of 2, now at 2.03%. Brent, $74 a barrel, rounded up. We can do that. Gold, $17.82 the ounce. Bitcoin, I refuse to quote under 32,000, not to upset Matt Miller, 32,400 now on the esteemed coin. We need to get our heads straight. Michael Kushner is going to do that right now with Morgan Stanley. Decades of experience and chief investment officer of global fixed income. Michael, an open question on a Monday. Have you ever seen a market like this?
It is very unusual from multiple perspectives. Curve twist. 10-year yields didn't actually move all that much from where we were 10 days ago. But the 5-year part of the yield curve, the 30-year part of the yield curve, we had a 25 plus basis point swing, which is very anomalous. Probably haven't seen this in over 10 years. So yes, there's been a massive rethink about the path of monetary policy. But what's interesting is that the long-term targets, the long-term endpoints haven't changed all that much, which is the interesting bit.
Michael, I want to go pro question for the Greeks right now, the Greek letters right now, and part of that's gamma, convexity, or acceleration. For the pros listening and watching this morning, are you worried about suddenness or accelerative tendencies within fixed income?
Well, I think that's part of the movements we saw last week. We're positioning, curve steepening trades, Fed not moving anything for a long time, low volatility over the summer. The Fed wasn't going to really address tapering or changes in rates till the fall, till after Jackson Hole, the September meeting, and suddenly that whole narrative changed. So whatever you thought was going to happen over the summer has become a lot more risky. So yes, all those things have become difficult.
Michael, Tom asked me a question. What is the message the Fed members want to give to markets this week with all of the Fed speak, from Williams to Bullard and onward? What is the message, or are they happy with the disagreements that are being reflected in a little bit more uncertainty in markets?
I don't think they're necessarily happy about it, but it reflects the diversity of opinions which exist both within the Fed, within the academic economic community, within the analyst community on Wall Street. If you look at the FOMC, I think there's 5 members who still see no rate hikes in 2023 and 5 who see 4+ rate hikes in 2023. That's a pretty different opinion about how things are likely to proceed. And I think that given the rise of inflation, hawks are more willing to show their hands about, yes, this is potentially problematic, but the differences of opinion have not been settled.
Well, and of course, to the hawks, it is basically them saying, hey, we're not actually going to let inflation in the economy run quite as hot as maybe some in the market had anticipated. What is the actual read-through in fixed income if that is indeed the case, if they are actually going to keep a lid on inflationary pressures?
Well, I think we're seeing it already with the long end of the yield curve. 30-year Treasury is falling pretty sharply and staying or hovering around this 2% level, which is remarkable given how strong the economy is, how high inflation has risen, and yet the market now seems to have this confidence that the Fed will pull the reins in such that inflation expectations will not exceed the current levels in their long-term forecasts or targets.
Michael, do you think that we've entered a market that is no longer range-bound, but that gets chop, that actually can be identified as up or down?
I think we are moving into a more two-way market, and we've been in a bull market since the end of March. Yields peaked at the end of March, and since then, Q2 has been a bull market in fixed income. High yields done well, spreads have tightened a little bit, IG's done well, and yields are lower. It's been a great quarter for fixed income. Not surprising, equities have had a bit of struggle and gone kind of sideways in many sense in Q2. But this scenario of worry about the future, that the Fed is not going to allow the economy to run away, that maybe this whole flexible average inflation targeting thing may be over, in the sense that the rise in inflation in 2021 will be sufficiently high to take average look-back inflation above 2% such that they can begin hiking rates next year. All to be decided in the next 6 months, I think.
Michael, how is your world linked into either real economic growth or nominal economic growth? And I link it through, folks, sort of a spider web of all these things we talk about, maybe back to a summation of R-star. Thank you, John Williams, speaking today. But then when I go beyond R-star, back to potential GDP or actual GDP that we're going to see, how does that filter into the Cushman world?
Well, I think the concept of R-star, very difficult to measure, difficult to understand exactly where we are, but it's a very important concept of the trend growth of the economy and the level of real interest rates which generate strong growth or weak growth, and the concept of secular stagnation, which we've been in for a long time, that Larry Summers promulgated as a function of this declining R-star, excess savings in the world. So the question is, going forward, is the fiscal expansion, which has been offsetting the rise in private sector savings, corporate and household, the last 6 months, a year or so since the pandemic started, will that money be spent in the private sector? If the private sector will spend that money, then R-star can rise, real growth will be stronger, real bond yields, nominal bond yields will be higher in 2022, 2023. If, however, and there's some evidence, I think the Fed has done research on this, that after previous pandemics in history, R-star tends to fall for long periods of time time, and people don't spend all the money in accumulated savings they've acquired because they're worried about the future. How this breaks out in the next couple of quarters will be important to decide how this plays out.
And is this the peak, Michael? Are we peaking now in the second quarter?
In peak of growth or peak of
growth?
Peak of what? Growth. I think that's one of the reasons why bonds have done well in the Q2. People believe that growth peaked, inflation peaked, and will fall. The question is how far will they fall? Right now, we're pretty optimistic the growth will remain strong into 2022, and inflation is not coming down significantly from the trend it's been in, but it will fall a lot from where we currently are today. But that's tend to be quite bullish for fixed income. We just thought yields might get a little higher before they started falling back down to these levels.
Well, thank you so much. Michael Cushman with us with Morgan Stanley. Interesting to dovetail his thoughts with what Michael Wilson is doing on the equity side. Hey, futures, I'm going to call a bid to it. I mean, we really haven't broken out to a higher level. Nevertheless, off of Monday, a bounce. Dow futures up 195 points as well. Lisa, I've got to go to the real yield. We haven't talked about that. And folks, this is the nominal yield minus the inflation expectation out to the residual, which is the inflation-adjusted yield. Which of those three parts, Lisa, are you focused on?
The idea here is that people are expecting the Fed to move away from buying bonds, and so they aren't going to suppress yields as much. You're seeing the real yield go up perhaps a little bit more in terms of the term premium. I, though, find the move rather muted. Honestly, the fact that we still have a negative 0.8% yield in real terms on the 10-year indicates a great degree of accommodation and pretty tepid expectations for inflation and a sell-off in the future, Tom. I'm looking at that and thinking a lot of people are skeptical of just how hawkish the Fed really is.
I'm going to see, Kayla, your observation right now as we go into the Fed speak.
My observation, Tom, is that you're not seeing the outperformance from tech like we saw last week. We saw that unwinding of the reflation trade in the equity market with the NASDAQ 100 outperforming. That was the case earlier on in the session, and now we're starting to see it roll over just a touch. NASDAQ 100 futures only up about 0.25%, and that compares with S&P 500 futures up about 0.4, Tom. So maybe we're seeing that reflation rotation rotating back.
Reflation, rotation, deflation,
how many
stagflation. It's going to be it's a nursery rhyme.
Lisa, she didn't beat us over the head that we missed $100 oil from Francisco Blonde.
So just to put this into perspective, we've heard other $100 a barrel oil predictions from Trafigura Group, and Goldman Sachs, but this is probably the clearest call yet. The idea here, we're all going out, we're flying around, we're traveling in our cars, we're moving around, and you're not having the shale producers come back online.
But
That's a big deal.
Yeah, a couple things going on here. Jane Foley to join us on foreign exchange. Really looking for that from Rabobank. And we begin the Bloomberg Forum, the Qatar Economic Forum, with a gentleman from South Africa, Cyril Ramaphosa, will be speaking in a moment. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. National Security Advisor Jake Sullivan says the U.S. is working on additional sanctions against Russia for the poisoning of opposition leader Alexei Navalny. President Biden said he raised Navalny's case with Russian leader Vladimir Putin during their summit last week and made it clear that Russia would face consequences if Navalny died in prison. Spain's Prime Minister says he plans to pardon 9 Catalan separatists who were put in jail for their role in the illegal independence referendum of 2017. The leader says he'll recommend that his cabinet approve the pardons when it meets tomorrow. A backlash is expected from conservatives who are opposed to any kind of reconciliation with the separatists. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. The Tokyo Olympics will limit the number of spectators to 10,000 people per venue to reduce the risk of the world's biggest sporting games turning into a super spreader event. The organizing committee chief says the number will be set at either 10,000 or 50% of venue capacity, whichever is smaller. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness nearly $21 billion of annual R&D spending to find solutions for the public good. The new Office for Science and Technology strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. Global News 24 hours a day on air and on Bloomberg Quick Take. powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
What we're keeping a close eye on is inflation expectations. If they really start to become unmoored here, people really do start to expect higher and higher inflation going forward, then that does become a little bit of concern. We are in kind of uncharted territory right now, not only with what's going on with the pandemic, but as well as the way the economy is responding to that.
Jay Bryson of Wells Fargo there with important comments, many different opinions about where we are. One of the great joys of where we are, Lisa Abramowitz and Kaylee Lines with us this morning on radio, on television. Thank you for being with us. Eventful markets with a not so much a new lift, but a sustained lift in the markets. Futures up 19, Dow futures up 205 as well. Is trying to speak to authorities and the complexities of bonds. Anybody who's waded through Fibonacci knows there's a lot of mathematics going on here, a lot of dynamics. Tony Crescenzi earlier with us from PIMCO, and now a true expert on the short-term market, Ira Jersey, running all of our interest rate strategy at Bloomberg. Just is really wonderful on short notice to get Mr. Jersey on here this morning. Ira, there is a growing amount of a wall of money in the repo market. The authorities say remain calm. Others say not. Which is it?
You can, I think, remain calm in knowing that the Federal Reserve is aware of the situation where they don't want interest rates to turn negative on a systemic basis. I think that the Fed is worried about the financial stability of interest rates being negative in the U.S. and wanted to certainly try to alleviate that situation. So the way that they did that was by raising those two key interest rates last week. But I think the other thing, Tom, is that we have to look at taper as a way to alleviate that, because this whole situation is being created by the Federal Reserve continuing their asset purchases at the scale that they are.
Okay, but what's so important here is, unlike Europe, we have a massive money fund complex. All of our listeners and viewers know this as well. The Fed clearly wants to defend money market funds with positive interest rates. Even if they could make a penny, would be great. Ira, who do they serve? The money market rates that we all own, or do they serve a Fed that's trying to unwind this wall of money? Which is it?
Well, So I think the challenge here, Tom, is how does the Federal Reserve not give a subsidy to money market funds, but at the same time, try to fulfill its mission of helping the economy. And I question whether or not at this point quantitative easing and buying all of these assets, if it's not actually helping anything, because there's other constraints on why this money is not necessarily going to help anything except asset prices go up, because reserves, bank reserves, which are what's created when the Federal Reserve buys a bond, can't be lent to the public sector. So they can't go to businesses, they can't go to the household sector. So base money keeps on going up and up and up, and it still has to find a home. So it's creating, and this is not unusual. I mean, we actually had the same situation in 2011 and 2012 toward the end of the quantitative easing period, where interest rates were zero and potentially negative, because basically these reserves aren't wanted, because there's things like Basel regulations where banks don't want to hold all of these reserves. So I think the other thing that can be done, and is a relatively easy fix, is to exempt these reserves from some of the Basel regulations, and not necessarily all of them, but from the supplemental leverage ratio in particular, so some of the larger banks can hold these assets, because they don't present a risk to financial stability if they can just be held on bank balance sheets for not a lot of cost.
So if anyone is not deeply entrenched in the rate dynamics, this seems like an esoteric debate, but it really goes to the heart of the quantitative easing debate, which is, at this point, is the Fed hurting more than it's helping? Does it need to taper because its excess money that it's pumped into the system is causing all of these problems? What do you think as far as the taper debate and when the Fed will start, especially because actually their assets on their balance sheet rose more than on average over the past year? We've seen them actually increase to the highest levels, a new high of more than $8 trillion. How close is the Fed really to tapering?
Yeah, well, based on the comments that Chair Powell made last Wednesday and Bullard made late last week, and I think that you'll probably hear a little bit more this week, it would not surprise me at all if they actually started tapering in the fourth quarter of this year. We'd originally been first quarter of next year, but I think that they're getting closer to the idea that, hey, we can still have easy monetary policy even if we start reducing our asset purchases. The important thing about asset purchases in general is it's a signal to the market that we're not hiking, right? Because the Fed is not going to start raising interest rates while they're buying assets, even if they're buying just a little bit. So one of the suggestions that kind of I've made last week was, they could reduce asset purchases from $120 billion a month to $20 billion a month, and just buy a lot less. Let the market be able to more easily absorb all of these reserves that they're creating, just because they're creating smaller amounts. But even if they're buying $20 billion, they're not hiking. So there's still a signaling tool that they can use with these asset purchases, just by reducing the amount that they're buying on a monthly basis.
Ira, does a 1.45% on the 10-year Treasury yield make sense in a world where the Fed is talking about tapering?
So it surprised me a little bit that we did rally, but I think what the market's saying to us right now is we think that the Fed might actually, in early taper as well as potentially earlier hiking, which I don't necessarily think that they'll do in terms of raising interest rates, but that they're going to be able to squash the inflationary problem that some people think might be out there right now. So what the market's telling you is, hey, we're not necessarily making a policy mistake, but that policy rates aren't necessarily going to go above 1.5%. So even if the Fed does hike, it's only going to be 4 or 5 times, and then they're going to stop. And the big thing that I think we're all missing in this whole all these market moves is the fact that real yields have gone up, 20 basis points, and inflation expectations have come down 15 basis points. And I think that's we can't lose sight of the fact that the market's thinking the Fed is going to keep a lid on inflation at some point, and their reaction function maybe wasn't quite as lenient as we thought it was going to be in terms of their ability to absorb more inflation.
Ira Jersey, thanks so much. Greatly appreciate it. With Bloomberg Intelligence this morning here on fixed income. And again, extraordinary movements here. The yield again. Well, the yield's higher. We've gone up 2 basis points in a blink, 1.46% on the 10-year yield. Lisa, it's the Qatar Economic Forum. The South African president speaking right now, Cyril Ramaphosa, to our Zayan Verji, and he's making headlines here, and he doesn't mince any words. They need the vaccine.
Yeah, this all speaks to the divide in the world between the haves and the have-nots, and very much it has become a developed versus developing nations. How much will that be in the focus here?
Qatar on the Persian Gulf, of course, around their rivals Saudi Arabia and others, Bahrain, and they've made very, very clear this forum will have a bias to Africa and the challenges of the Middle East. We're thrilled we could be part of the Bloomberg Economic Forum in Qatar. This is Bloomberg. Good morning.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Good morning, everyone. Bloomberg Surveillance, Lisa Abramowitz and Tom Keene, John Farrow off Kaylee Lines with us this morning as well. I want to reset right now at 8:30. Maybe there's no economic data or less economic data, but what there is an exceptional Monday across equities, bonds, currencies, and commodities. Kaylee Lines making a splash with a Merrill call of $100 oil, $73 a barrel on Brent crude. Oh, excuse me, I misread that. Yes, $73 a barrel on Brent crude. The problem you run into, Lisa, and I mean, I just went down in flames because I'm looking at Brent crude, but dollar ruble is also 73 to the dollar.
Yeah, that's all of
So
our
I was looking
problems.
at dollar ruble as I was looking at Brent crude as well. Lisa, I look at the bond market now, and seriously, how do you make a forecast in this?
It really is a faith-based forecast. It goes down to whether you believe that inflation is going to surprise to the upside, what your belief is about the reaction function of the Fed, and frankly, the just dynamics with all the cash out there, the idea of foreign buying. Should the U.S. rate start to rise enough for the highest yielding shirt in the sandbox actually having some value? How about that for mixed metaphors, Tom?
Yeah, you just went down in flames on that. I'd never expect that from Kaylee Lines. Kaylee, speak to us in English about the shirt in the sandbox.
I'm coming up empty, Tom. I'm still trying to
Good.
dissect the different parts of that sentence that Lisa just said.
Fair
It's been a
enough.
while since I have been in a sandbox, I will say. What I'm looking at, Tom, is the dollar. After 6 consecutive days of dollar strength, we get broad-based dollar weakness in the G10 space today. And I wonder if that episode of dollar strength is over, if we are going to see it resume, and how that reads across into the other asset classes.
The chart is out there. We've had a wonderful, eclectic set of guests this morning. Jane Foley coming up as well on FX. Laura Rame joins right now with FS Investments, their chief U.S. economist. And Laura's acclaimed for writing these short bullet research notes where she says, would everyone just stop it and look at the obvious elephant in the room? And Laura, you absolutely nail it this morning where you say the elephant in the room is nobody can make a 2-year forecast. We got to give it up. If we can't make a 2-year forecast, what do we do?
You got to try, Tom. I think that's, what we do. But, everybody, I think, looked at the Fed's forecast and they immediately started penciling in these rate hikes. The reality is that the dispersion of those 16 Fed members is so wide now. There's clearly a lot of disagreement. And that's where trading gets interesting. Obviously, that's where the volatility picks up. You're going to have all these guys talking. We don't have a lot of economic data early this week, so we're going to be watching the tape for what these guys say. And I think that is going to continue. We've already started off Monday in a particularly volatile session. I think it'll be interesting to see where that goes from here, because you've got the real hawks, you've got Powell tomorrow. There's this, I think, real soul searching on the part of the Fed. Do they believe their own framework review? Are they okay with the economy running a little bit hot and inflation maybe running ahead of where they've traditionally reacted?
Okay, but it's a theory. I mean, you and I have been doing this for more than a few years, and the basic I would suggest right now is we are truly, I mean, it's a cliche, folks, but it's Cliche Monday on surveillance. Let's go with it. Laura, this is original territory. Nobody really knows 2 days or 2 years.
I couldn't agree with you more. And what is driving me a little bit crazy is a lot of the very respected, very intelligent Fed governors sort of running back to these traditional Phillips curve models that they have built and thought so carefully about in a world where we saw those models completely break down over the last 15 years. And looking ahead, I think we're going to have real issues deciphering this data. what does it mean when the unemployment rate falls, precipitously fast when you've still got so many people out of the labor force? Just one example of how interpreting this data, you can't paint it with the same brush that we've been looking at for decades. But I think for the Fed, those are the guideposts they're used to. And markets, it's complicated enough for markets to be dealing with this much uncertainty. They need to get familiar guideposts from the Fed, and that's what we're seeing.
Laura, if you're talking about how difficult it is to make a 2-year forecast and yet you have to try, let's put you on the spot. What are you looking at in terms of inflation, and have you changed your view based on the fact that the Fed is getting a little bit more aware of the potential for the economy running too hot?
I see this inflationary cycle, and I'm always up to the task, Lisa.
Good.
I'll always give you the forecast. I'm seeing a mini cycle in inflation. And I think, to me, the smart money needs to really be watching wages. Headline inflation is going to continue to give these distorted, offsetting, supply shortage-driven signals for some time. But I think underlying all of that, we need to really see the trend in wages. If that picks up significantly and it's sustained, then I think I really would rethink my forecast right now of this really being more of a mini cycle where inflation is back to the 2% range that it was historically, and by this time next year.
Laura, when you talk about wages, I also think about the shift in the economy where some people are worried about a higher out of work or sort of a lower participation rate in the labor market. The idea that the skills needed to fill some of the roles that are available right now are skills that a lot of the people who lost their jobs during the pandemic may not have. How does that factor into wage increases? Does it matter which workers are seeing their wages increase?
So for inflation, it definitely does, because most of our workforce is this sort of what we say is unskilled. That's because they've probably just never been trained up on the skills, labor force. And that over time has dragged wages down to the extent that this cohort can start through competition demanding wage increases. You could really see the financials of these companies that depend on this low wage area really change. It squeezes the profit margins. It does all the things that could cause companies to pass price increases on. But to your point, what we've seen is a pretty significant shift in geography, in jobs required. All of these things, I think, could eventually lead to higher skill workers. Companies may find themselves needing to train these people up. I think that would be the best case scenario. What we'd like to see is more skilled workers earning more money, not just low skilled workers.
Laura, we of course all are watching the labor shortage, and we're watching the wage implications of that. And I know the wage data is very important to you, but what other data are you paying close attention to here? When we talk about how noisy and messy these economic reads are, what are the key points you're watching? And does any of it really matter until we get maybe cleaner reads in the fall?
I think on the inflation front, stick to wages. But when we look at other indicators, I think the lending numbers are going to be really important. We've seen banks be really good about maintaining discipline when it comes to lending. And I think they really need to keep that going with this much liquidity and loan demand starting to pick up again. I think that's going to be a really important feature of how sustainable our recovery can be. And then from here, I think we start to think about 2022. Still a strong year for growth, earnings, but it's likely to be a year of deceleration from here. I think we're hitting the high watermark for growth right now, and a lot of people haven't fully grasped that. This is kind of as good as it's going to get for GDP.
Yeah, if we're peaking here, what kind of deceleration do you see? How much slower will the growth get?
Well, this is where so many people are missing the impact of the labor supply constraint, right? Our economy needs everybody that it can get to sustain growth, or even to sustain growth significantly above that 2% level or 2.5% level. If we have a lot of people that have chosen to exit the workforce, we're still down 3.5 million people, not lost jobs, people who have just either retired early, stayed home. All of that becomes a real constraint on growth, I think, more quickly than most people are willing to appreciate. So Yeah.
We got to leave it there. Laura Rain, thank you so much. Great brief there on the 2-year forecast. She nailed the 2-year forecast with FS Investments this morning and their chief U.S. economist as well. Lisa, I remember when most economic reports always modeled out a 3 or even a 5-year economic forecast. That disappeared about 15 years ago, even before 07, but certainly with 07. And now, I mean, can you really go out to 2024?
Can you go out to December 2021? Honestly, yeah. Where are we going to be when you look at the comparisons in the data and you look at sort of the inflation debate and wages going up? The labor frictions that we still have not understood fully.
I agree, the mystery of the labor market, but the other thing I'd look at, Lisa, is this basic idea of what are earnings going to do? How do corporate officers adapt business-wise and financially to what the Fed has wrought in the last few days?
Well, Kayleigh kind of nailed it. And Kayleigh, you were talking about mergers and acquisitions, this idea of companies just buying each other because they had a lot of cash and money is really cheap to borrow. And we're expecting to see a lot of that. The question is whether they can actually create some synergies. I hate to use this word, but we are Cliche Monday here, as Tom said. And then going forward, whether this just means cutting staff, Kayleigh.
Well, it's a very good question, Lisa. And of course, what the read-through is to, as Tom said, corporate earnings, because we were just talking there with Laura Rain about growth peaking out now. But talking about earnings growth, that also is expected to decelerate. These companies are going to be facing very, very tough comparisons. So if earnings growth is decelerating, economic growth is decelerating, if we're peaking out here in the second quarter, what is that going to mean for returns going forward, Tom?
We will have to see. I'm just not really sure. Lisa, it's nailing it must be in the air. That's all I can say, Lisa. Nailing.
Do you want to nail something to the wall? Coming up,
Someone give Tom a hammer.
I'm hoping that Jean Bovin, head of the BlackRock Investment Institute, I hope she can nail it and get a sense of what we can expect going forward. I'm not nailing it. I'm going down in flames.
Thing.
That's how we go.
That's okay.
But no, honestly, we're going to drive the conversation forward on the open.
But in defense of Lisa, I've had people in Montreal Canadians I called she. And that got me nowhere as well. John from Coventry emails in right now. He says Kayleigh nailed it as well.
She did.
Nice to hear from John.
Oh, you guys. Thank you, John.
There's Jean Bovin. He is wonderful. Wonderful. I really can't say enough about Jean Bovin. He's one of the brightest minds out there in greater macroeconomics. He is a BlackRock and always must listen. I really must say that. Again, we're looking to Qatar and the Economic Forum out there. Some good guests coming up, including the former Treasury Secretary, Steven Mnuchin.
With the First Word News, I'm Kayleigh Lines. Iran's president-elect says he will not negotiate over Tehran's ballistic missile program or its support of regional militias. Hardline cleric Ibrahim Raisi, who recently claimed victory in Iran's presidential election, also says he would not meet with President Biden. Negotiations have been taking place in Vienna to try to save a deal meant to limit Iran's nuclear program. There's political chaos in Sweden after Prime Minister Stefan Löfven lost a confidence vote in parliament. That toppled his minority coalition and leaves the leader with 1 week to decide whether to call snap elections. If Swedes are forced to head to the polls early, it would be the first time since 1958. Authorities in Hong Kong will shorten quarantine time to 7 days for fully vaccinated residents traveling from most places. They're also set to cut the requirement for non-residents who are vaccinated. These are the most significant moves yet to ease one of the strictest border curbs in the world. Other plans include lifting capacity restrictions at some restaurants and swimming pools. And European natural gas extended its unprecedented rally as supply curbs sent prices to their highest level in nearly 13 years. The gains are fueling concerns about inflation. Gas is so scarce in Europe that some utilities have turned to burning more coal, a setback for the fight against climate change. And Bitcoin fell to a 2-week low amid an intensifying cryptocurrency crackdown in China. China has ordered payment platform Alipay and domestic banks to not provide services linked to trading of virtual currencies. The institutions were also ordered to cut off payment channels for crypto exchanges and over-the-counter platforms, the People's Bank of China said in a statement. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kayleigh Lines. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
There's so much money floating around that it was putting downward pressure on money market rates, call it commercial paper, et cetera, and 3-month LIBOR, which reached an all-time low of 13 basis points last week. And so there's still, that money still is out there, so to speak, and it won't be removed for a long time.
Tony Crescenzi of PIMCO, extremely important conversation there on $1 zillion trillion piled up, a wall of money that won't move right now. These are real complexities. And to all of you watching this, maybe that haven't gone through the curricula Lisa Abramowitz has gone through or Kaylee Lines has gone through, it's real simple here this morning. The pros are as befuddled as you are as well. We're just trying to explain it. A major shout out to the surveillance team that worked through the weekend to give you smart voices on this. Stephen Stanley publishing moments ago at Amherst Pierpont makes really clear we've given up on studying the supply side of the American economy, and we've got to do that right now. And also as well, Mark McCormick at TD Securities, who was strong dollar like Jane Foley. McCormick just looks for strong dollar to endure here. Jane Foley joins from Rabobank. She's been dead on, and what's so important, folks, is her price targets are moving. I mean, the idea of you get a price target and a cup of coffee later, you're halfway there. What do you do with your movable feast of FX targets? Jane, how ugly has this been, and how do you adapt and adjust at Rabobank on a Monday morning?
Well, to be honest, my 1 month target at the end of in the middle of last week was at 120. I haven't changed that yet because we could have a little bit of price adjustment, but I do think that the dollar is going to remain strong, certainly into the rest of this year and certainly this summer. I mean, there had already been a lot of focus on Jackson Hole. Maybe that was going to be the meeting where the Fed became, more hawkish. But I think what we saw last Thursday clearly really surprised the market. And what we're seeing now is a huge amount of dollar positioning just been squeezed out here.
Well, the dollar position has been squeezed out. I got a little static on the line. We're going to keep going with Jane Foley, see if we can get that. That's, Kaylee, that's what happens when the mice eat the wires.
Hate it when that happens.
We leave 7:31 Lexington, and the mice come in and working the wires as well. Jane, I look at the Pacific Rim play just as something that we haven't talked about today, away from the majors. And there's just been this, idea of better economy, Pacific Rim excellence. If I get a strong dollar, I can't get Pacific Rim currency strength. Which wins out?
Well, I think in the short term, it's got to be the dollar. But what the Fed has done last week does potentially allow other central banks to put a different slant on their policy. So, for instance, if we consider, the RBA, the RBNZ, those economies have been pretty good. They didn't really dive that much last year compared with other G10 economies. They've had really strong rebounds. And yet the central banks, or particularly the RBA, has remained pretty dovish, not so much the RBNZ. But you could argue that now that the dollar is strengthened and their currencies have come off, that this could really open the door for other central banks to be a little bit more hawkish too. Now, you could potentially apply that same sort of logic, maybe even to the Bank of England, maybe even to the ECB. To what extent does this open the way for other central banks to subtly change their tone? Now, we're not necessarily expecting the shocks that we've seen from the Fed. I mean, look at the yield curves in the UK and look at the yield curves in Europe and Germany compared with the US over the last few days. We haven't seen that much movement. But, it could mean that we will see more central banks being brave enough to come out and being a little bit more hawkish, because they don't need to fear that their exchange rate is going to start zooming higher.
Well, and that's on the developed central bank side, right, Jane? And when you look at emerging markets, the Bloomberg or the MSCI EMFX index right now hovering around its lowest level in a month, obviously on the losing end of that dollar strength equation. And we know that emerging market central banks have been raising rates. They have been tightening policy. They are trying to combat rampant inflation when you look at the likes of Brazil and Turkey. Are they going to be able to provide enough support to their currencies?
Well, I think at some point we've got to look at various different emerging markets, in their own, given their own fundamental capacity, rather than look at the group as a whole, because some are better positioned than others. But clearly, in terms of there being a stronger dollar, in terms of there being a Fed who's a little bit more hawkish than it was before, that is clearly bad news for the whole of EM. But we still got to remember that, the Fed is still being accommodative at this point. It's just a little less accommodative than before, but still accommodative. So from that point of view, there will be still value in some emerging markets. But it will be the investors that are able to, put apart the different EM countries and look for the ones that can still offer value.
Jane, of course, we're getting the Bank of England decision later on this week, and right now I'm looking at a cable rate 138 or so. It is the pound is the strongest performer in the G10 space today. What is your base case for the pound?
Well, we have seen, obviously, sterling come back against the US dollar in the last couple of days. That's not the same sort of story that we're seeing in sterling against the euro. It's been still really very range-bound, and although it's moved a little bit, it's still towards the end of the lower end of its range. Now, the Bank of England, as you said, is clearly in focus. Probably not going to be that much on offer, but I think the market's always expecting that Chief Economist Haldane, as he leaves the bank this month, will come out with some hawkish parting remarks. So I think the market's positioning for that, but I think there isn't going to be any particular surprises over the summer. But later in the year, we could have a little bit more tapering from the Bank of England, so we need to watch out for that. But that assumes, of course, that the slowdown in reopening the economy in England doesn't impact confidence too much, that we still carry on and see the remaining reopening of the economy take place in July.
Jane Foley, thank you so much. Greatly appreciated on a tumultuous day. Kaylee, I just look at the 10-year yield. I mean, rounded up to a 1.47%. I don't know where we were when you and I walked in the door, but, we're bordering on a 10 basis point move.
We were sub 1.4%, Tom. I think at the lowest point in the session, we were looking at a 136. So the move has really been quite remarkable, not just today, but of course this follows yields getting whipsawed last week. Your knee-jerk reaction on the back of a Fed with the dots getting pulled forward 2 hikes in 2023 was yields higher. And then we saw that bid coming into the long end. We saw that flattening trade. Maybe it had to do with some short positioning being covered, but obviously the dynamics very interesting to watch today, because we are seeing the selling pressure coming back in the bond market. We're up 2 basis points, Tom.
Yeah, the research right now is just extraordinary. Everybody's publishing with a frenzy. It's much more different than than a normal Monday as well. Just very quickly here, Kaylee, you got to watch the VIX 20.36. I got to believe it explodes through to 19 level to show the calm in the market.
Well, we will wait and see, Tom. Right now, NASDAQ 100 futures rolling over toward the lowest we've seen really since about 4 a.m. Eastern time or so, only up about 0.2%. S&P, though, faring a little bit better. So maybe that reflation trade will actually get back in vogue today, Tom.
He is a chemical engineer from India, and he was at Stanford, and his father said, come back to India and help build a startup company, Reliance. He has done better than good. Harshlinda Amin in conversation with Mukesh Ambani of Reliance Now. This is the Qatar Economic Forum, the Bloomberg Forum. We're thrilled that he could join us today. A real focus there around the world. Stay with us through the morning. This is Bloomberg on Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A volatile morning turning into melt up from New York City for our viewers worldwide. I'm Lisa Abramowitz in for Jonathan Ferro. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Minutes from the opening bell here in New York City. Traders gearing up for another busy week in the markets with a host of Fed speakers and economic data on the agenda. Plus, Bloomberg kicking off the Qatar Economic Forum today. We'll be bringing you live coverage all week. Some of the biggest names in finance, including conversations coming up this hour with Bridgewater's Ray Dalio, as well as former Treasury Secretaries Larry Summers and Stephen Mnuchin. Well, let's begin with the big issue. So long, summer doldrums.
There will be volatility.
You're certainly going to see volatility pick up.
That's not necessarily a bad thing.
I don't think the story has necessarily changed.
The tapering discussion and the liftoff discussion
is just an adjustment in timing.
You're going to have to reprice this hawkish outcome.
Volatility might be around here for a little while.
Bond yields have been the driver.
Guys, you're seeing a curve flatten.
Dramatic flattening.
You're seeing more opportunity.
You want to be positioned to exploit that volatility.
What's happening is just a repricing of the pace of the tightening of the Fed.
We are moving away from super easy policy.
There will certainly be volatility.
Joining us now, BlackRock's Jean Boivin and Mike Contopoulos of RB Advisors. Jean, I want to start with you. Are we in a new normal of tightening monetary policy?
I don't think so. We've the Fed has been a bit struggling in communicating the new framework that they're operating in, but this is a fundamentally different framework, and we've been labeling that the new nominal. And the response that is on the table now, I mean, they've moved that a bit earlier into 2023, but it is the most muted policy response to the outlook that we would have seen in decades. So I don't think this is fundamentally questioning the framework we're operating in. It's a bit earlier liftoff than maybe was on the table before, but I think this is at the margin as opposed to a fundamental change.
Mike, do you think that the markets have been overreacting, and frankly, all of the histrionics and discussions have gotten a bit overblown for a Fed still very much in the easy policy street?
I do, Lisa. You know, I mean, at the end of the day, the Fed is going to react to the data. They've said that for some time. And the data has come in a little bit better than they would have expected on inflation. And so they've adjusted a little bit. But at the end of the day, I don't see this as being a huge inhibitor to growth, which is what the market is effectively saying. I mean, look at the 530s curve and how much it's flattened down to 115 basis points, giving up months and months of steepening. You know, I'm not entirely sure the message is that they're going to suppress future long-term growth or abandon completely the average inflation targeting. It just feels like the market was looking for an excuse to unwind a lot of crowded trades, you know, whether that be steepening, whether that be reflation. And my suspicion is that you'll have several Fed governors this week start to walk that back a little bit. And I think a lot of these themes actually are going to pick up steam again.
All right, so Mike, where was the biggest overreaction? Which asset class has perhaps gotten a bit mispriced following the Fed's meeting last week?
I think clearly the 530s flattener was a huge move that was probably unjustified. I mean, when you think about it, everything we've seen since 2012, whether it has been tapering in 2013 or hikes in 2017, has led to a flatter long end of the curve, 530s. But the difference between then and today was that the Fed's neutral rate kept on stepping down, i.e. their expectation for future growth kept on falling. What could be different today is that their expectation for growth could actually be going up, in which case the median long-term dots could also be moving up over the next several years. And if that happens, you would expect a steeper curve, not a flatter curve. And so I think the rates market had the biggest overreaction. And Lisa, if you think about it, right, look at credit markets. You know credit markets very, very well. Look at CDXIG. Look at CDX high yield. No reaction. CDXIG is still trading at 50 basis points. High yields trading at 285 basis points. Credit markets are completely open, signaling no signs of stress. And so clearly, in my mind, it was rates and in particular the curve.
Jean, this actually raises a really good point, this idea that there's a complete dissonance here between risk assets and the rates markets, that you've seen rates markets get nervous, and you see a nervousness and a slower growth priced in. But as Mike was talking about, in credit, it's very much risk on, very much wide open, very much not a taper tantrum. Jean, do you think that the overreaction has been in the rates market, or do you think that other markets perhaps are not aware of an outlook that the Fed is forecasting?
Yeah, I think the biggest disturbing fact from the response, and in line with what has been said, is I think is the inflation market response. I think that's extremely bad news for the Fed. I mean, if you're looking at making this announcement last week, which was predicated on inflation fears that were building up, or the upside risk now being more real. The Fed tries to take that a bit on board into now, putting a liftoff in 2023 on the table. And then the next thing you see is then the whole inflation trade being questioned. So to me, I think this is the most important, disturbing, reaction from last week. This is where I guess there's an opportunity, to take the other side of that. And I think this is one place where I agree with my colleague here that I would expect the Fed official this week to start to walk that back, because that's pretty bad news for them.
All right, well, investors are preparing for another bout of Fed-fueled volatility this week. Coming up, 5 days, 10 FOMC speakers, 16 Fed events, and 1 Chair Powell on Capitol Hill. For more, let's get to Bloomberg's Abigail Doolittle. Abigail.
Lisa, it is certainly a big week for the Fed, as you were just mentioning. A rethink, perhaps, of last week's reinterpretation of inflation, reflation, tapering. 17 opportunities for the Fed to weigh in this week. We have officials speaking today, including Kaplan, Bullard, Williams. We also will have Mester, Daly, Bowman, Bostic, and Rosengren. And of course, tomorrow, Fed Chair Powell will be speaking, testifying before Congress. So it is going to be interesting to see whether or not they use that classic ploy of different views, because the bulk of these officials are more hawkish. The rest split between neutral to dovish, whether or not they will rethink. Now, whether the interpretation or the actual view comes out more hawkish than had been expected, even relative to last week, at the end of the week, UBS is saying that it's not going to bother stocks all that much. If we go into the Bloomberg terminal, UBS is calling for a 3% drop for the S&P 500 if we are to taper. In the top panel, you can see the Fed's balance sheet absolutely ballooning, taking the S&P 500 below it. But UBS is saying that the economy, the growth prospect right now is so strong that the profit outlook will help the S&P 500 even if the Fed does taper more than expected. And then finally, of course, the big action in the long bond last week, that 30-year yield absolutely tumbling. Today, an earlier part of the session, below 2%, now back up as investors are really trying to figure out what it means with the economy moving toward more of a growth situation. The Fed not going to be there forever. It's going to be interesting, Lisa, to see how all this plays out in the week ahead.
Abigail Doolittle, thank you so much. Still with us, Jean Bovin and Mike Kontopoulos. I want to go back to Jean's point that he was making about how the Fed is probably not great or not very excited about lower inflation expectations going forward, looking right now at the five-year forward break-even rates now at the lowest since March. I'd love your view, Mike. I mean, do you think that the Fed is going to try to walk back some of its rhetoric, even though a little bit of nervousness is probably comforting to them? Perhaps this will allow asset prices to not get overly inflated.
So that's a really interesting point. I mean, the Fed wants to see higher five-year break-evens, right? They want inflation expectations to accelerate. So that's what's actually a little bit interesting about what happened last week. Here's the Fed trying to boost up inflation expectations, yet what happens? Inflation expectations fall. So I actually take a little bit of a different view, which is that the Fed's probably a little bit nervous that they went overboard on tampering down inflation expectations, because that's what causes, the higher average inflation that they're actually looking for. And so that's one reason why I think they're going to suggest this week that they were willing to let the economy run hot, that nothing has really changed with their assessment, that they want inflation expectations to go up, and that they're going to be patient. And we all knew the Fed was going to taper. We all knew at some point the Fed is going to hike. And anybody who thinks that they're going to do it prematurely, this Fed, who's done everything that they've done for the last 12 months, is going to hike prematurely. I mean, it almost seems laughable to me. And so you have to believe that inflation expectations and rates are going higher, which is good for which is good for value. It's bad for duration, good for credit. right? And as the UBS strategist mentioned, the profit cycle still looks very, very strong. And ultimately, from a stock perspective, that's what drives stocks.
All right, and Jean, we're going to get a comment from you on that in just a minute. Jean Mouvin and Mike Contopoulos, you're both sticking with us. Right now, Bloomberg is hosting heads of state and global business leaders for day one of the Qatar Economic Forum. Former Treasury Secretary Larry Summers, Bridgewater's Ray Dalio, speaking now with Bloomberg's Stephanie Flanders. Let's listen in.
We have a supply-demand issue of bonds because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments, that pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, like, to borrow houses right now, I mean, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon, and the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect. So that's what it looks like to me, the whole picture of the low real interest rates, and then also the worries about the supply-demand, monetary inflation, and also the Fed tightening.
Well, you both focused not just on the short-term inflation, but on this long, because obviously what really matters is whether we're moving to a long-term environment, which is more inflationary, and the implications of that. So I guess, Larry, I would say to you, how much do you buy into the monetary side of what Ray was just saying? And also, how much would you say this is a global issue, not just something that's related to US fiscal policy, for example?
Look, I would say we're driving our car at 100 miles an hour on a road that is empty right now, but won't always be empty. And I don't know what form the accident will come, but when you're driving 100 miles an hour, it's probably not actually the fastest way to get where you're going, because you're likely to have some kind of dislocation. And whether that comes in product and labor markets, whether that comes in spiking of interest rates, whether that comes first in a decline in the value of the dollar, I don't presume to be able to predict. But that we're on a problematic course where anything can happen and none of us can predict markets precisely, but where the balance of risks is very, very much on the too much liquidity overheating side seems to me to be relatively clear. I think these tendencies are present in many places, but I think they're by far more pronounced in the United States than they are in the rest of the world. It's not that extraordinarily low interest rates are unique. It's not that extraordinarily big budget deficits are unique. It's that having them in tandem with an economy that's growing at what people expect will be a double-digit rate this quarter, and along with an epic degree of labor shortage. That's what is, it seems to me, the extraordinary feature of this moment. It would be a very different thing if we were creating liquidity in an extraordinary way to respond to a major output gap. But to be doing this kind of thing in a labor shortage economy seems to me to be very intensely problematic.
You mentioned the dollar. I mean, I guess one could see there are different scenarios that come out of this. I mean, the classic scenario for the US growing faster than everybody else, sucking in a lot of imports, would be that actually the dollar could rise and export problems to the rest of the world that way. But Ray, you just mentioned that you potentially see the dollar heading down. So is there a fundamental threat to the dollar that comes out of this?
Yes. The way, I'm just dealing with the mechanics. The way it works is you sell a lot of bonds. So now who do you sell the bonds to? And when I look around and calculate who owns the bonds and what they have to buy and what the incentives of buying, they're bad. And in fact, you could see dollar selling of bonds. What that means is then the Federal Reserve is in a position of either seeing rates rise because there's not enough demand to meet that. In fact, if they start selling, it would be a very bad situation. And that they can't let that happen because that would be very bad for the economy and markets and all sorts of things. So we have to keep in mind where we are. We're at the end of a long-term debt cycle. And that means that the Federal Reserve will have to do what they did last time, which is to buy a lot more to prevent the interest rates from going up. That's very non-cyclical. It's one of those cases where, in reserve currencies, it's a very dangerous thing. Now you compare that with alternatives. First, the best alternatives are other asset classes, but also, let's say China, for example. I think the situation that we're in is quite similar to the going from the late 60s into the early 70s, when there was a different core inflation rate in the United States versus Germany and Japan. It's a different balance of payments situation. We're in basically a balance of payments deficit. They're in a balance of payments surplus position. That means that they chronologically are worried about imported inflation, and there's favorable capital flows. So I think that that's negative for the dollar, particularly against Asian currencies.
I have Ray's instincts, but considerable agnosticism on timing. There are classic periods, the early 1980s is the one that comes to mind, where large budget deficits spurred growth, sucked in capital, and were associated with an appreciation of the dollar. So I'm not sure of the timing here, but I think, and I'm not as confident as Ray is in the long-term attractiveness of Chinese capital markets and indeed of foreign capital markets to the dollar. But I think the risks are substantial. And one of the things that I hear people say that seems most bizarre to me is they say, no, you don't understand. Now we're in an era of globalization. And so the inflation process is much stickier, or we can't get rapid inflation because of globalization. I think the opposite. Because of globalization, we're much more like a small country than we used to be. And that means that the dollar gets into trouble, which it easily could, that the pass-through to inflation is going to be more rapid than it would have been decades ago. So I basically share the kind of concern that Ray is expressing, just with a bit more uncertainty about timing. And I guess I'd add one more thing, Stephanie, and I think it's kind of an important point, and it's implicit in something that Ray said. The really hard monetary policy challenges are not actually moments like the period after Lehman or the period a year ago this spring, when there's massive illiquidity and markets are breaking down, and it's entirely obvious the direction that policy should move. You need to provide liquidity, and the questions have to do with how. The really hard monetary policy dilemmas are when it's not clear which way to go. When on the one hand, you have a falling currency and an excess supply of bonds, and on the other hand, you have a weakening economy and rising inequality and a fear of recession, and you don't know whether you're cutting rates to respond to the latter problem or doing tightening things to respond to the former problem. Those are the really difficult moments in monetary policy, where even the direction is not entirely clear. And my fear is that we're setting ourselves up for such a moment.
I think that the Fed, though, would argue that they are actively looking to have that overshoot in inflation, the change of approach in terms of the average inflation model, in order to sort of reset the system and indeed get that wage growth through to parts of the economy that perhaps have not seen it over the last few years, and that could be more politically sustainable long term. So Ray, do you see that is an argument that the Fed could make, that it's worth some short-term risk to achieve that more sustainable outcome?
As I mentioned, I think if you see break-even inflation rates go above 3% or something like that, and you see that spurt, then you have the dilemma of the tightening of the monetary policy. As I said, I'm not particularly worried about that particular inflation. The other things that worry about me are the whole shift in terms of the quantity of debt money that's being produced that goes into create bubbles, creates an enormous amount of liquidity, and that I think will be manifest by either a rate rise tracing inflation or a dollar decline. And I think then we also have to deal with the changes in the political situation, the wealth gap situation. With the wealth gap is the left-right question. There's a lot of conflict in terms of left-right politics. There's a big move, pretty much probably, to more left politics, believing that there's not enough fair share of incomes and so on. And those will create structural changes that will have effects. The amount of money which has gone to profits has increased from about 6% of revenue to about 14% of revenue. And that's decreased the share that's gone to incomes. Those things could be structural changes that shift the wealth and income. I think we're here to those that are going to be more beneficial, let's say, to workers than to capitalists, I think, in general. That's particularly a U.S. issue. It is a European issue, too, although it's a world issue, but it differs around the world. So I think those are the bigger issues, that and the rise of China and what the rise of China means. Those, I think, are the bigger issues.
Larry, I mean, when you say the globalization, it's an interesting point about us becoming more like a single country responding to things. But one could argue that the things that globalization was associated structurally with falling inflation for a long time, at a period where you also had central banks focusing more on inflation, and you had this sort of shift in bargaining power away from workers. If all of those things are going into reverse, that is potentially more inflationary, but also a better world for workers, or a more inclusive world? more sustainable politically?
Let me take your question a moment ago and then come to that, Stephanie. Look, I think the arguments about average inflation targeting and so forth, they kind of have their place, but I think we need to recognize when you declare victory. When we've got a record labor shortage, the Fed probably shouldn't be obsessing about making sure there are opportunities available. When we've now got average inflation over the last 2 or 3 years up to 2%, we don't have the problem of needing more inflation in order to get to some kind of level of average. So I just think we need to recognize the new reality is very different from the secular stagnation reality of 2 years ago. Look, I am all for a strengthening on a variety of dimensions of the hand of workers. I think we need to raise the minimum wage. I think we need to re-empower the ability to organize unions. I think that you can't read the stories about working conditions at Amazon and not think that something should be happening to rebalance things. At the same time, I think you have to recognize that doing all of those things is going to bear on the inflation process. It's going to bear on what economists call the natural rate of unemployment. And you're going to have a set of consequences, and you need to factor those in setting macroeconomic policy. I mean, we had a moment very much like the current moment, coming after a long period of no inflation. We had a government that had very expansive desires for what it was going to do. We had a progressive tide sweeping through the country, changing attitudes on very many fronts. We had that in the 1960s. And what we saw was that inflation rose more rapidly than anybody anticipated, that a right-wing tide in politics was ushered in with the successive elections with lags of Richard Nixon and Ronald Reagan, and that what happened ultimately did not serve the interests of the progressives who supported it. And you saw a big upsurge with the way in which the United States went off gold and imposed tariffs universally 50 years ago this summer. So a return to that does not seem to me to be what we should be targeting. And my concern is that I see too much in the current trajectory of economic policy. The Lyndon Johnson, John Connolly axis of economic policy making doesn't seem to me to be a healthy guide.
Well,
I think we
lost out Larry briefly, but yeah, Ray.
I think Larry and I agree that this is looking more like the late 60s transitioning to the early 70s. And then I'll also say, though, and that has implications for the balance payments in the dollar. So we've covered that. I'm more worried about the inflation in financial assets and what that means for returns and bubbles that are developing, because there's a massive amount of liquidity around, and it's being thrown around so that it's a difficult environment for those returns to be justified. I think we're building kind of a bubble. So I think inflation in financial assets and so on is an issue related to liquidity. Anyway, you think about it. What's happened is the net worth of Americans and most people in developed countries.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. That was Bloomberg Live's coverage of the Qatar Economic Forum. You can watch extended coverage now at Live Go, where we see Ray Dalio talking about the threat of a bubble. We're just moments away from the start of trading, and you can see asset prices climbing higher, just as Ray Dalio was talking about, climbing despite some of the concerns about tapering, led by the riskier sectors in the market. The Russell 2000 leading the way, up nearly 1%. NASDAQ up just 0.1%. The S&P up basically 0.5%. If you flip up the board, it's been round robin when it comes to Treasury yields. They were lower heading into the U.S. session. Now they are climbing higher as people reassess what the Fed's true reaction function would be, especially given the fact that they don't like the fact that inflation expectations are going lower, as we heard from our prior guests. We are seeing crude continue to climb as Bank of America Merrill Lynch's Francisco Blanchard puts out there the potential for $100 a barrel oil. Let's head to the markets desk. Bloomberg's Abigail Doolittle joining us now.
Lisa, before going macro with that risk on tone that you were just highlighting, it is, of course, Monday, and it's a true M&A Monday. We have two movers that are absolutely soaring, starting out with Lidl, the chemicals company, up 82%. This as the Clear Lake Capital-backed Uniphrax is buying the company for a little more than $62 per share for a $1.3 billion deal. We also have Raven Industries soaring, the ag equipment company being bought by CNH Industrial in a $2.1 billion deal. So there is adding to that risk on tone. Now, before taking a look at a piece of what is helping today, not helping is the crypto space, really down sharply. This is Bitcoin is just below or above, I should say, $32,000 per Bitcoin, tumbling, that volatility continuing, and of course, China back in the news, cracking down. But of course, you could talk about the parabolic uptrend that maybe it should not have happened, that those bubbles don't last. And then helping out the markets today, Lisa, one piece of it, a bit of reflation back. This is yields back up, perhaps a rethink of the hawkish interpretation of the Fed last week. We have the banks climbing as yields, again, are climbing as well, Lisa.
Thank you so much, Abigail. The big banks bouncing back, as you said, but still leading the declines this month. RBC's Gerard Cassidy recommending investors buy the dip.
We've not seen this low rate environment persist for so long, particularly on the long end of the curve, with the likelihood of inflation heating up to levels possibly we haven't seen in over 25 years. So the industry right now is grappling with an excess amount of liquidity caused by the quantitative easing by the Federal Reserve. This pullback is a great opportunity for investors to buy bank stocks.
For more, let's bring in Bloomberg's Ritika Gupta. Ritika.
Thanks, Lisa. Well, we really have seen the banks turn from your leaders to your laggards in the month of June, climbing back up a bit today, but still in the past 2 weeks were down as much as 10%. This, of course, as that reflation rally lost some steam after a more hawkish Fed and some of those earnings estimates being revised lower. We had some stark warnings from the CEOs of JP Morgan and Citigroup on that trading revenue. Jamie Dimon saying it could be down as much as 38% from a year ago, but we do have some positive catalysts for that banking sector this week with those Fed stress tests could help it move off that 100-day moving average, which we had closed around last week. Banks are expected to pass these stress tests with ease. That could mean billions of dollars going back into share buybacks and dividends. These had, of course, been capped during the pandemic year. We did see some of the restrictions lifted early 2021. The idea now that more money could go back to the shareholders has some of those analysts saying buy that dip, but risks, of course, do remain on the horizon. We have to see what happens with those trading revenues, the core lending perhaps being softer, and of course, the direction of interest rates, Lisa.
Ritika, thank you so much. A flatter yield curve is part of what's weighing on the big banks. HSBC's Steve Major expecting the 10-year to drift lower, not just lower. He wrote, quote, "The path of least resistance is to lower yields. We maintain our 1% forecast for 10-year treasuries." Joining us now, Esty Dweck of Natixis and PGIM's Greg Peters. Esty, I'd love to get your take on whether this can persist, this flattening in the yield curve that's really hammered banks that we've seen to date.
The reality is, I don't think that much has changed. I think we're seeing more of an overreaction to the dot plots Powell walked it back, talked it back through the press conference. We're very far away from the objectives in terms of unemployment, of the labor market. As you were saying earlier, inflation expectations are now coming down and peaked about a month ago. It does look like the path of least resistance is downwards now, and we have been in something of a downtrend for yields since March. But I think we're going to probably settle in after a few days post-Fed, and we'll start to see a stabilization and not a further drop in yields.
Greg, what's your view? I've heard from a growing number of fixed income strategists that actually flatter is the more likely trajectory of the yield curve. Do you think it can persist?
I do, and we do, and that's been kind of what we've been calling for all along. It's been painful for a little bit, but we do think back-end yields have crested. I'm not suggesting that there won't be volatility. I think one of the lessons learned here over the past several trading days is that the Fed speak's just going to create volatility. At the end of the day, though, ultimately, I think the curve is flatter and yields are lower. And I think that is the trend that we'll be operating under for quite some time.
The discussion that we were having with Micah Jean earlier in the morning, I thought was fascinating. This idea that perhaps the Fed is going to try to walk back some of its rhetoric simply because longer-term inflation expectations have come down. This is exactly what they do not want to be seeing, and this is exactly what has been stemming the contraction in the yield curve. Do you agree that there is this sense, Esti, that perhaps the Fed will walk this back, allowing the yield curve to steepen once again?
Well, the reality is we didn't see that much steepening ahead of the Fed, right? We had seen yields trending down even before. We'd seen a stabilization, let's call it around 150 on the U.S. 10-year. Real yields remain very firmly in negative territory. I'm not sure if just walking back or talking back some of this in the next few weeks is going to lead to a much steeper yield curve again. I think maybe your front end drops a bit further, but the long end had been stabilizing around these levels. And really, the hikes that are potentially penciled in by a number of governors are for 2023. That's 2 years out. So a lot of time before the yields need to adjust much further.
Greg, what do you think in terms of all the Fed speak that Abigail ran down just earlier here today, talking about what we can expect with the messaging? Do we think that there's going to be any kind of change to the rhetoric that we heard last week?
There's too much dispersion and there's too much white noise. I think market participants have to tune out the white noise. So, it doesn't matter what Bullard said, right? So, the fact that the markets reacted around that is really surprising. So I think market players need to focus on what matters, and what matters is what comes out of Powell's mouth and then Clarida's mouth. The rest is just really white noise and should be tuned out. So I think, this whole narrative around walking back, talking back is really a false one in many respects, because we shouldn't be paying attention to those governors in the first place.
All right, and this has been a serious issue as we look to the Fed speak that Jay Powell will be speaking on Tuesday. Esti, when we talk about positioning in risk assets, do you go into banks? Do you buy? Do you sell treasuries at this point? Do you buy riskier credit and just go back on the reflation trade after a brief pause?
To some of this, yes. I think the reflation trade isn't over. The rotation into cyclicals isn't over. I think there's more room to run. Just when you think about the reopening potential, we've done very well in the U.S. We're a bit behind elsewhere in the world. So I think there is more room to run there. What I think is tougher is on the yield side or on the treasury side to think, what catalyst would it take to get a big move higher in yields? And, maybe the labor market improving, but I don't think that would be such a surprise to markets to get 3-4 months of very strong non-farm payrolls. We've been expecting them. We know that a number of the reasons why it hasn't happened should be dissipating over the next few months. But I do think that at this point, from an equity market, from a risk asset perspective, it is more of a pause in the move rather than the end of the reflation trade.
Greg, considering the fact that you do think that the yield curve is going to flatten, is that a sign of risk to high yield debt, to the riskier credit? Is it a sign that perhaps the slowdown could start to affect the incredible cash flow that we've seen for some of these more speculative companies?
I think it's too early. So that's always a risk. And the yield curve has always been a forward-looking measure of economic slowdown. But I think what's unique about this cycle is that you look at valuations writ large versus where we are in the economic cycle. Valuations are very much late cycle, where fundamentals are early to mid-cycle. So I still think there's room to run in risk assets, high-yield bonds as well. But clearly, the binding constraint as we look forward is less the economic activity and more on the valuation front. I just think we have some more room to run here and some more time.
Esty Dweck, Greg Peters, thank you so much. Right now, let's head back to the Qatar Economic Forum.
Which can be delivered. What do you think is the right answer for infrastructure at this point for the United States?
Well, I think infrastructure is something that's very important. Actually, this is something that President Trump campaigned on as well, and we wanted to get done. We ended up having a lot of other priorities, so we had difficulty passing this. But just as last year, both parties came together to pass the CARES Act, I would encourage the parties to come together, something that looks like around $1 trillion, as I know what the bipartisan group has been working on. And I think that can have a real positive impact on the economy. So I'm a big fan of bipartisan work in that area. And I would be very careful, particularly as we grow the economy and people are trying to get back to work and small businesses are opening up, what could be significant tax increases across the board.
Well, and the tax increases really is the rub, isn't it? Because watching from the outside, at least, with the various meetings that President Trump had up at the White House, the infrastructure weeks that were had, it always got down to, I think, how do you pay for it? Not just how big is it, but how do you pay for it? Is it essential that you not raise income taxes in any way, shape, or form, corporate or individual, in order to make the infrastructure work?
I think it can be done. There's a lot of money left from the pandemic funds last year. We passed over $6 trillion of funds. There's still significant money that hasn't been used. I believe that can be recycled. And I think the bipartisan group can look for across the board. There may be some pay-fors that don't have significant impact on the economy.
Is that use taxes?
Excuse me?
Would that be use taxes, for example? That's one of the things being suggested is pay for. That's not income tax, but use tax.
I'm not going to comment on the specifics of whether it's gas taxes or other, because I'm going to let the bipartisan group figure that out. Almost by definition, it's the areas that people can agree on. But I'm hopeful that will get done. I think it's been moving in the right direction, and I'm hopeful.
So, Mr. Secretary, give us, if you can, a rough sensitivity analysis on the question of the trend line growth, because you said it depends critically on investment in things like infrastructure and tax policy, which seem to be linked up. What's the upper level? What's the lower level, depending on what they do there? What do you expect in terms of trend line growth for the United States over the next 5 years?
Well, I can't comment on 5 years, but I would say clearly in the foreseeable future, I mean, we could easily see 6 to 8% growth. I think the other area, and the previous panel commented on this, is the risk of inflation and how that plays out. Now, inflation is good for certain parts of the economy and very bad for other parts of the economy. So I do worry, as Larry Summers and others have said, that the chances are higher as opposed to lower, that this is ongoing inflation and that the Fed will need to adjust for that. I think in the interim, there'll be businesses that are growth businesses, high margin businesses with consumer spending that will do very well with higher inflation, and businesses with lower margins and high costs of labor are going to be concerned. So I think the inflation outlook is something that's going to need to be managed very carefully.
Well, let's talk about managing it carefully, because it appears that the Fed is coming around to the view that at least has to be concerned about inflation. That's what we heard from the Fed after the FOMC meeting. We heard Chair Jay Powell say we're paying attention now to inflation, even though they didn't take specific action. Do you think that what the Fed is doing, basically in indicating down the road they're going to have to tighten some, do you think that that's going to be enough to rein in the danger of inflation?
Well, I have a lot of confidence in Chair Powell And we worked obviously very closely over the last several years. Clearly, what the Fed did last year during the pandemic really, really helped, and it was critical. So there's no question that the Fed needs to go into a period of normalizing rates and normalizing the portfolio. And I think the question is really how quickly they do that and how they do that in an effort to control inflation. I think the issue is that the Fed is being cautious. The Fed models, the Treasury models, economic models really are not very good at predicting, given the vast amount of fiscal and monetary response we had over the last year. So I think this is something that needs to be watched very carefully. And I do think the markets are underestimating this risk.
Well, it does raise the broader question, at least for me, of how much of the growth we're seeing right now, because as you say, Mr. Secretary, we're going to see some robust growth this year in all likelihood. How much of that is because of the fiscal and monetary support as opposed to the underlying strength of the economy?
Well, I think a large part of that is going to be the fiscal and monetary that allowed for the reopening of the economy. So again, I just want to put this in perspective. Over a year ago, I never thought I'd be in a period of time sitting in an Oval Office talking about shutting down travel to Europe, talking about shutting down the entire economy. So there's no question that now that it's reopened, and now that, at least in the US, there's vast vaccine distribution, you're seeing businesses come back very, very strong. And I believe in particular the travel, entertainment, leisure business, people like these videos, but people want to get back out and travel and see people.
Yeah, I think that's very fair. You talked about some of the things that you did in the Trump administration, you and President Trump did, to really spur growth. And it certainly included tax cuts as well as regulatory reform. On the other hand, President Trump from the beginning took a very strong line with China, which, by the way, President Biden seems to be following up on. Looking back at it now, did you leave some growth on the table because of the need to be tough on China?
Well, I can't specifically say whether we did or whether we didn't. What I will say is that China is the second largest economy in the world. It has a large population, 1.3 billion. It's both the biggest opportunity and the biggest threat, with a large growing middle class. And the purpose of the tariffs were really to create a level playing field. So the issues that we were dealing with were the same issues that my predecessors were dealing with, Hank Paulson and others. And there's no question that the tariffs had the desired impact of getting China to the negotiating table. We made a lot of progress on the phase one trade deal. I would encourage the Biden administration to continue that work and try to have China make more reforms on trade and play by the global rules. I think that's important for their economy and very important for the rest of the world economy as well.
As the Biden administration does apparently turn from Europe to Asia, and particularly China, is it a zero-sum game? I mean, in the sense that in order to really get China to the bargaining table and get real concessions, you have to run the risk of giving up some growth.
Well, I don't think it's a zero-sum game. China, they were at the bargaining table. We made significant progress. I would encourage people to get back to the bargaining table, and let's see if they can get a phase two deal done. That's really the purpose. This was about protecting intellectual property, protecting fair and free trade, and having two-way trade. A major component, we believed, of the deficit was that our companies didn't have the same opportunities to participate in China as their companies had in the U.S.
And finally, Mr. Secretary, I really want to turn to what you're doing now, because I understand you are putting together a fund for investment that involves sort of, if I can put it this way, a public-private partnership in a sense, public-government experience with private investment. Tell me what you're doing.
Well, David, I'm very focused on the work that I did over the last 4 years, both on national security and regulatory areas, very focused on technology such as cybersecurity and data privacy. I think as we've seen in recent events, these are very important areas of national security and economic security, and also in fintech and financials, where we see really the U.S. systems continuing to advance significantly.
So some of the issues we've seen, for example, with some of the ransomware attacks, are real challenges. Do you see investment opportunities there, and what do those investment opportunities look like?
Well, David, when I was at Treasury, I was responsible for cybersecurity for all of the financial services industry, as well as for the IRS, which is obviously a very large holder. And we did a lot of work on modernization. We did a lot of preparation. The financial services industry has invested significant amounts of money in these areas. I think other areas of the U.S. economy need to continue to invest as well. And this is going to be an ongoing issue that's not a 1 or 2 year issue, but in my opinion, a 10-year issue.
Let me ask you something that I know you know a lot about, and that's blockchain, and for that matter, cryptocurrency. Is that a help or a hindrance in dealing with some of the security issues we have?
Well, I think the underlying technology of blockchain has huge potential, particularly for things like real-time payment processing, cross-border, using stable coins. My views, and we did a lot of work at Treasury on this on an interagency basis. We put out regulations last year around making sure that if you want to buy cryptocurrencies, that it has to be transparent. And I believe that many of those industries should be in the regulated world. They should follow the same BSA, the Bank Secrecy Act requirements, the Know Your Customer requirements, and these shouldn't be the equivalent of secret Swiss numbered bank accounts. So as long as we do a lot of work and
that was Bloomberg Live's coverage of the Qatar Economic Forum. You can watch extended coverage now at Live Go. Greg Peters and Esty Dweck still with us. Esty, I do want to go to this idea of the dollar. And as we've heard a number of the people on these panels, in particular Ray Dalio, we were hearing that the dollar is poised to steadily weaken due to how much debt has been incurred and due to some of the Fed bond buying. Do you agree with that?
I don't think that the amount of debt is really the market's concern at this point. I think the focus is much more on reopening, on what growth is going to look like, what the Fed is going to look like. We've interestingly seen basically something of a double bottom in the dollar index that held. So we have a bit of a floor now. It doesn't mean the dollar strengthens a lot from here. And again, I think that a lot of the market reactions we've seen since Wednesday have been overreaction, and the dollar is one of them. I just don't think that the debt dynamics today are going to be enough to weaken the dollar, where the U.S. economy is growing faster. There's more fiscal impetus, and we'll see how much Biden manages for infrastructure. And of course, you now have a bit of a carry advantage against a number of currencies. Some downside potential for the dollar, but I think it will prove to be relatively limited.
All right. Well, meanwhile, infrastructure talks are stalling on Capitol Hill. Negotiations resuming this week. For more, Bloomberg's Emily Wilkins joins us from D.C. There's a question, Emily, of how much progress is being made with the bipartisan support for the $579 billion bill, seeming to gain some steam here.
I mean, look, the fact that they have got 10 Senate Republicans, technically 11 Senate Republicans on board is a big deal here, because that means that the bill can go through the normal process. They don't need to worry about reconciliation, and President Biden can claim a bipartisan victory. However, they're still stuck on how to pay for this. Republicans have put forward indexing a gas tax. That's actually something we've seen some Democrats in the Senate open to, but President Biden has said no way. He's been very adamant about not raising taxes on those Americans who make less than $400,000. And so you have this question of exactly how things need to be paid for. Yeah. And you have another deadline coming up, because after this week, the House and the Senate both recess for a few weeks for the July 4th.
All right. Thank you so much, Emily. Greg, there is a question here about whether we may see a bigger surprise to markets for a tax rate hike, or perhaps to a bigger or smaller than expected infrastructure plan. In other words, should we be looking more to the taxes or more to the headline number and the potential growth that could stem from fiscal spending?
I'm focused more on the fiscal part. I think that's the real potential game changer, if you would. It seems like it's a very popular bill as well. I think infrastructure is something that's been talked about for, seems like decades at this point. There's a very big multiplier effect relative to maybe some other spending that happens at the federal level. So I look to the fiscal side as the real key here, and much more focus on that and the potential for growth relative to the tax side at this point in time. But at some point, it does have to be paid back. I'm just not convinced that that is the narrative today. I think that's unfortunately a narrative for future generations.
There is a question of what the Fed exactly means, and we're getting a host of Fed speak, including the Fed's Kaplan, saying that the dot plot reflects dramatically improved outlook, including 3.4% inflation this year. Esty, how much is the fiscal spending a part of that? How much are we already pricing in some sort of substantial package getting passed in Washington, D.C.?
Not so much, I don't think. When you look at Biden's numbers, and again, we don't know how much he'll achieve, but even assuming he manages to get $2 trillion of infrastructure, if you put that over 10 years and you look back, that's about 1% of U.S. GDP per year. These are not, game-changing numbers. It's great on sentiment. It's a good headline. If he does manage a bipartisan deal, that's another win. But the reality is, from a pure growth perspective, one, it takes time. You have to find the right places to invest, and it is going to be diluted over a number of years. So it is positive, but I think at this point, if you're looking at the outlook, this is a lot more about reopening, the economy is getting back on track, pent-up demand, and that growth continuing to filter through because we haven't priced in all of the reopening yet.
Greg, before we let you go, just real quickly here, do you think the dollar is going to strengthen from here or weaken?
I think the trend is towards strengthening, not weakening. So I disagree with Ray Dalio's thesis. I think shorting the dollar over the long term is typically a bad endeavor.
All right, I think a lot of people actually do agree with you. Greg Peters, Esty Dweck, both of you, thank you so much for being with us and for your patience as we listened in to the Qatar Economic Forum panel. This was Countdown to the Open. We see right now in the markets a kind of interesting dynamic emerging as you see the NASDAQ sort of toggling between gains and losses, finally getting back up into the green. The S&P up 0.7%. If you look at the Russell 2000, though, continuing to lead the way, perhaps not dead yet, is the reflation trade. People trying to pile back in, with Fed officials, including Jim Bullard, saying that the U.S. is in a stronger position on reopening now than expected, and we have to be ready for the idea of upside inflation risks, basically doubling down on this idea that the reason why they're bringing forward the rate hiking is because the U.S. economy looks so good. It is not bearish on the U.S. economy or inflation. This was Countdown to the Open from New York. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest-hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of in life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de Rivera. This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The
forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty.
The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
There's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks, and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
2 traffic, 260. Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
When people think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFaul.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends. But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start. And from that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. elections. Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to USA, 24 people went for the job. 23 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们差。我们在座的所有人的脑袋绝不比你们差。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Value-Ag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions. and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. origins of the creative content of a lot of the work at Lightbright comes from a variety of sources. Sometimes people come with a napkin sketch. Some people come with an Adobe Illustrator file. And we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I learn so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it, and we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when I see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating. that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
It's a bit like an addiction. You've got to make something. You have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. Sven Cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change. And as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle. And it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured at Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now for a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect the pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice. You've got to be able to judge material temperatures. You've got to just look at it and you just get a feel for it. It's the stage where your tubes start to look a bit like a bicycle. My father's a jeweller. He'd make sort of very pretty things, which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, and you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that, or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the paint can have time to cure a little bit, and then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives. So we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom. So as soon as I had one, I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. They surf wonderfully. It's beautiful and it feels great to be on one of them. I always had a love for wood and kind of passionate about things that went in the water. I've kind of been around wooden boats most of my life. There's just so much character. The way they're built, the stories that come with them, a lot of that has translated over to why we build surfboards the way we do. When we first started thinking about building surfboards, wood was the natural material we chose. They have a very high strength to weight ratio. Wooden surfboards have the longest history of use in the surf world than any other material. People have been surfing wooden surfboards since kind of the first documented history of people riding waves. The board starts in CAD, where we take a 3D model, break down the shape, and kind of create frames and templates and all the inner parts of the board that we get cut on a CNC machine. We take those frames and we just pop them out, assemble the frame into kind of a skeleton. We go out to our lumber shed, pick a bunch of cedar, and bring them into our mill shop, put glue along the edges, clamp it all together into a panel. Everything's book matched. You have symmetry in the colors and texture of the wood. Cut your outline. take our assembled frame, gently put it down right on top of the plank. Once that foundation is started, you're basically building up the three-dimensional shape, the outside part of the board, using lots of strips that kind of interlock and fit together. Every piece of wood is going to be different, and it's all going to react differently. There are frustrations with it, but I think that's one of the things that keeps it challenging. You learn to read the kind of what the grain lines are doing and what the color of the wood is telling you. Once those rails are cleaned up, we put our top planks on. It's a little bit like putting a lid on a box. It's like, this is it. Whatever's inside that board is staying inside that board. And by tensioning some rope, you can clamp the two together. It's like a time capsule. What makes our boards unique are they are built right here in York. They're built using material that grows right here in the state of Maine. They're built 100% by hand by local craftspeople and surfers. There's a lot of time that goes into these boards, between 40 and 60 hours start to finish. We wanted to build surfboards that were as hollow as they could be, but still be strong enough to work well. Too light and they don't surf well, but too heavy and they don't surf well. So there's a balance point there, and that's where we try to be. Taking the board off the rocker table once the top has gone on, that is by far one of my top favorite parts. It's just you and a shaping stand, a board, and a hand plane. Everything else is out of your view. It's simple, it's pleasurable, it's quiet. You can be with your thoughts and you can just kind of be present. There's something about taking a nice sharp edge tool to a beautiful piece of wood and feeling the curls coming off and knowing that every pass that you're making, you're kind of getting it closer and closer to what you have in mind. Once we've shaped it down and the board's looking like it's supposed to look like, it's time for it to go into the glassing room. 4-ounce fiberglass, laying it over the board, draping it over the edges, cutting it, applying epoxy, and on the board. Once both sides are lamb coated, it's time to put in the hardware. Drill and router and install the fin box. And on the other side, we drill and put in the leash plug and a vent. There's a lot of air just naturally inside the board, and that air wants to expand and contract with temperature changes. And that vent has a little piece of Gore-Tex fabric in it, and it allows air to kind of breathe both ways, but it doesn't allow water to get in. Once all that hardware is put in, it goes back into the glassing room. We brush a nice, beautiful, thick coat of epoxy over the whole surface, and that we call a gloss coat. That's supposed to look beautiful and glossy and shiny and flawless. You get to see that board come to life. Whatever the colors in the wood, they really come out. It just makes it look like candy. You just want to touch it and run your hands down it, and it's just kind of the icing on the cake. Once everything is hard, we put it into what we call the oven, get that epoxy to cure, really kind of bake it, and just get it to harden. Put in the fin, screw in the vent, and ship it out. We just love the idea of building something that's sustainable and long-lasting and made by hand. Kind of gives you a deeper connection to the product over something you might buy on a shelf. When a customer gets the board, they feel it. They 100% feel the amount of work and the amount of passion that went into the board. So I'm not really looking at hours and efficiency. We're looking at like doing it right and enjoying it as we go.
Ma Baoli, better known as Gang La, is one of the 4 Grand Marshals leading New York's Pride Parade this year. But in the country he comes from, being gay is still a social taboo. The CEO of a Beijing-based internet company is on a mission to improve the lives of millions of gay men in China.
对于每一个 LGBT 人群来说，即使这个国家不允许你跟同性爱人结婚，但是你仍然要勇敢地去选择你自己的生活，你仍然应该拥有幸福生活的权利。
Ma's company Blue City runs an app and a website specifically for gay men. Blued is one of the biggest gay social networking apps in the world, with an estimated 30 million registered users. Unlike most other apps, Blued is more than just dating or hookups.
大家可以在我们这个软件里面找他自己的情感，然后可以阅读相关的内容，然后可以进行一些娱乐，比如玩游戏啊，比如看直播啊等等。
Back in 2000, when Ma studied at a police school in northern China, he realized he didn't feel like everyone else.
因为他们都找女朋友，然后谈恋爱，但是我对长得好看的同性的男生，我反而觉得对我更有吸引力。所以那个时候我就到互联网上去找这样的一些资料，然后希望能够告诉我自己，我到底是谁。互联网上所有的信息都是负面的，都是错的，就是说同性恋要电击疗法，要被治疗，然后要吃药等等。
After visiting some foreign websites with different attitudes to homosexuality, Ma created his own site for a Chinese audience, encouraging people that
他们也是正常的，他们不用自卑，然后也不用自杀。
Even though attitudes towards homosexuals are slowly changing in China, it's still a social stigma. The virtual world of Blued, where members can be open about their sexuality, is for most a striking contrast to their real lives. This is live streaming, a function added to Blued in late 2015, right as the internet craze was starting to take off in China. Many self-made stars like Jin make decent amounts of money by receiving audiences' virtual currencies and gifts.
我们不是彼此的初恋，初恋这种事儿多不靠谱啊。
For Kyle and Klaus, a couple who have come out, live streaming on Blued means something different.
其实我经常会收到很多粉丝的一些互动的留言，就是类似就是说你们让我们看到了同志情侣之间的一些希望啊，我看到这样的留言我是很欣慰。
The government's rules for acceptable content online may shift quickly in China, with LGBT material in a grey area. Many companies feel the chill of the recent internet crackdown, but Blue City still runs as usual. Ma has won the Chinese government's trust by helping with HIV prevention among gay men. A third of the company's staff are dedicated to screening pornographic and politically sensitive content.
我不太多的愿意去对抗，我更多的愿意去对话，去改变他们的想法。我觉得这个可能在中国来说是更有效的。
In the past 5 years, Blue City has grown from a team of 7 people to a promising business with about 250 staff. Ma said the company earned over $15 million last year, mainly through advertising and selling virtual currencies to live streaming audiences. Now the company is expanding overseas.
我希望吧，通过我们的努力，Blued能够成为全球第一家在美国纳斯达克或者是纽交所上市的这样的同志互联网公司。
This is Rich Chigga. He's a Chinese rapper by way of Indonesia, and he's very popular on the internet. This is Joji. He's a Japanese-Australian singer, and he's also very popular on the internet. Plus, Joji invented the Harlem Shake meme. Let me say that again. This guy, Joji, in the blood bathtub, invented the Harlem Shake meme. But we'll come back to that. So Rich and Joji are both signed to 88 Rising, an entertainment company hoping to build a lasting global brand that will outlive singular moments of virality. They primarily create content combining Asian culture and hip-hop, a formula that apparently pleases the internet gods greatly. They've only been around for 18 months, but they're already putting up major label numbers.
I think that we have an unprecedented collective of talent, a group of predominantly Asian artists, really making waves globally, which from an independent point of view as well.
88's founder, Sean Miyashiro, cut his teeth launching Vice's electronic music channel, Thump. But quickly, Sean became interested in life beyond dance music.
I knew that after launching a whole content platform that I have kind of the ability and the know-how to do it again, but for what was the question.
So Sean moved to the Bronx to start over and figure it out. He couldn't afford an office space, so he worked out of his car at the top of a grimy parking garage.
Everything kind of started here. If you look around, this is my environment. This is my serenity, really. 88 Rising was built here. Built on the grounds of LA Fitness, residence in a parking garage. I was living in the Bronx. I'm just like, damn, where the hell do I go? So I just come up here and I just kind of figure things out every single day. Being like, okay, what the hell is this thing? Coming here was kind of like my own kind of private office, basically. To be honest, I would even go to the bathroom here. I would take pisses here, you know what I mean? It was, it's just too far to go back down there. When I need Wi-Fi, I'd spend a good part of the day at Dunkin' Donuts. Hi, how are you? Can I get a chicken snack wrap?
Before 88 Rising officially launched, Sean caught a surprise break in the form of a Twitter friendship with a funny 16-year-old kid from Indonesia named Brian, who taught himself English by watching Rubik's Cube tutorial videos on YouTube. Seriously, that's true.
I thought his Twitter was genius, from the future, just crazy, and just the shit that he was saying, the memes he was making. But I didn't know that he rapped or anything like that. I really didn't, and he came up with Dat Stick 2 weeks later.
12 in the morning, pop shells for a living and baby gon' smell blood trail every minute, bro.
Dat Stick was Brian's first ever attempt at making a rap song, and it immediately went viral.
Everything was great about it, but the one thing that I noticed is the song was hard as hell. Just everything about it, man. Just it was menacing, bro.
Soon after the video dropped, Brian signed with 88 Rising.
I'll FaceTime with Rich. Sorry for calling you Rich Chigga on my phone, Rich. Brian, he gets super pissed off that he's saved in my phone as Rich Chigga. He's like, dude, am I not a human to you? What's good, bro?
What's good, brother?
How you doing?
Doing great. I just did a sound check.
How was it?
It was tight.
So, Brian could definitely rap, but some viewers understandably took offense at a Chinese kid satirizing rap cliches and calling himself Rich Chigga. But if a group of well-known rappers saw the video and genuinely liked it, that could at least help validate Brian as a legit hip-hop artist. Plus, it could be really funny.
It was just kind of an idea that I just had on the spot. Everything that rappers say is better and funnier and smarter and wittier, and it's just more entertaining. We just edit it as tight as possible, put it up, and it really worked.
Yo, this nigga got a pouch on and a Reebok pouch.
This is the hardest nigga of all time.
You said when you come for a chigga like me, that was dope.
Like, it's just lit, and I think people will take it as a joke at first, but it's like if he ran with that and kept doing more videos like that, it's just lit.
You know, I'd never been to America before, and like all of a sudden, just like I see like all the rappers that I listen to just like reacting to my stuff, and I was like, what? How did this happen?
The reaction video also went viral and even led to a remix of Dat Stick featuring Wu-Tang's Ghostface.
I'll get on that track. You know what I'm saying? Yeah.
Really, on the remix?
Yeah. Oh, you know him?
And yeah, the remix went viral too. Brian has since acknowledged the misstep in his name and claims he may change it. But for the time being, he's still Rich Chigga to his fans. An ever-growing global audience, hungry for more releases from emerging talent around the world.
I didn't know that it was gonna be this impactful and this important to people, and I'm very thankful and blessed that it has. And every day now that I wake up, it's like it's just like a new mission every day.
A major part of that mission involves Joji. Remember the bloody bath guy? He's a former YouTube personality in the middle of a career transition.
The sound of this song, Will He, it's like a trap song that you can like slow dance to. Awkward prom shit, you know what I mean? I used to do crazy episodic internet videos. It was going well, and one day it was me and a few friends just in a room. We were casually chilling, and then someone plays the song, and it's brand new at the time. I happened to have a lot of costumes laying around, so I told the other guys, I was like, get in these costumes and let's just dance to it, like who cares? We were like, okay, let's just go crazy at the drop. So that video goes up, I go to sleep, and the next morning, everyone's doing it, like next morning. That taught me a lot about the internet, how people want to just be a part of something. And from that point on, something changed, and I was a little better at understanding demographics and people and what they want to see and what they want to hear. I was friends with a couple other artists who were affiliated with 88, and then I also started to realize that 88 is the bridge between Western and Asian entertainment, and I really wanted to be a part of that.
Joji just released the In Tongues EP, his first project as a serious artist.
Joji's In Tongues record came out a couple weeks ago. It's #2 on Billboard on the R&B charts, which is crazy for, an independent release, and he's like a brand new artist.
And the success is even more impressive, knowing he went from creating something like this.
It's just Taco Bell. What could possibly go wrong?
To creating something like this, the newest music video for his song Demons. Tonight, Rich Chigga has a show in New York City. Tickets sold out in an hour.
I came here, I'm first online. I was here at 1. Yeah, I was the third person online.
So why'd you get here so early?
Because I want to see Rich Chigga. I want to touch him.
What do you guys think of Joji?
He's
That's my dad, son.
Did you guys cop the new EP or like?
Yeah. I woke up at 6 in the morning just to cop that shit. And then I listened to it, and that shit started making me cry.
This is actually kind of exciting. Every time, this never gets old. Like, you live online and social media, but like, there's nothing like just being with the people.
More often than not, viral success happens by accident. And then after an appearance on Ellen or Jimmy Kimmel, the creator's star power fizzles out. But 88 Rising has figured out how to turn potential gimmicks into brands with an actual following that keeps coming back for the next thing.
Oh, shit!
So keep an eye out for 88's next move. But more than likely, it won't be covered on network television or terrestrial radio. Although, as they've already proven, nowadays that really doesn't matter.